Ladies and gentlemen, please make your way into the presentation room. We are starting in 2 minutes. Everyone, please make your way into the presentation room. Exhibitors, sponsors, presenters, everybody, please make your way into the presentation room. Thank you. Good morning, ladies and gentlemen, and welcome. My name is Steve Torsa. I'm the founder of Wholesale Investor. I'd like to welcome you all to Emergence 2025. Now, as we start this, I appreciate some people are still going to be coming into the room whilst we're actually kicking off, and I've got to put my battery on so it doesn't actually turn off while I'm going through this. So a couple key things for today. Just want to note, as a first sort of just order of business, is that we've obviously the VIP row is the second row. The front row is for presenters and speakers that are coming up. So just please observe that throughout today. Just want to make everything as efficient as possible. So firstly, I just want to say a big thank you for joining us today. This is the largest event that we do each year. This is our marquee event. And the idea behind Emergence was, it was born out of the idea of actually placing a spotlight on the innovation ecosystem. And that was in 2018. And as you can see, it's significantly progressed since then. And now Emergence is about placing a focus and a spotlight on the private market space. And the interesting part about that is every part of that private markets area is represented here today in the actual event. And the history of Wholesale Investor, to give you an idea, whilst many of you know us for a lot of the work that we've done on the innovation side, which I'll be sort of talking about in my sort of presentation, really what people don't know is we actually ran our first property and fund manager showcase going back to 2012, right? So we've actually been putting a spotlight on funds and property right the way since 2012. And it's been a key part of what we do because we realise it's part of your portfolio that you typically invest into. And so with each year, And I'll say the other part was, one of the elements that we've also added is obviously on the crypto side. Now, we've also, the first company we worked with in crypto was in 2013, which was Independent Reserve. They actually did their seed round in our boardroom. So we are very good at working with I suppose, new emerging technologies and also innovative business models, as well as traditional at the exact same time. The reality when you do something like Emergence, it's a big event. You know, across the next 2 days, we'll have anywhere between 750 to 1,000 attendees actually at the event. We've got around about sort of 50 to 60 companies that are going to be presenting their opportunities to you. We've got 40 keynotes and panelists throughout the next 2 days. We have absolutely stacked these 2 days to make sure you get as much value as possible. We want you to walk away from this event with 3 outcomes. Number 1, we want you to basically experience high-value networking. 2, we want it to help shape your own investment thesis about how you're thinking about markets and your own investing, right? And then the third one is getting access to opportunities that you don't normally get access to in the normal day-to-day. And those are the 3 elements which make Emergence quite unique. So as mentioned, the story in us doing this, we've been doing it since 2018. Every Emergence has its own journey. In 2020, who came to our Emergence in 2020? Okay, surely it was more than that. It was literally the last event most people went to before they went into lockdown, right? So to give you a bit of an idea. And then in 2022, I remember we hosted it. So if you think about the journey leading up to that, not knowing what was going on with COVID, the bushfires of late 2019, etc., where the skies were orange and I was getting calls from international guests saying, what's going on in Sydney? Is it burning? Right up until 2022 as an example, where we literally hosted Emergence 1 week after they lifted inside lockdowns, right? So there's a lot of bets that we play in doing this as well, but that's innovation. We take bets and then we deliver on it. Over the next 2 days, you're going to get access and you're going to see some incredible presentations from some amazing CEOs, fund managers, and also and founders behind the business that are presenting. And the part of that is we want to make sure that you walk away with as many connections as possible. So this is the presentation room. Then we've got exhibitors outside, different sponsors, and then also there's an exhibition room next door as well. Each day will have different exhibiting companies in the next room. Likewise, each day will have different presenters, keynotes, panelists as part of the actual event. So that's the key parts. Now, to get onto my presentation, really Emergence is your destination over the next 2 days, you know, for insights into venture capital, digital assets, private equity, private credit, and also family office investment trends. And I'll add to that as well, ASX listed small caps. If you've been to my meetups over the last couple of weeks, you'll know that I believe right now is the best time that I've seen for the foundations of growth across the private equity side, high growth across the innovation side, and then also high yield on the private credit side. And there's a couple of different things I'll talk to about that. The reality is there's also still some lingering fears, right? As far as people are concerned about why Warren Buffett is still sitting on so much cash, right? People are wondering why there are some people that are still selling at the moment. People are also concerned about potential for trade wars. But there's so many different foundational things that are in play that are going to make the most significant difference. The thing I always highlight when I'm talking about innovation and what makes innovation absolutely beautiful is that first what it does is it replaces the value of the incumbent and then it accelerates exponentially past it. And what's interesting about that is you're seeing that across 5 different platform technologies that are also all converging at the exact same time. These are the technology, these is what we want to be showcasing across the next 5 days and be providing insights on so you can build out your own investment thesis. And what's really interesting is that if you look at the way that technology is adopted, it typically goes through S-curves. And of course, us in the room, we're probably in the early adopters, the innovator standpoints where we take things on early. But when it crosses that 5% mark, that's when the early adopters, that's when it really starts to accelerate, right? And you can see the type of growth potential that often takes place, you know, during those periods. And what's interesting is those 5 platform technologies are all sitting now in that sort of early adopter and early majority. So for example, when I did my maths, I mentioned that crypto is only now at 8% adoption, to give you an idea, right? And when you go through the list of all those different areas, you'll see a lot of them, they're right in that sweet spot of that early adopter phase. And even for things like private credit, right? Private credit is still, even though it's got a lot more attention and spotlight over the last sort of couple of years, the reality is, compared to the US and UK, it's actually still very early in the cycle, and I know Brett will be talking about that today. I love this statement from Cathie Wood. People have got different perceptions about her funds. What I love the ARC research. I think what they do is fantastic. Every year when they bring out their big ideas report, that's my favourite thing to read. Typically, in this comment she makes, technology breakthroughs in AI, autonomous mobility and humanoid robots are likely to turbocharge productivity again, causing another step function in growth over the next 5 to 10 years. There is one of the beautiful things they did in their report was they actually highlighted all the different times in history where there's been a convergence of new technology platforms all going through that early adopter phase. The increase in productivity is unbelievable, where it has almost like 100 to 150% impact on GDP growth, right? So that's why that brings to this line is that effectively we all think about the value that's being created out of the internet. Like you look at the Magnificent Seven, you know, there was over $3 trillion of value alone created in the Magnificent Seven last year alone. However, this statement that basically first AI is going to replace the value of the internet and then it's going to accelerate exponentially beyond it. And it's an important thing to sit there and think about because we all know how much money's been made and how much value's been created. So then what does this look like going forward? Now, is it always a straight linear line? Absolutely not. Technology, you know, it looks like this, but ultimately the direction is what I showed you before with that S technology adoption curve. The example that I love to give, you know, and Michael Saylor is the ultimate bull when it comes to Bitcoin. And it's also nice to note that it's down to 86,000 at the moment. It's hitting that range. By the way, for all those that have been following Bitcoin, please, it's one of the things to note that when it goes through its bull run, it always has dips of between 20 to 30%, at least 5 to 6 times in its actual bull run, right? So the call for people saying it's in its bear market's just a little bit early. But he had an interesting way of thinking about it. His company MicroStrategy back in 2020, he thought to himself, well, I've got my revenue approach to my business, right, and how I'm trying to grow, and it was fairly flat at that time. So what he did was he unleashed a Bitcoin strategy on his balance sheet. Go and have a look at the share price of, they've rebranded recently, of Micros. Go and have a look at the share price of what MicroStrategy has done in the last 5 years. His prediction is that basically with it compounding, he predicts it will compound on average at 29% ARR over the next, by up to 2045 and will be valued at $13 million. And the question I always ask about Bitcoin is, when do you actually start to believe? You know, is it when it crossed $1,000? Is it $10,000? Is it $100,000? Is it $1 million? Like, what's the point? You know, at which someone says, for me, I was fortunate enough to work with a lot of companies really early on. But when you look at this digital, and obviously today's we've got a digital asset panel session, which is why this is a topic for today. There is 3 massive macro factors coming into play right now when it comes to Bitcoin and the entire crypto ecosystem. Firstly, you know, the potential potential expectation, obviously with the US government setting up a Bitcoin strategic reserve. They currently sit on, I think, 217,000 Bitcoin. And the prediction is that they'll look to basically have 1 million Bitcoin in their strategic reserve. So if you put that into perspective, that has to come from somewhere. But likewise, if a sovereign, as a sovereign fund, if they trigger the purchasing of Bitcoin onto their balance sheet, then what else is likely to happen? Other sovereigns will follow. The next part is there's now 70 plus companies that actually have crypto on their balance sheet, listed companies. It is very likely going forward that if sovereigns start doing it, then also corporations will start adding at least 5, and the prediction is around that sort of 2 to 5% of their treasury as actually Bitcoin in part of that. And then the last part is, has anyone tried buying more than $10,000 worth of crypto through a normal crypto exchange? Has anyone tried that? It is a shit experience, right? No, you get called by the bank, you get your bank account shut down, there's all this. So the ETF products make it such that people can go and literally buy 500K worth of Bitcoin and not get a question asked, as opposed to the experience beforehand. So to me, this is why being excited about it being on a dip of 30%. And by the way, we've been talking about this since July of 2022, when we were saying July 2023 at our venture and capital event, and you look what it's done since then. So the venture capital trends, this one's an interesting one. I'm not going to speak to, obviously there's a venture capital investment trends panel today. I'm not going to speak to the different sectors. All I want to speak to is the observations, which is coming out of if you take out all the noise that's coming out of the US government and all the media that's coming around it, it is absolutely clear, and this is why I've put it as this will be the venture capital trends. They've got an absolute focus, and this is going to be a global focus, for energy domination. Previously, I was just talking about just sustainable energy. Now the focus is just energy. Why? Because now there's fight for 2 different types of dominance: technical dominance and energy dominance. So then the other part to that is the investment in autonomous solutions, whether it be digital or physical in the shape of robotics, is going to be a massive focus going forward for this year. And then tech stack. The different tech stack that every company is building their businesses with is going to come into a massive spotlight for investors, because it's going to show investors where the headspace of the founders are at and how they're thinking about maximizing productivity efficiency in their business. And then the last one is AI, agri-tech, AI in healthcare, health tech and agri. There is some incredible innovation happening in that space, and you can already see this take place, at the moment. So that's just my high-level perspective on what I see is the trends that are going to be massively in focus this year. Without doing the sector breakdown, I'll save that for the panel. The macroeconomic factors, when I did my meetup last year, these were the 4 factors I said that investors will be looking for to understand the triggers in the actual environment. A pro-business government in the US was a starting point, and we saw what happened with the markets with that. The second part is that interest rates also have come down 1%, which is obviously, as soon as that happens, then more money will obviously start to flow into innovation. The second one is there's obviously been a quantitative tightening cycle from central governments, but unfortunately, those debts that they have to be paid in some form. So the expectation globally is that that quantitative easing cycle is about to come, because central banks around the world will need to print money to start to basically pay for some of their debt expenditures, their debt obligations. So these factors all combine to, if you see those domino effect, and then the last one being that cash coming back in on the sidelines. And I saw a great podcast of someone talking about there's an estimation of between $6 to $7 trillion of cash sitting on the sidelines that has the potential to come in. So that's why, even for the innovation space, it's been such a punishing area for the last two years in the sort of small private sort of area. To me, it's about to go through one of its biggest runs, and for all those factors I just aligned. So then, by the way, I know when I mention the word Trump, I know exactly 50% of you cringe. I know it because we polled it, right? But I had an interesting thought over the holidays. I just thought to myself, I wonder what the Trump last presidency looked like, right? If you're just thinking about it just pragmatically, what did it look like from an innovation perspective, right? And if you look at the NASDAQ 100, said it went from 5,155 to 13,197 with a 150% increase across that 4 years, 26% compounding. The normal average is 12%. Right now, of course, there was COVID stimulus factored into that, so I'm sure there's smarter people than me that can figure out how that sort of, how that factors into that. But it sets a tone. The one that really blew me away was crypto. I had no idea that Bitcoin was at 890 at the start of that presidency, and by the time it finished, 35,000. It's not hard to understand why you got such a big crypto vote in the US when there's 50 million account holders, right? US venture capital also had a massive increase from 69 billion to 156 billion in that time. The one that was a bit disappointing was the Australian All Ords. Only went up 21% in that time period. But then the other one that surprised me was the Australian venture capital market. When I looked at that and thought, at the start of that period, 364 million, and by the end of that period, 1.23 billion. So an increase of 238% in the venture capital ecosystem. It's very rare you have such a significant activity or macro factor where you can actually look at what it did, previously and what it could look like going forward. So that's my presentation for today. Tomorrow I will have a different presentation, and I'm going to be giving my thoughts on the potential for AI, how I'm using it, and also how I'm seeing others use it and what I'm focused on from an AI perspective, because whilst people try and may think it's overhyped, I absolutely disagree with that. And I know that from my own personal experiences and from the conversations that I have with founders and CEOs every single day. So the next 2 days is your insights into the innovation future. To me, these are the 3-decade-long trends which I am focused WI around and everything that we think about. The Great Succession is one of the biggest ones, and hence there's a private equity focus as part of this. The expansion of private markets, that's been sort of well documented. And then the rise of non-bank lending and private credit opportunities. I was very surprised to see still the small amount of money that goes into private credit from the business side, and then even on the property side, only 16.5%. So it's still very early in the adoption cycle in Australia. This stat is hard to forget. This is the greatest wealth transfer that will take place over the next decade. It is one of the most important trends and shifts that will take place. The expectation that by 2033 that it will grow to $30 trillion, and it's currently growing at 12% CAGR. So those areas of non-bank lending that are all featured today as part of this conference in our companies that are presenting, in our keynote speakers, in our exhibitors, etc. So today, our hashtag is Emergence 2025. We've got a media wall outside. We strongly encourage light up LinkedIn, light up X, take photos with me, take photos with everyone, share it, because how this space grows is because of you guys. We can only do so much. We work incredibly hard. We've got a small team that works incredibly hard to do what we do. But the reality is how this space builds is from you guys, and probably how you guys found out about this event is through someone that you know. So take a photo and share it. We've got an incredible lineup of speakers today. So there's a couple of things I'm going to go through now. Speakers, then some of the sponsors, and then also the companies presenting today. Hashan, I tell you, you are going to absolutely love his session on life science. I think life sciences, as just mentioned, is one of the biggest growth areas, potential areas over the next 5-10 years. The way he sees life science is very unique and very different to anyone else I've spoken to. He's one of the best in the country in this space, and I am super grateful to have him here presenting. We've got Simon Matter from Prime Financial. If there's a business that I absolutely love that represents almost like the service side of what Wholesale Investor does, it's Prime Financial. If you go and have a look at their website and look at all their different business units, I've just never seen a business that's so well set up to take advantage of all the future trends which are coming down the pipeline at the moment, except for the digital asset side, but I'll make sure I hook him up with MHC by the end of this event to get that on track. Ashley Law-Smith from Startup Nerds. I love the work that they do with startups in actually preparing them. They've got a special showcase today of some of their startups that they're actually working with and helping to shape going forward, which I know you guys will enjoy. Edward Carroll from MHC Digital. I think what MHC is doing, the first time I spoke to them, I was blown away because I thought what they are doing goes back into exact alignment with what I showed beforehand. When corporations and family offices and high net worth start allocating 2 to 5% of their wealth to crypto, or to basically get it on their own balance sheets, they are the ones to do it through, right? Because when you're doing large volumes, you do need someone to assist with that. MHC was actually founded by Mark Carnegie, who's obviously one of the sort of legends of the venture space in Australia, and one of the, has done incredible work for this entire ecosystem. Then we've got Andrew Shute from EBR. If you followed Andrew from 2 years ago, you would have done very well because his share price has increased nearly 270% over the last 2 years. when you know that basically cardiac disease is the #1 killer of humans, right? He's providing a wireless defibrillator, no, not wireless defibrillator, that's a rapid response revival. A wireless pacemaker, they said he's got a different name for it from that, but basically a wireless device that can go into the heart that's a lot easier to go in. They've made some incredible milestones in the last 2 years, and that's reflecting their share price now. They're over a 600 mil market cap company and doing incredibly well. Brett Craig, I watched his presentation in Melbourne, is an incredibly insightful look into what's happening in the private credit market. He's built his own fund over the last 7 years to over $1 billion under management. And then Nick Richards from Venturely will provide that perspective of what I mentioned about succession and how they're approaching it in the marine space. So that's our keynote talks for today. We've got 2 panel sessions, venture capital investment trends, always a top attending session for us. And then obviously, so I know for a lot of people, the venture capital is the fun one, the risk one, but then we've got the real fun one, which is on the crypto side, where I said we get that great perspective of 3 fund managers that are actively in this space, focused on talking about what's happening in the crypto area. And as I said to you, it's only at 8% adoption, globally. So we've also got an incredible list of companies presenting today, and I'm going to do my best to go through them. One of the companies, and also Merkle, they're also going to be on the panel session as well. They're a digital asset fund manager, and what I love about how they think about it is they set their performance benchmark against Bitcoin, right? Obviously, when crypto markets are on, it's very easy for digital asset managers to do quite well, but they set their performance targets about how much they can go above Bitcoin. So I found my conversations with them incredibly insightful. Also, we've got Oz Premium Finance, which is basically helping investors generate monthly returns via insurance premium funding. We've got Deltine High Yield Motel Fund, which is backed by David Toomey, who's built and listed a company in the US, right? He's basically he will show you how they're actually taking motels from around the country and turning into high-performing assets and high-yielding assets. For the VIPs, we've got Chefin. One of my favourite additions to this event is having their food as part of our VIP area. You'll love Petco, great business, great model. They sort of got their sort of start when we were doing our first Emergence and have been, provide some fantastic stuff. Real-time data, they're optimising the frontline work productivity for streamlined data connection in the agri space. Future Property Group, fantastic background behind the founder of the business. They're developing sustainable, eco-friendly communities with energy-efficient housing solutions. Kitea Health said incredible life science business. It was actually referred to me by one of the life science companies that we deal with. Said they're involved in hydrocellular care, I can't even say that, with wireless brain pressure monitoring technology. They've got some incredible backers, incredible VC backing out of some of the top groups in New Zealand. Unikorn Capital doing a fantastic project in sort of Western Sydney. They help investors basically get access to premium property opportunities. The Ordre Group, super happy to have Simon come over from the UK. He's backed by Alien, backed by Perennial, backed by Alibaba, and what they're doing is they're using AI-driven authentication to revolutionise luxury fashion verification. We've got Old Quarter Coffee Merchants, and this is a uniqueness of WI. They've gone to sustainable farming practices or sustainable farming, coffee bean farming areas in ASEAN, and are basically providing a go-to-market solution for them with their coffee beans, which I think is amazing. Activeport automates telecom network management, reducing costs and boosting efficiency. They're an ASX-listed company that have also got some big announcements that have just come through. FC Capital, providing private credit solutions for an international market. Golf.ai, who's a golf fan in here out of curiosity? I think it's more than that, that's for sure. Using AI to enhance golfing experiences. Ausbiz said, I've been following Ausbiz literally since the day they launched, and what Kylie's been able to do with that business, the audience she's been able to grow, the speakers they're able to get on a daily day, but it's an absolute credit to what they're doing and something that's been needed in this space. Frontier Pets was introduced to me by one of my shareholders. They've built an incredible business in providing ethical freeze-dried raw pet food that's got obviously a longevity factor to it, and you can imagine how passionate their consumers are. Their recurring subscription rate is unbelievable. unbelievable for the pet food area. Acuity Development Group, coming in from South Australia. They've done over $700 million worth of projects, so they're going to be talking about their upcoming project that they're working on. One of my absolute favourite human beings to work with, Leslie Chong from Imugene, is also going to be presenting. You know, as someone that's experienced cancer within my own family, you know, over the last, you know, sort of 12 months, you know, the work that she's doing on the I can't even get it out of my head. Immunotherapy area is something that, you know, I think is super important, and obviously, you know, she's been a star. Expression Capital Partners is a private equity firm specialising in entertainment. He's actually coming in from London for this event. They've got some massive licensing deals with the likes of Hasbro and some big projects. They're actually a family office themselves that are creating an opportunity around the entertainment space through licensing deals and allowing investors to participate. ReachLX, helping leaders through their AI-driven solutions to actually, you know, perform at an accelerated rate. They're going to be doing a bit of a talk as well, but it's really about helping equip leaders with the right tools. And then Succession Plus, who I've been following Craig West now for 15 years. If there's a business that's also well set up to take advantage of business succession, he is the leader in that. He's the one that's been doing it for 15 years. So Craig's also going to be presenting today. So that's the introduction for the companies that are going to be presenting. I'd like to say a massive thank you to the sponsors. I strongly encourage you to go and see all of them. I said these sponsors, we are absolutely blessed with the caliber of sponsors, whether it be T&B Aura. You know, Charles is coming over from Asian. He's one of the leading sort of Asian venture capitalists. He's going to be doing a keynote tomorrow. So make sure you look out for his presentation. Prime Financial, I've already said what I've said about Prime. Like, I think that business, the way it's set up is perfectly, all of the business units are perfectly aligned. When you see the future of business, they're perfectly aligned to take advantage of that. OKX is one of the, you know, leading digital asset platforms globally, and super happy to have Mark, Lalissa and the team involved. By the way, the coffee that you're going to be getting served today is all thanks to them. They're the actual coffee sponsor. So make sure you go to their stand, have a chat with Mark. I've thoroughly enjoyed my conversations with him in understanding the crypto markets. And I said they've got a fantastic platform for trading and participating on. MHC Digital Group, as I mentioned before, perfect for high net worth, family offices or corporates that are looking to get exposure to crypto on their actual balance sheet. Flanders Investment Trade, anyone looking to go to Europe and have a base in Europe, have a chat to Luca during the event. He's an incredible guy. He's worked with a lot of Australian companies and helped them sort of get access to not just the Flanders market, but Europe in general. Invest HK, likewise, super happy to have them involved. They've been helping many Australian companies, investors, etc., basically get access to capital and expand into Hong Kong. Succession Plus, as I mentioned before, Startup Nerds, ReachLX, Bybit, you know, have to give a big shout out to Bybit. They obviously had a rough weekend, but their CEO did an incredible job of communicating what was taking place, you know, during that time period. If you haven't seen his communications, I strongly recommend it. But also a crypto platform with 60 million users globally, and now obviously looking to work with Australian investors in this space. Non-correlated capital group. For investors that are looking to professionalise what they're doing and sort of set up funds or to have sort of smaller scale offerings, they're perfectly built to actually do that. So make sure you go and have a chat to Troy and the team. BetterX, been a great partner ours for the wealth managers and financial planners in the room, or the investment groups that are looking to give their clients exposure to crypto. Have a chat to BetterX. Rocking Horse, you know, helping R&D lending. Agro lending, for all the private credit fund managers in the room that are looking to really digitize their solutions from end to end. Agro lending is the company to go and speak to. Chefin, incredible food. Thank you to our media partners, and also thank you to our event partners, which include the Dubai International Chamber and also GITEX. We're going to be hosting a pitch night shortly where we're going to be featuring, you know, where we're basically going to be giving Australian startups the opportunity to go and pitch on a global stage in Dubai. So I have gone well over time. Everything is inside the Capital HQ app. You've all received emails about it. I know, because I helped write those emails. Oh, sorry. Christine wrote the emails. I helped send them out. So you can get everything for this event inside the actual app. We've done everything to make sure it's a seamless experience for you. The final point from me is this, and I say this every single year, and it happens every single year. The power of one conversation in this room can change the entire trajectory of a business or of an opportunity. So make sure you meet as everyone as possible, but also make sure that you go and chat with all the different exhibitors that are presenting. We have got some incredible, the amount of founders that we're working with that are either family offices themselves, and this is their next business, or being, like our curation, and I'll go through this just after lunch, the amount of founders that we're working with that have built and sold businesses beforehand or have been senior in quite significant corporate businesses, and now this is their sort of venture, into the sort of innovation world. Go and have a chat with them. The power of one conversation in Emergence is absolutely everything, and I'll assure you this, you will meet someone here today that will be an important relationship for you in 5 years' time, and you would have absolutely forgotten that you met them here, but don't worry, I will remind you. So on that note, final thing is, we've got a lot coming up. Come and have a chat to us. I said, if you're an investor wanting to come over to these different opportunities with us, come and have a chat with us. If you're a company that would like to be featured at any of our upcoming events, come and have a chat with us as well. We are being super aggressive this year on the event side because it's been a punishing last 2 years on the innovation side. This is the absolute time to shine across those 3 areas. As I said, innovation, private equity, private credit have all got their spotlight now, and we want to make sure we become a centerpiece as part of that. So, ladies and gentlemen, enjoy your Emergence experience.
Thank you, Steve, for the very amazing, informative opening presentation. Good morning, everyone. I'm Bella. I'm going to be the MC for today. To start the event, we are honored to have with us the founder and managing partner of KPRX. With deep expertise in life sciences investment and innovation, he will be sharing his insights on why the sector is poised for success in 2025. Let's give a warm welcome to Hashan de Silva.
Thanks everybody for coming. Thanks Steve for organising and inviting me to be here. And thanks to Wholesale Investor for supporting innovation in Australia. It's something that I'm very passionate about. It's a tough act to follow going after Steve, and I'll have a disclaimer out front. I have a 4-month-old baby who's going through one hell of a sleep regression, so I apologise in advance if I'm not as peppy as our host. So moving through actually the real disclaimer, a message from our lawyers. So what Steve asked me to speak about was the healthcare innovation bull market. And so I'm not going to come here and lie to your faces. We are in no stretch of the imagination in anything close to a healthcare bull market in today's market. The market started to collapse globally, probably in 2021, in Australia in 2022, and we have not seen a recovery. But what I want to talk about is, I guess, why the market only matters when you're buying, or if you're a company, when you're looking to do a fundraise. But the actual commercial outcomes, the market is less important to healthcare than it is to other sectors. And so these are the kind of 4 points that I'm looking to cover. Why Australia and New Zealand? And a lot of people, when I pitch my fund in Australia to investors, particularly in the US, they say, why would I care about Australia? Why am I looking to come to Australia? The US is the locus, the epicenter of healthcare innovation. And while that is true, a lot of important innovation comes out of Australia, and we'll meet some great companies today and tomorrow. Why now? Going back about what I was saying about the market, obviously why healthcare, and then look into the future. So on why now, as we were discussing earlier, we're in a deep bear market in healthcare. What we're looking at here is what we can ascertain from publicly listed companies in the US going back to when the market really started to collapse, which was April 2021 for biotech companies. We've seen it go down, we've seen it stay down. And the data's a bit old, but if you were to fast forward to today, we saw a slight recovery towards the end of last year. And on November the 5th, I believe it was, we saw that kind of really fall off. But as Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. Healthcare, unlike other industries, if you use tech as an example, with healthcare, you don't actually take very much business model risk. And what I mean by that is, the price of a drug, in particular, is very forecastable when the drug is even in its infancy. You can look at what other drugs are on the market, you can look at where they're priced, and based on that, you can have an estimation of what you think the clinical benefit of your drug would be, and have a good idea of what price will be. That price and that price elasticity is very low, right? What we've seen through cycles, going back to the 20s in the US, is that while insurance is linked to employment, we actually don't see insurance rates really vary that much when through cycles. And the one time we did see insurance vary a lot was when Obamacare came in and we saw it go up. And so with that, demand is largely unaffected by market conditions. And if you look at CSL in 2008, when everyone thought that the demand for their products would fall because they're super high priced rare disease drugs, and that if people lost their insurance, they would no longer be able to afford those drugs, we did not see that happen, right? We saw the demand and the sales growth stay flat. On the margins and cost side, the margins for a drug in particular, we know that well before the drug goes on the market. So the manufacturing package, the CMC package, is audited by the FDA very early on in the clinical development piece. And so we actually know the unit economics of a drug maybe a decade before it goes onto the market. So what that means for an investor is you can actually forecast what the business model and the profitability of that drug will, or the drug or device will be, way before you have to worry about it getting on the market. So what is the real risk? It's the clinical risk, right? Will the drug succeed, or the medical device succeed, or get regulatory approval? And you compare that with tech, right? If you're an early investor in Uber or an early investor in Netflix, you really don't have much insight into what that business model will look like when the company's at scale, right? Who are your competitors? You don't know. What are the pricing power? No one really knew, and right? If you fast forward to today, Uber just became profitable. Netflix is accounting profitable. And so if you're an early investor, your ability to forecast a P&L in a tech company, and any other company really, is not the same degree of certainty as healthcare. So the crucial skill when looking at a healthcare company in early stage is your ability to assess the clinical risk, which is largely idiosyncratic. And if I'm to show you an example of that, an Aussie example, Neuron. So prior to starting Carspeak, I was the head of healthcare prior to starting KPRX, I was the head of healthcare at Carspeak Capital. Carspeak were the largest investor in Neuron. So we acquired our initial investment in March 2020, taking 14% of that business. So if you look at that share price chart, right? You can see where we invested again. The first uplift is the FDA, is the phase 3 trial being positive. That's in just before 2022. The next uplift is FDA approval. The next uplift is when the pricing is announced and the drug is commercially launched. And if you have that against the backdrop of what the market did, right, we saw a 40% decline in the XBI. So I guess the key point that I'm trying to make to everybody in this audience is, with healthcare, don't be too concerned about what the market is doing, except when you enter. And so the opportunity present in the market right now, I think is at least, I mean, I'm not too old, but it's been the best time to invest in healthcare I've seen in my career, right? Particularly in the private side. The venture capital funds in Australia are few. Private investors have largely left the market. Generalist investors have kind of really left the market. The companies that exist in healthcare, unlike tech companies, healthcare companies can't pause their funding, right? So healthcare companies, if a clinical trial costs $10 million today, it's going to cost $10 million in 2 years' time. If you pause that, all that means is your patent clock is ticking and your business is becoming less valuable. So a healthcare company has a much more of an onus to raise today at a lower valuation than maybe a tech company that can maybe mark time, do things cheaper, maybe cut down their go-to-market plan, but a healthcare company can't. A clinical trial value is set. Same with the med tech and same with a diagnostics company. And so we really think now is the time to be investing in healthcare. And as a vintage of VC funds, if you go back and do an analysis of the best performing healthcare vintages, the ones that launched in 2000 weren't the best ones, right? Because we had quite a steep crash in 2021, 2022. But the ones that launched in 2007, 2008 did quite well. And so I think the healthcare funds that are launching 2 years ago to today, and then maybe in 2 years in the future, will do really well. One caveat that I will put, we have some serious near-term regulatory uncertainty that we've never seen before. And this regulatory uncertainty is across the board. So the first thing I'll talk about is what's happening to the US has been the locus, the focal point of healthcare innovation for forever. The cuts that are being done to the NIH BARDA, other government bodies, means that I think there is a potential that we'll see the center of gravity of healthcare innovation potentially move out of the US to somewhere else. Where that'll be, we don't know, most likely China. And so that could be that could actually change what the eventual economics might mean for biotech doing research today, where in the past the US was a market of choice, but in the future, in 10 to 20 years, it might not be. On the other side of it is the ability to get a drug or device approved. We're seeing ad hoc cuts at the FDA across the departments with really no rhyme or reason. One of our portfolio companies has an application with the FDA at the moment. The person that was running that application is no longer with the FDA, and the last I heard over the weekend was he might be getting hired back. So there is that material uncertainty. So what does that mean for me as a fund manager? With my companies, I need to make sure that they're funded to weather this initial storm, be it 1 or 2 years, where we might see some dislocation before the regulatory landscape is more known. Now that's easier said than done in a particularly tough market. And so that all that means is we're being a lot more picky with our positions, making sure that they are funded, and less likely to we're more likely to be more concentrated than to be not in this market. Why Australia and New Zealand? So this is the number one question I get whenever I leave Australian shores to talk to LPs outside of Australia. What most people don't realize is Australia is actually the market of choice for conducting early stage clinical research by everybody. Pfizer, Lilly, everybody will come to Australia to do early stage clinical research. The biggest reason for that is our R&D incentive. 43.5 cents on the dollar back in cash. And so when I meet US LPs and I tell them that the federal taxpayer is paying for 43.5% of the risk capital of my portfolio company, they think that's crazy, right? Like the US was very generous with grants, but nothing like this. So what that means for me is if a company needs $10 million to do a clinical trial, I only have to really fund them 6.5, 7 mil. The federal taxpayer will do the rest. But on the other side of it as well is that it's a lot cheaper to run a clinical trial in Australia than anywhere else in the world. But we have an ethnically diverse population that means that we can recruit the required patients to mirror the US and to mirror Europe. So I'm sure clinical trials can be done cheaper in some other markets, in Asia, maybe Africa, but they tend to be a very kind of homogeneous population. On the other side of it, on that same point, a CT scan in Australia is about $100, $200. It's about $2,000 in the US. An MRI is about $500 in Australia. It's in the many thousands in the US. So the actual conduct of the clinical trial is a lot cheaper in Australia. And so on a kind of a purchasing power basis, an Australian company needs to raise 10, 20% of the money that a US company needs to raise to do the same level of work. So a company in Australia can stay in Australia, raise money in Australia, do all their work in Australia all the way up to the end of phase 2, and then not have to worry about going to the US until after then. So what that means, particularly for a cell therapy company, Leslie will be speaking later, right? The CMC package that you need to give to the FDA before you can even dose a human sometimes costs tens of millions of dollars. So as an investor, as a VC, that is, it's not wasted money, but it doesn't de-risk your investment. So you have to spend tens of millions of dollars to do manufacturing and certain types of toxicology work that doesn't de-risk or improve your value, but you've got to pay for it before you actually do the stuff that will improve your value. In Australia, you don't have to do that. And that is very attractive. And so all of these kind of regulatory changes has meant that we've become the market of choice. And because of that, we have the best clinical trial infrastructure in the world. There is no market better than Australia to do clinical trial research. New Zealand is a close second. And so what this has meant is that biotech and medtech has become one of the fastest growing sectors in Australia. So I've kept food and ag there as a kind of a control, but we've seen more than doubling of the amount of people hired within these sectors, and the government incentives go up with that. And now we have the government even further supporting it with diluted money. So you have the National Reconstruction Fund, you have Breakthrough Victoria in Victoria, Invest Vic, all supporting innovative companies, and they have a big sleeve for healthcare. So what does the future hold? One thing that I think generalists don't appreciate as much as, I guess, people that have worked in the biotech industry is that big pharma don't really do their, I mean, they do some of their own innovation, but the vast majority of the innovation that gets done, all the life-saving drugs that go into patients' arms, are done by small companies all around the world, mostly Australia and mostly US, some in Australia. And when you look at that pie chart, you can see that only 28% of the drugs that were blockbusters were developed by Big Pharma. Everything else was acquired. And Steve talked about dry powder or spare capacity in the market. Big Pharma now have more capacity, cash and available debt to acquire every single medium and small cap pharma in the world. So they've never had more dry powder today than they've had in the past. So we've seen a pause in M&A activity over 2020, 2021. We saw it recovering in 2024. And then kind of abruptly stopped with the regulatory uncertainty, but Big Pharma need to acquire. Their products are on a patent clock, right? So they buy a drug, they launch the drug, 10, 15, 20 years, that drug goes off patent and the revenue goes to zero. So they need to constantly replenish that pipeline, which is why we're always looking to Big Pharma as a potential exit. The IPO window is still largely shut. 2024, we saw kind of a slight creak opening of the IPO window. The best IPO to date has been CG Oncology, which has traded many multiples up from its IPO price. But unfortunately, that's kind of firmly shut in the last couple of months. But I mean, I always tell people, unless you believe that people are never going to get sick again, there's going to be a healthcare market and the IPO window will open. So what am I excited about in Australia in the near future? So we published an article recently in Livewire saying that Australian biotech is no longer just CSL. So when I started my career in the investment side 5 years ago, there was only just CSL as a profitable biotech company in Australia. There was no other ones. Fast forward to today, we've got Telix and Neuron. Fast forward maybe another year, and then so we have a couple more medtechs. Fast forward a year in the future, EBR Systems might have their FDA approval and might be a very profitable medtech company. We've got Polynovo, we've got Avida. None of those companies were profitable 5 years ago. So we're seeing rapid growth in a very short period of time in Australia. And I think that the next 5 years, independent of what the market will do, will be just as exciting. Thank you.
Thank you, Hashan, for the insightful keynote. Now we turn our attention to our company presentations, beginning with Prime Financial. To present, we have its Managing Director and CEO and the Chairman, Simon Matter. Simon, the stage is yours.
So firstly, thanks so much for attending today, and a big shout out to Steve for putting such a massive event together. Steve mentioned as part of the introductions that we operate as an advice business within this space, and these innovative businesses that are all coming to market and developing are our core audience. We're seeking to deliver services to those businesses and also try to deliver to them access to capital. So what I'm going to talk about today is really that intersection of advice, capital, and asset management. So as a business in this space that was founded 26 years ago, we're very much focused on working with founders and founder-led businesses that have great ideas that need access to advice and capital. Our business was co-founded between my father and myself, as I said, 26 years ago, with a very simple philosophy. It was all about providing a combined advice experience for our clients. So our clients today are very much emerging businesses, founders, high net worth investors, and also family offices. We very much believe, very optimistic in uncapped opportunities, and we see this every day with the clients that we're working with as businesses, but also how our investors think about the future as well. So today we're a business with $1.3 billion of funds under management. Our business started as a wealth management business 26 years ago. We've got over 200 team members that are based here in Australia, but also overseas as well. And there are 4 key service lines that we focus on delivering for our customers: accounting, business advisory, wealth management. We're in the SMSF space as well, and importantly, corporate finance, which is a real key to what we do. This is how we think about our business, and particularly over the last 5 to 7 years, we've been on a very strong growth trajectory. We want to double our business every 2 to 3 years. Back in FY22, when we had 26 million of revenue, we set ourselves a goal to double that to 50 million by FY25, and we will hit that this year. We were then seeking to double our business again by FY28 to FY30 to $100 million, and we believe we've got the capability to do that and the pipeline of acquisition opportunities, but also organic growth. I think the key as to why we really understand our clients well is because we are a founder-led business. We understand all the grind and the grit that is required to actually build a business from nothing. So when we come to the advice piece, we come from a place of lived experience. And that's something that we're very proud of. And it's not just about our business being founder-led, but the fact that we've got over 20 founders that work in our business seeking to deliver advice to our clients and find the next best opportunity to invest in. The other key part about how we think about tying everyone to the future is this concept of employee ownership, team ownership in the business. So of the 189 team members that we have, half of them now have equity in the business. 48% of our business is owned by our team. We absolutely want to align with our team and make sure that they are participating in the value of the business that they're trying to help co-create for the future. So based on all of this, we think, I think pretty dynamically about what we can do for our clients and the next best investment opportunity for high net worth investors. So to give you a bit of perspective as to who our clients have been over the last 26 years, I think this slide represents it pretty well. There's over 5,000 clients that we've advised for wealth management and SMSF. There's over 2,000 businesses that we've been engaged with, and obviously a lot of them still today. There's 1,000 of our clients who have helped access R&D grants. It was interesting to hear that spoken about just before. This is a fascinating part of what we do. But the fact that you can actually access this through R&D tax incentives and help fund the capital that you require for new development and products, that's a key part of what we've been able to do for our clients over the journey. There's over 100 SMEs that we have invested in, either providing equity or credit through our alternative asset funds management division, and 500 clients that we're actively working with on growth, transition and succession. And some of those sort of themes that Steve was talking to at the start, we couldn't agree more in terms of those 3 key areas, and I'll talk a little bit about that in a moment. And finally, this for us isn't just about the services that we deliver directly to our clients and the opportunities that we find, but we work with over 250 other professional services firms to help them deliver their version of what they see as a connected advice experience. So we think we play a pretty important role in terms of empowering aspiration and driving growth within this sector. I'm not going to go through all this slide, there's a bit of information here, but quite simply, as a business, we think about it in 2 key areas: the business segment and the wealth segment. Our business segment makes up about 50% of our revenue and about 50% of our team, and the wealth segment makes up a similar amount. Importantly, in terms of how we're structured, we have 34 team members now, I have to keep checking because it tends to grow every now and then, that are working as part of our Centre of Excellence around driving business growth. That could be M&A, operations, IT, finance, HR. So as we've become more acquisitive of late, and we've acquired 3 different businesses in the last 2 years, it's been important to make sure that you integrate deeply and are then able to make sure that you offer the services that they have to that larger collective audience. And I think this is the best way to look at our business. We are absolutely trying to combine what we do for businesses and also in that wealth management investment space. Clients will come into our business for one of those things that are highlighted around the outside, and then what we seek to do through our One Connected model is to make sure that they get access to everything we can do so we are fully empowering their aspirations and what they're seeking to achieve. We think this is quite unique. There's probably not that many companies of the size that we are that could do this much for their customers. So I'll just quickly touch on our results that we released last week. And the team have done a fantastic effort again. And you'll see some of the continuum in terms of our growth. But revenue was up 25% to almost $23 million. Our reported EBITDA was up over 100%, underlying EBITDA up 8%. Our margin was slightly down at 18% versus typically 21% in the first half. We pay a dividend. We pay at about 60% of what we earn, and that was up 3%. And our reported EPS was also up as well. Some of the key highlights has been around what we've been doing from an acquisition point of view recently. So we've always had sort of 8 to 10% plus organic growth, but we're now turbocharging this by virtue of some of the acquisitions that are very complementary to what we're seeking to do for our clients and the investment opportunities that we want to provide. So around about 12 months ago, we acquired a business called Untitled Capital, who are actually featured outside, and they're an alternative asset fund manager. They've been in the private credit space, they've also been in private equity, and in the past also property as well. But this business that we acquired, because it connected in so well with what we were seeking to do, it actually achieved its 3-year target earn-out in the first 12 months. So it's an absolute testament to that team that came into the broader Prime Group, but also how we were set up to absorb that opportunity and make the most of it. This philosophy around one connected services for our clients will continue on. We think it is genuinely different, and we are expecting to continue to have a strong second half for a full year result that we expect will be up 15 to 20% on the previous year at both a revenue and earnings level, and to see our dividends up 3 to 5% for the full year. Just on this side here, you can see the growth in the two segments. In the past, we would have been rapt to have 10, 12, 14% growth in just one division, but the fact that we were able to have such a significant level of growth within our wealth segment was an impressive result by the team. This just gives you a little bit of a feel for how this plays out in terms of our business over the last 5 years. I won't dive into a huge amount of detail other than to say the benefit of our business is that we actually do have around about 70% of our revenue is recurring. That will continue to build to 75 and 80% over time. But what you're seeing there is that pretty much every division that we've got, whether it's wealth, SMSF, accounting and business advisory, or in fact capital, has been growing over the last 5 years. And I'll touch on this in a little bit more detail in a second, but we are in the right markets, and I believe the comprehensive nature of what we do for our clients means they keep coming back for more and more things. So the organic growth piece is sometimes easier to achieve because you are cross-delivering more services to your customer. This is our dividend slide. As I've highlighted, that's part of what we do in terms of the 60% payout ratio, and that has been increasing. So in terms of the strategy and the outlook for our firm, and I'll dive into some of the investment ideas that we're focused on, we keep it pretty simple. Prime place to be. We want the best talent in the marketplace. We want them to own equity in the business that they're helping to develop, and we're actively targeting to bring them into our ecosystem. So have a fantastic firm that people want to come to, where they can develop. We want to compel the client to do more things with us. We don't want to give the client a reason to go outside our four walls. That's part of our competitive advantage. We want to keep on simplifying what we do. As we get bigger, we've got to make sure that we still focus on what are the core needs of our clients and make sure we do more of that. And obviously the final point is wanting to grow our revenue streams and our earnings. So just to jump into a few of the themes that we think are really important and what's driving our business is around the needs of these audiences here. So this is a fantastic report that was produced by Praemium actually quite recently released. And although it doesn't feel like it every day, cost of living crisis, etc., Australians are getting more wealthy, particularly those that have between $1 and $70 million of investable funds. You'll see there that over the last 12 months, the number of people that fit that cohort have gone from 635,000 to 690,000 people. They now control 3.4 trillion of assets, up from 3 trillion previously. And this is just the growth in the last 12 months. And we talked about it, or Steve highlighted at the start, succession and this great wealth transfer is the biggest thing that we're going to see, I think, over the next 5 to 10 years. And people are not prepared for it. Whether they're people that have portfolios now that might be shares, bonds, etc., or hard property assets, but their business as well. People are not preparing for what they need to do with their business. So we think there's an immediate need to address that for our clients, but there's also an investment opportunity on the other side, because the next generation aren't as excited as parents might hope they might be to take on the business that mum and dad were running for X number of years. The other key thing that we look at here is we are still a well and truly under-advised market here in Australia. Just have a look at that middle part of that table on the right-hand side there, the unmet advice needs. They're material. And I think part of this is because people don't know where to go to get that advice. And quite often, advisory firms are very siloed in what they do. They just focus on one piece. So that's why we're trying to bring this together to give a more comprehensive solution. I won't touch on this in any more detail other than to say we're very aspirational. Aspire, innovate, grow and impact are our taglines, and we live that every single day. So the outlook for our firm, again, just confirming, we're seeking to grow our revenue and our earnings by 15 to 20% this year, see our dividends increase, and it's about continuing to do what we do well, deeply integrate, identify great acquisitions with great people that are highly aspirational. They're not looking for succession plans, they're looking to join a group that can do more for their clients and make a bigger impact. So that's fine, that's the prime story. That's where we fit in the ecosystem in terms of advice, capital and asset management. Now I'm quickly going to pick out just a few things that we're thinking about from an investment point of view and things that we're seeing. I've touched on this already, but this great wealth transfer and this under-advised area, there's a really significant opportunity in the advice space to help people think about this transfer of over $1.9 trillion of assets that need to be bequeathed to family beneficiaries. This business segment, you can't actually absorb the number of businesses that will come to market over the next 5 to 10 years. The volume will be more than what investors can actually cope with. And even the funds management industry isn't set up to deliver solutions to these size of businesses. So the problem here is, where's the advice coming from? Who's giving it? Who's shouting from the rooftops, come and see me, we can help you with this? And I guess that's part of what Prime's purpose is. So I guess the final opportunity there really from an advice perspective is to be proactive, to start conversations now, to make sure the families are talking about this and getting it on the radar so that we can plan for the future. In this alternatives bucket theme, which everyone will define probably slightly differently, there's three things that we're looking at that we think are, some are a little bit different, some not so different. But this SME investment across equity and credit, where we've invested in over 100 businesses over the last 5 to 7 years through our alternative asset management division, LTOR, we think this is a material opportunity. And I'll touch on that in a little bit more detail, but the number of businesses that are currently making $1 to $4 million of EBITDA plus, great businesses with fantastic cash flow and recurring revenue. I know it's more glamorous to be in a startup and VC, I totally get that. But these are established businesses with great cash flow that are a fantastic opportunity for someone, even if it's not the next generation within the family. This next one, I'm pretty certain that maybe only one other person will cover today, but the business of investing in sports, media and entertainment. And I'll touch on a transaction we completed over the weekend. But this is an emerging area here in Australia. It's well defined and well invested in the US and Europe, and the returns that have been achieved in this space have outpaced quite a few, definitely private equity. And I'll talk a little bit more detail about what we're seeing there. And housing and property, I think we all know that theme, and Australians love investing in property, but I'll just quickly touch on one key area that we're looking at. So this business of sports, entertainment and media. On the weekend, our funds management division actually acquired an NBL team the Tasmania Jack Jumpers, a very successful team that was established around about 5 years ago that actually won a championship within that first 5-year period of time. This is a business that is profitable, that has a fantastically committed fan base. And what we're seeing at the moment now is that owning sporting clubs and a whole host of things that are involved within this sports space is no longer just the domain of billionaires who have some spare change. We're seeing this as a real investment class where we can differentiate what we're doing and offer this to wholesale investors. And one of the key themes that we're seeing playing out at the moment is that valuations here in the Asia-Pacific region are vastly lower than what you would see in Europe, the US and various other places. So it's presenting a genuine opportunity. You're seeing now that overseas investors are now pushing into Australia to take advantage of that. And I don't believe, and I'm happy to stand corrected, that there's any other investment banks or funds management or advisory firms that actually have a dedicated sports, entertainment and media arm to what they do. So we're quite differentiated. There's pretty much not a deal that is playing out in this space, particularly sports, that we haven't had a look at or been able to see. So we've got pretty exclusive deal flow here, and we see that as a great opportunity for our investors. Just finally at the bottom there, there's some of the areas that we've actually been advising or investing in the recent past. So obviously basketball, which you can see, cricket, both rugby codes, motorsport, which is a fascinating area in itself, and as I said, sports and entertainment tech. This isn't just about clubs. This is about the whole ecosystem and how you can play to different parts of this theme. So housing and property, I'm not going to dive into a huge amount of detail because I am conscious of time. But there's no doubt that Australians love investing in this area. I don't think there's ever been more diverse ways to actually invest in this space. The non-bank space is in its infancy. So on the credit side, there's plenty of opportunities. And essentially within this housing and property space, we've undertaken about 30 transactions in the last 2 years. So we appreciate it, we understand it, we know that our clients like investing in it. And there's one area that I guess if I could just touch on before I finish up, that we particularly like, it's around this NDIS space. Whether it's the development of a specific facility for particular people with needs, or whether, and that's a development opportunity and a development profit that comes with that, or owning that asset and receiving an ongoing income stream, we're equally favourable towards both of those areas. And we've originated quite a few transactions in this space. So to close today, from my point of view, we are absolutely operating at the intersection of everything that's happening from an advice, capital and funds management point of view, particularly around alternative assets. We want to deliver that comprehensive service for business owners and provide that next unique investment opportunity for investors, wholesale investors. We see this as a growing opportunity for us as a firm, and that's why we've been building and delivering some pretty decent results for our clients, but also for our own shareholders. And the market that we play in is just going to get bigger. There are some significant needs that need to be addressed, and we believe we're best positioned to do that in a very comprehensive and connected way. That's pretty much me done. I again really want to thank Steve and the Wholesale Investor Network for having us participate in today. We couldn't be a bigger believer in what is being done here, and we're really glad to participate in it. Thank you for your attendance.
So it's very rare that you get to work with a speaker that's actually gone and listed a company on the NASDAQ and not just gone and actually built a business and then listed it for a multi-billion-dollar amount. But that's exactly what our next speaker has done, Evan Thornley. He's actually a perfect example of a technology founder actually bringing a property business. And when I first sat down with him in November last year, I thought it was one of the most creative models that I've seen that's really been taking a unique approach to property. So on that note, I want to give a special introduction and a welcome to our next speaker, Mr. Evan Thornley.
Good morning. There's a whole lot of really interesting stuff at this conference. There's crypto, there's a whole bunch of venture and all sorts of really interesting stuff. But I wanted to start you with a cautionary tale and explain why I'm here to talk about none of those things, although I'm probably well qualified to do so. So, the less good-looking person up there, you know, this is show business for ugly people, is yours truly after we listed the first Australian tech company on NASDAQ, took it to a $14 billion market cap, which was proper money in those days, and put me on the top of the young rich list. And I don't claim it was anywhere near as good a company as Scott or Mel or others have built, but, you know, we pioneered some stuff. And that wasn't bad for a kid who grew up in a single-parent family on welfare and is 15 centimetres shorter than his dad because he didn't have enough to eat. So at age 36, I was suddenly accosted by the nice people at the Goldman ultra high net worth desk. And they took me in to tell me the secrets of how to keep my money and invest it wisely. And I thought, this is great. I'm going to get access to all the hot IPOs. I'm going to get all these secret private equity funds that normal schleppers can't get to and all that sort of stuff. And that was all true. But actually they sat me down and said, son, let me tell you about portfolio allocation. The asset classes you choose to invest in are more important than the individual assets. And they took me through and they said, look, for most of our clients, if they can compound their wealth at 15% per annum, year in, year out, they've actually done really well. Many of them will end up at about 12. If you haven't managed your portfolio so well, you end up at about 10. And how do they do that? They have a risk portfolio that goes from cash and government bonds through to venture and crazy shit, right? But in the right proportions. And so I listened and nodded wisely, but because I was a lot smarter than them, I decided to keep investing in tech along with my mates. And so I invested in a Mayor's IPO fund that invested in all the hot IPOs before they were hot, because they made 100% on their money in 6 months in our deal, so I thought I'd do the same. It's a thing called Amarindo. I think I got 9 cents in the dollar back. I came home, the good folks at Macquarie, and I love Macquarie, and they backlisted us on the ASX and did a whole bunch of things. It's a great firm, but in this particular case, somebody came and sold me a leverage on leverage corporate bonds deal. And I'm like, look, I don't really understand this, but isn't leverage on leverage a bit risky? It's like, mate, look at all this history, it's all going to be apples. Which it was, right, until the GFC came along. Then a good mate of mine made an absolute poultice of dough on the Coinbase IPO, got in the C round, rode it all the way up to the whole crypto wave to the Coinbase IPO, made, you know, 9-figure sum. And we went down to my place in the hills to have a yak, and he said, tell me about how I should not stuff this up. And I tried to give him the Goldman lesson, he ignored me, and he regrets it now. So that's a long cautionary tale, but I guess what I'm trying to say is risk is cool, risk makes you rich until it doesn't. And then risk bites you in the arse, and it's a real pain. So I'm not saying don't invest in all those sexy things. Mate, if you want to put 2% of your portfolio into crypto, knock yourself out. You'd be much smarter than me if you can figure out whether it's going to go up or down, whether you're a believer now or not, I don't know. If you want to put 5 or 10% of your portfolio in venture, sure, and PE. But I think the real challenge is what's the missing middle in your portfolio, because you're going to have some cash, right? And you're going to have some fixed income and other things. But where do you get that risk-return balance where the guts of your portfolio is going to perform sensibly with relatively low risk and perhaps some uncovered upside? So having learned a few hard lessons, I decided to try and understand why most people who made money in this country then put it into property. And how could you do that effectively? And I couldn't really understand it, and I didn't really understand how leverage worked, a whole bunch of things. But anyway, for the last 10 years, my business partner, Anthony Cohen, and I have been slowly building a platform that does understand how that works. And I want to take you through it very quickly. I'll have a bit more time tomorrow to take you through in more depth. So, just to be clear, you all know, you will have seen these stats, there's $11 trillion in the residential property space in this country. But the weird thing is this: if you want to invest in an investment grade fund, in parts of that asset class, you are spoilt for choice. If you want to invest in new property development, which is 3%, every layer of the capital stack is available to you. You know, from equity in the Stocklands and Mirvacs through to, mezz finance, private credit, the whole deal. We can talk about the risk return on all those things, but that's 3% of the asset class, and that's really a manufacturing business. If you can sell a dwelling at a sufficient margin over what you cost to build it, you've made profit, and that's fine. That's 3% of the asset class. The biggest industry in this country, by the length of the straight, is 22% of this asset class. It's called mortgage. And whether you want to invest in equity in the big four banks, right up through Peppers, mezz notes, or anything else, again, there's investment grade funds in every layer of the capital stack. So that just leaves a little tiny corner, the remaining $8 trillion, which is equity in existing homes. And there's not a single investment grade fund to invest in that. The only way you can invest in that, as almost all of us do, is either through the home we buy to live in or as a landlord of, some number of investment properties. So we started there. We built LongView 10 years ago and we said, let's understand how people invest in residential property. We're now the top ranked rental property manager in the country. We manage 4,000 rental properties. We fix broken dunnies. We manage tenant arrears. We do all of that stuff. We do it better than anyone else in the country out of 47,000 licensed real estates. And I can tell you with absolute certainty as a consequence that being a landlord is a shitty way to invest in this asset class. And many of you are nodding your heads because you know that. It's hard to get diversification. There's all sorts of hidden costs and challenges. Particularly if you live as I do in the People's Republic of Victoria, you're now getting eaten alive by 265 basis points of land tax before you get off first base. There's just a whole lot of reasons why it's hard, actually, to make money as a landlord. And no one knows that better than us because we are closer to more Australian landlords than anyone else around. So Anthony and I, for the last 4 years, have said, OK, how do you really invest in this asset class? And let's think about it. The word landlord, let's be honest, that is actually a medieval word, OK? Like, investing as a landlord in resi property hasn't changed a lot in 1,000 years. You own a piece of land, probably with a dwelling on it, somebody hopefully pays your rent, and hopefully some combination of the rent and the increase in value is what you do. Okay. There's probably a better way. There's probably a way to build an investment grade fund in this asset class that is at least late 20th century, if not quarter of the way through the 21st century. So those of us who lived in Silicon Valley for a while and cut our teeth at McKinsey have applied ourselves to this problem. Let's start right here. I want to be really clear. There's lots of interesting ways that wealth is created in our economy and everywhere else. The single biggest source of wealth in our economy, by the length of the straight, is capital growth on existing Australian homes. The capital growth on Australian residential property this year, and pretty much every other year, just the capital growth, not the underlying value, is the same size as the entire federal government budget. Federal government budget last year was $680 billion. Capital growth on Australian resi property last year was $630 billion. That wasn't such a good year. In the last rolling 12 months, it's actually $800 billion. So depending on whether you want to take the 630 or the 800, that is either 4 or 5 times all the earnings of every company listed on the ASX combined. So by the length of the straight, the biggest wealth engine in this country is capital growth on Australian residential property. Why is that? Well, you'll hear a whole lot of nonsense from a whole lot of people who should know better that say it's all about negative gearing tax policies and it's all about supply-demand imbalances and we're at the end of a 30-year secular decline in interest rates. Well, until we weren't, and funnily enough, property kept going. But actually the answer is devastatingly simple, and PEXA and LongView published a white paper to explain this with 100 years of history. We have the second highest population growth rate in the world, have had since before any of us were born, and we uniquely concentrate a disproportionate share of that population growth into just 3 urban centres, Sydney, Melbourne and Brisbane, and as a consequence, the value of well-located land in the suburbs of Sydney and Melbourne and Brisbane has been doubling every 8 years for 100 years. And unless something changes, that process will continue because, as Mark Twain said, they're not making any more of it. So more than 100% of that capital growth is the increase in the value of the land underneath the homes. Land appreciates, buildings depreciate. So the biggest wealth driver in this country by the length of the straight, and one of the most stable, that in 100 years has never had a peak to trough decline of more than 12%, right? And that was over a leisurely 2-year period, and it made it all up in the third year. And that was the most volatility you've ever seen in this sector, right? Is the land underneath Australia's suburban homes, good homes, quality family homes, the homes that you all live in, which is why in most cases you've doubled your money in the last 10 years and the 10 years before that. Okay, so let's invest in that as an asset class, because if risk is cool until it kicks you in the arse, then this feels like a different quadrant that might be more attractive. Okay, how do we invest in these assets? Well, you'd like to have a diversified portfolio, because like that would be common sense across all of those markets, across different price points and different geographies. And you'd like to be invested in the assets that are better quality than others, because funnily enough, in $11 trillion worth of assets, some are better than others. So, this is where the Silicon Valley McKinsey part comes back into the story, beyond the medieval part. We put a data science team together. We analysed every sale price of every residential property in Australia for 50 years. We have professional buying advisors who've literally bought 1,000 homes each in the last 20 years, and we combined that art and science, and I don't have time to tell you now all the details, but let me tell you this. 1/6 of the homes in Australia generate half the capital growth. Just your usual kind of 80-20. And those are what we call, and I've trademarked this by the way, the Rodwells of Sydney, Melbourne and Brisbane. You live in many of them. Robust, older dwellings on well-located land. Okay, it's not that complicated. Now, believe me, when we get down to the individual asset selection of each individual property, we get right in every detail of that property and everything about it and everything the data science tells us. But at the end of the day, land appreciates, buildings depreciate. If you invest in quality family homes where 3/4 or more of the value of that home is actually the value of the land underneath the home, that's how you get exposure to this engine. If you do that in a diversified way, you've got exposure to a stable, high-growth asset class at remarkably low risk. Because what's your risk? You're sitting here watching grass grow in dirt disguised as houses, right? That's what we invest in. So that's the asset class. So the first part of the Silicon Valleyisation of this traditional, some would say medieval asset class, is just to do some proper data science, combine that with genuine deep field expertise. Anyone who's been in property knows you've actually got to be out in the ground to really understand each property is different. You combine those two things, you can invest in a diversified portfolio of high quality assets that are going to have very stable, predictable growth for a long time. That's the beginning of the missing middle of your portfolio. That's got such a low risk stack, to be honest, that you would probably expect to be getting mid to high single digit returns without leverage. But we're looking to deliver twice that. How do we do that? Well, that gets to the second part of this. Is kind of the McKinsey part. That was the Silicon Valley part. We invest in those assets in a different way. We don't buy homes to rent them out to people. We co-invest with homeowners in their principal places of residence. And we do that for 2 reasons. Well, 3 really. Firstly, on average, they're much better quality assets, right? Almost every landlord I've ever talked to has made a better return on investment on the home they bought for lifestyle reasons than on the investment property they thought they were buying to make money, because funnily enough, better quality assets generate better quality returns. So you'd much prefer to be in those assets. Okay, why are we investing with homeowners? Well, we wanted to get, and I'll say this slowly so it sinks in, leverage without debt and land without land tax. If I can invest in these assets, these high quality, professionally selected assets, and I can get leverage without debt and land without land tax, then I can get 14% returns instead of 7 or 8. Whilst actually reducing the risk, because I don't have the leverage risk and I've got a diversified portfolio. So it's taken us 4 years to build this platform, but that's what we do. So my offer to the homeowner is this. Most Australians either have too little home equity, unfortunately the next generation, or they have too much. Because the capital growth has built their wealth so much, a disproportionate share of their wealth is tied up in the home underneath them. And in many of those people's lives, particularly 45 to 59-year-olds, they have some other uses for the money they'd like to deploy. Whether they're investing in their small business and growing it fast, whether they want to make some renovations to their home, whether they want to be the banker mum and dad to their kids, whether sadly, they're going through a divorce and too much of the marital asset pool is in the family home and one partner's hoping to stay in that home with the kids and have least disruption as possible but needs to pay out the other. There's a whole range of reasons why people need access to their home equity. So we offer them access to that home equity on remarkably friendly terms. We're not a lender, we're an equity co-investor. We want to participate in the upside of these homes. We only invest in 12% of the assets we see, and they're the ones we are just about certain are going to have terrific capital growth. So my offer to them is this: I will write you an equity cheque for 10% of the value of the home, and what I want from you in return is a disproportionate share of something you don't yet own, the future capital growth in your home, money you don't yet have. That's it. So a 10% equity share in the home in exchange for 1/3 of the future capital growth. Let's think about that. That means I've got 3.3 times leverage on the underlying growth rate. And if the average in the detached dwelling sector since before any of us were born is 7% compound per annum, and we're investing in the top half of that asset class, then the underlying growth rate's going to be in the high single digits, and we got 3.3x leverage on that with no debt. I'm not borrowing any money from anybody. I have no interest payments. I can't be shut down, I have no negative cash flows. So we've got leverage without debt of 3.3x on really high quality assets. And this is the principal place of residence of the homeowner, and if you build this structure the right way, ain't no one's paying any land tax. So I've got land intensive, high quality residential properties with no land tax and with leverage without debt. That's how I have a lower risk stack than I would have as an actual landlord and yet make a higher return. In fact, if you were good enough at asset selection and you bought the exact same properties that we're buying, the whole lot, the first 100 million worth that we've co-invested in, if you bought them as a landlord, those exact same homes, you would make 400 basis points less return than we will on the exact same assets, because you'll have leverage, because you'll have land tax, because you'll have all the costs and risks and hassles of being a landlord. So literally on the same assets. So this is what we've developed, understanding how hard it is to be a successful landlord. Not that many people got $100 million to buy 60 quality homes in Sydney, Melbourne and Brisbane, by the way, so we also have much more diversification. So that's our mechanism. This is the LongView Home Equity Fund as it's developing. We've got the first 64 properties in there. They are worth on average about $1.8 million, so we're invested in 64 quality family homes across Sydney, Melbourne and Brisbane. They're not fancy. There are no gag in our kitchens, okay? These are just quality family homes, Rodwells in places that matter, from $1 to $6 million in value. 78% of the value of these homes is actually the dirt underneath the home. That's the part that's going to go up. And we own a 36% share in that capital growth. So that $100 million worth of houses is going to be worth $200 million all day long. 10 years from now, we'll get 1/3 of that capital growth for 1/10 of the value. So that's the LongView Home Equity Fund. It sounds too good to be true, but I've got really bad news. I thought we were unbelievably smart, I'll be honest. Haven't put years into doing this until we discovered that a bunch of people in the US have already been doing it for a decade. We didn't know about that, we do now. We didn't copy them, we didn't know they existed, but there's a home equity investment sector in the US. There's 3 or 4 unicorns with 10,000 plus houses, multi-billion-dollar books. They've been delivering 17 to 19% returns to their investors. They're securitizing the back end of the books. This is already a thing. So the bad news is we're not as smart as we thought we were. The good news is actually this has been done before, and this is a much better capital growth market than the US. So if you're going to do this strategy anywhere in the world, you do it in the country with the second highest population growth rate and the highest level of urban concentration impacting land value. So that's what we do. Look forward to meeting you. This is, I think, the missing middle for your portfolio. You want to be in property, you want to be in land, you want to be diversified, but you don't want all that risk. You know, I got money in private credit and a whole bunch of other things. Compare the risk stack of this to that, right? I got no construction risk, I got no financing risk, I got no weather risk, no CFMEU. I'm watching grass grow, right? I'm not getting up at 3 in the morning to find out what happened in New York. I'm watching grass grow. Dirt disguised as houses with a clever mechanism to increase returns whilst diversifying risk. Thanks very much.
Thank you very much, Evan. Now we have an exciting keynote session, Meet the Startup Nerds and Discover the 5 Ventures Shaping Tomorrow. Let's give a big round of applause to the Startup Nerds CEO and the co-founder, Ashley Law-Smith, and co-founder and expert nerd, Mike Mobilia.
Is this the button? Just press play. Good morning, everyone. It'll just be me today. My co-founder Mike's sitting over there. You can't miss him in the yellow, so have a chat to him after this and the break. So my name is Ash, one of the founders of the Startup Nerds, and we're on a mission to help businesses succeed. We've got something incredibly exciting for you today. We're bringing 5 startups to the stage who'll come up after my presentation and introduce their ideas to you. They hope to increase awareness of their brand, to unlock opportunities for growth by having those right conversations, and also to raise capital. Before I introduce them to you, I will tell you a bit more about our point of difference. So my co-founder and I started in 2022 offering a startup ecosystem of services tailored towards helping them succeed. And we stumbled across a business that had struggled to raise capital for the best part of 18 months. It looked really interesting, so we took a look into it. And what we found was the business had all the bells and whistles we felt an investor would be interested in. It had great market opportunity, incredible founders, a track record of execution, and was in disruptive tech. And so even with all of these bells and whistles, it still struggled to find capital. So we took a look into the investor strategy, and what we found was it was not the business that was the issue, it was the way it was being positioned. And so we worked alongside those founders and tweaked a couple of things. We didn't change the business model, but what we did was unlocked exactly what was underneath and always there. The outcome of this was the business was successfully funded in a seed round and is now on its way to generating $2 million of ARR just 6 months post-funding. An opportunity that would have been lost if it was not successful with its capital raise, and not only for the investors like you, but for the Australian economy. And so we work alongside founders, or the moral of the story is, great opportunities don't often go unnoticed because they lack potential, but because they aren't positioned effectively. And that is essentially what we do with our capital raising assistance. We help the founders to unlock their true potential. Now, before I introduce the startups to you, a bit of housekeeping on how to get in contact with us. So, a couple of ways. You can scan the QR code on the screen and fill in your details. We've also got some flyers and business cards flying around in the exhibition hall. We do have a trade stand, will be available today and tomorrow, so come chat to us, we'd love to hear from you. And then all of the opportunities here today will be available on Capital HQ. Now, without further ado, I'd like to introduce to you the first startup to take the stand, and please welcome the founder, Ahmed Salim, all the way from Western Australia, where he'll chat to you about Podyssey. Thank you.
Thanks, Ash. So my name is Ahmad. I am the co-founder and CEO of Podyssey. But prior to starting Podyssey, I used to work as a geologist, and a large part of my role was travel. I traveled a lot. For about a 10-year period, I averaged 330 days on the road. So 11 months of the year I was on the road. And travel is great. You know, you get to do a lot of cool things, get to see a lot of cool places. But the part that sucks about travel is all the downtime that you have, all the time that you spend sitting on planes, sitting in airports, sitting in cars, going to airports in traffic, all of that stuff. And you need a way to kind of use up that time. And my companion during that time was listening to podcasts. So I listen to a lot of podcasts, If there's name a podcast, and I'll probably listen to it at some point. And hey, let me just move on. And so podcasts are great because they've been this really exponentially growing kind of medium So you're never lost for choice. Yeah, there's like, you can look at the numbers on the board. There's 6 billion minutes of content on podcasts, and every year it grows exponentially. Yeah, every year there's about 250,000 new podcasts that come out every year. And so as this content has grown more and more, as a user, it's great, but it's created this problem where the discoverability of that content is getting harder and harder. So if I want to find new content, or even say I want to go back and rediscover the content that I already listened to, that's becoming harder and harder. And I'll give you an example, like, say I listen to a podcast, it's usually an hour long, some are several hours long, and in there they had a 10-minute clip where they talked about, say they told me a piece of trivia about Roger Federer, the tennis player. Now, if I wanted to go find that content again, the only way you can currently do it is you'd have to go search the podcast title. It's highly unlikely that they're going to name the podcast after the trivia piece of Roger Federer. Or the episode title, again, highly unlikely that you could find it using that. Or you could use the show notes. And that you can find things using show notes, but not every podcaster puts show notes. I was a podcaster and I never put any show notes on any of my episodes. So how do you find this content? And what I found as a podcast listener was, at one point, was, how come there's not a Google for podcasts? Like, how couldn't I just go into a search engine and just type that little piece that I wanted to find, and it would just go find me that content or that little clip that I could just listen to? How come that doesn't exist? Imagine you had to search websites, but all you could search for was just the address of the website. Like, that would be a really dumb way of searching. And so one thing I thought of is, like, maybe this is just a me problem, right? Maybe I'm the only one that has this problem. Maybe the market doesn't have this problem. And then you go look at the market of podcasts, and it's huge. So there are about 500 million active weekly podcast listeners. And this market is growing exponentially. The value of that market is growing as well. I mean, if you really think about what the value of podcasts is, the current US election kind of showed that, or how important they become as a source of media for a lot of people. So this wasn't a me problem. Maybe this was a we problem. Maybe there were other people, 500 million people that had the same problem as well. And so I was asked the question, why wasn't there a Google for podcasts? So I decided to build one, and that's Podyssey. Podyssey is effectively a search engine that allows you to search all the podcast content. So aside from just titles, it will search through the whole episode for any content that you want. And the way it does it is that we take an episode, say an hour-long episode, and then we break it into, using natural language processing and a few other AI tools, we break it up into the topics that people are talking about, and we create those into small clips. And then we tag them by those topics, and we tag them by who's talking as well. So now you can search through any podcast episode by the what, so what people are talking about, and the who, or who's talking at that same time. So now if I wanted to find that same clip about Roger Federer, all I have to search is trivia about Roger Federer, and if I remembered who was talking, I could just search for them, and it would go give me that clip. But then it would also give me all the other clips and all the other podcasts and episodes where they've talked about Roger Federer. And I could create a whole podcast, essentially, curate my own content about Roger Federer on all the podcasts that have occurred. And so we built this app. Let me just go back. So we built this app. It's out there now. It's live. And we built it for listeners as well as content creators. So if you're a listener and you want to find content, you go on the app and do it. You can use it free, or you can pay a subscription, and you can get a lot of other features. And the same as a content creator. And this is probably one of the first platforms that allows content creators to do this as well. So if you create your own podcast, you can put that content on our platform. We'll separate it into small clips, and you can go and then use it for social media marketing or whatever else you want to do to kind of increase your listener base. So as I mentioned, we're an app. We're already in the market. We started at the start of this year. Currently, we're the only app that allows this functionality. We're pre-revenue, so most of our users are all still free, but at some point we'll start charging them. And so we completed a pre-seed round, and we've got pretty good feedback from VCs, mostly overseas. So we'll extend this round and we'll raise a bit more capital. And what we want to do with that capital is basically grow not just our team, but the app to aim to get to 1 million users, and also build more features out into it. Now, the obvious question that you should ask if you are a podcast listener is, how come Spotify doesn't do this, right? And that's a really good question, and I'd love to answer it, but I'm out of time. So if you'd like to come to the booth, the Startup Nerds booth, I will happily answer that question for you. Thanks a lot for listening to me. Cheers.
Thanks very much, Ahmad. That's very interesting, and I'm an avid podcaster myself. The next startup to take the stage is a female founder, which is very exciting. They are looking to revolutionize the way we troubleshoot using our IT applications using AI. Please welcome Inshu Mishra from Builure.
Good morning, everyone. Sorry. Yeah. Good day, everyone. Thank you for giving us your time to listen to us. And I am Inshu Mishra, founder and co-founder and CEO of Builure. Builure is an acronym for Build Your Future. Future that we've all been talking about has long been lurking at the door, which is now standing right in front of us. AI. Everyone is talking about AI. But what are we going to do with AI in our respective industries? That is the question. So we at Builure, we at Builure are bridging the cloud skills gap by AI-driven expertise for maximizing the cloud ROI. The next question is, why? Why are we going to do this? So let me tell you an example from my experience. I have been consulting for 14 plus years as a technical architect in cloud ecosystem. Well, having worked as a technical architect in different geographies and solving multiple issues with the digital transformations that companies face in, having worked as a technical architect in different geographies, serving 50 plus clients, I have come across so many issues that the companies face while on the journey of their digital transformation. One such example that I would like to highlight today is when I was hired as a technical architect by a company, by a startup who had raised over $200 million over a year ago. And the issue they were trying to solve was integrating their AWS system with Salesforce for making the data transition as smooth as possible, because the Salesforce had their identity application and AWS had their cloud application. So the transition that was happening was storing the token in an intermediary database, which was highly unsecure, and they were trying to solve it to make it secure. In short, they were trying to get their customers sign into their application seamlessly and securely. It sounds simple, but given their architect, who was an AWS solution architect, who had little to no experience in Salesforce, the architecture was designed by him. 2 years later and $1 million later, it was finally fixed by me in 3 months. What I did was nothing but just advise them with my experience that Salesforce works in a different way. Fortunately, they had the luxury of affording that missive, but 70% of the transformations fail, and companies potentially go bankrupt in doing so. So we did some digging to figure out businesses are investing heavily in cloud. Businesses are investing heavily in cloud platforms like AWS, Microsoft Azure, Google, and Salesforce. Yet more than half struggle to realize the full business value from their cloud investments. In a global cloud computing market that is predicted to surpass $1.6 trillion by 2030, that is a critical skills gap and lack of timely expertise leave companies with underutilized technology, inefficiencies, and lost revenue opportunities. So there must be a better way. Our solution, our AI-powered platform bridges the cloud skills gap with a team of AI-powered agents that provides instant troubleshooting, strategic insights, and talent recommendations, empowering businesses to fully leverage their cloud platforms and maximize their ROI. How it works. How it works. You submit your query to solve, for example, the issue that we just discussed. You submit your query to solve the AWS app architecture with Salesforce Identity Solution. You receive an AI-powered insight. If that is not enough, you get to work with a human who is an expert in both the systems. When you get your desired outcome, our AI improves itself based on the knowledge shared in that session, making your next query resolution seamless for your team's enablement. Voila, your idea to execution becomes almost instant, creating less tech debts and allowing you more time to do the actual business. Our AI is under development for no hallucination and verified data with active responses and decision-making capabilities, leveraging our specialized expert network, taking care of your data privacy and security compliance. Our ask is we need an initial investment of $2 million to accelerate the product development, expand the expert network, to invest in R&D and technology, to achieve our MVP and a go-to-market strategy to expand our product footprint. So here we are, Hashan, Deepthi, and I, available all day today and tomorrow to answer your questions and concerns. We are a team of 3 technology leaders on this journey of helping businesses build their future on AI, on artificial intelligence, powered by the most intelligent species, that is humans. Thank you.
Thank you very much, Inshu. Our next presenter is coming from an industry which I know we all love, and that's real estate, but not just any real estate, it's commercial, and add that with prop tech. So I'm sure you'll all be interested to hear from Andrew Brown, formerly known as Brownie, of LeaseSuite Technologies.
Good morning, everyone. Thank you, Ash, from the Startup Nerds. My name's Andrew Brown. I'm the CTO and co-founder of LeaseSuite. So LeaseSuite are empowering the large business occupiers and commercial real estate industry with AI-powered portfolio and transaction management software. Here we go. So we are giving you the control to take control of your commercial real estate. And we're doing that through technology which seamlessly connects in lease and facilities management, lease procurement, portfolio management, financial reporting, occupancy analysis, and energy management. So what problem are we solving? On the macro industry level, there is a severe lack of investment when it comes to commercial real estate tech versus the residential tech, which I think everyone in this room would probably agree on. When it comes to portfolios of leases, they're still being managed on disorganised spreadsheets and other disparate manual collections of data. When it comes to leasing transactions, the processes there are no different than what they are today and than what they were 30 years ago. On the asset owner side, they're not empowered with software, so they can't maximise their data and reduce their income downtime and boost total returns. When it comes to the macro level, on the user level problems, commercial real estate is simply broken. When it comes to lease management, leases are complicated. A commercial real estate lease is complicated. It's not a set and forget document, and it's filled with booby traps. So if you miss a key date or event, this can have major financial consequences. When it comes to the transactional side, occupiers lack that insight and control on how they actually do transactions. Key data can be missed, misunderstood, which can lead to slow, expensive deals being completed, or you can miss out on options. As for the asset management side, when it comes to small funds, REITs, and family office investors, they simply lack the systems to effectively understand their leasing pipelines and investment performance. Our solution, LeaseSuite. So we're enabling and empowering all the participants in the commercial real estate ecosystem. We're 3 products. LeaseSuite Premises, which is portfolio management software for the occupiers, which provides rapid access to lease data to make better decisions. LeaseSuite Procure, which is AI-powered transaction software that slashes that project delivery time and costs. This product doesn't have any peer in the market, so we're getting real traction on this second product. Our third product, LeaseSuite Portfolio for asset management for building owners, bringing investors closer to the data that increases their income and total returns. So what's the long-term vision of LeaseSuite? Well, like I've mentioned, we've got 3 products. 2 of those products are in market, being Premises and Procure. Our third product, the Portfolio for the landlords and the family owned, will be available, and MVP will be available at the end of this year. So these products essentially will be profitable in their own right. And we'll add other products and other spin-off products to this ecosystem that we're creating, where it be agents will connect into this. There'll be fit out and construction, so forth, make good. Again, building an ecosystem here. And then with time, with data, and with just building trust, essentially what we're doing is building a marketplace here, which is the longer term vision. So a future marketplace solution is really enabling those tenants and the landlords to engage and to transact faster and a lot cheaper. And then with further innovation, I mean, AI-powered predictive modelling can be done. Matchmaking for leasing transactions and adopting smart contracts and getting into blockchain technologies. Our market traction and investment plans. We're closing the final 300K on a seed version 2 round. We've raised 2.6 million, so we have runway secured into 2026. On top of that also, we are eligible for the R&D rebates, so about approximately 300K on top of that, which also gives us further runway. We have 2 products in market, LeaseSuite Premises and LeaseSuite Procure, which I've already highlighted. We have contracted sales, so we're not at an early stage. I mean, whilst we are still early stage, we are making revenue. So we've got proven revenue and we're locking customers into 2-year contracts. We have our third product, LeaseSuite Portfolio, which is the MVP, will be available at the end of this year. We have a major capital raise plan for the first half of 2026, which is all about product expansion, and that will also go into the expansion into APAC markets planned for 2026. I'm Andrew. I've been in the PropTech space for 21 years. There's our other founder, Mike Steele, who is the commercial real estate industry expert. So 2 middle-aged men, seasoned vets who have been in this space, know the environment. We're hungry. We want to smash this, all things sales 2025. And then come and have a chat with us. We're at the Startup Nerds tent next door. Let's have a chat and let's be part of transforming commercial real estate industry from something that's very offline to online. Thanks, everyone.
Thank you very much, Andrew. Next to the stage, I'm going to introduce an AI solution in the generative AI space, and this tool can automate what a team of 7 content producers would otherwise be doing, almost at the click of a button. Please welcome Darren Carey and Andrew Jackson from Syndica.
Thanks, Ash, and thanks for everyone being here today. Very excited to meet you all and share what we've got for you. So I'm Darren Carey, as Ash said, the founder and CEO of Syndica. Syndica is dedicated to revolutionising content production through vertical AI agents. Sounds really technical and geeky, but we'll go into that and we'll let you know a bit more about that. trying which one. Got to learn how to do that. So the future of workflows, AI is actually unlocking, unsurprisingly, a $58 billion additional market. It's transforming the way businesses operate. So it's not about generating new, smarter software. It's about creating much smarter workflows. That's what's holding companies back. The AI technology is already there. If you think about it, the relentless demand for content to be produced is huge. It's expensive, it's manual. So their processes remain fragmented, time-consuming, and of course, very expensive. So let's talk about the problem and how we actually came about it. And this is really interesting for me, and I hope that this penetrates with you. We had a client who is a large sporting company here in Australia. They have a website, and every single day they have 7 content producers working there. They go to all of the sporting associations' websites in the morning, in the afternoon when news is released. They get those stories, they download them, they rewrite them in their own little tone of voice for their brand. Then they've got to change it for whether it goes up on a website, whether it goes up on their social media, whether it goes on any platforms. So their CEO rang me about 15 months ago and he said, Darren, this ChatGPT, it's awesome, it's great. I can put these stories into ChatGPT, ask it to make it a little bit more serious, a little bit funnier and whatever, but then I've still got to copy that content. I've still got to log into my content management system. I've still got to go and change that content or ask ChatGPT to change it again for the social media, for Facebook. Surely you smart guys can actually do something about that and make that a bit more automated. So there was that hint about what is the automation opportunity of the AI. So we built a proof of concept with that initially, and we actually proved that we could actually, using the OpenAI APIs as well as Amazon Bedrock, we could do everything that ChatGPT could do. We could set up the searches, but we could also make it automate and connect to the client's platforms without having to sign out and sign back in. But no one wants to reinvent the wheel, so obviously we did some other research. Unsurprisingly, to date, as far as I can see, there's about 41 companies out there on the web around the world saying that they do automated AI and all the rest of it, everything from generating everything you need for SEO and SEM to doing your ads, podcasts, you name it. I've signed in and paid for at least 12 of them and tested them. None of them actually have this automation that they claim to do. None of them actually help solve problems. Once again, though, really wanted to not reinvent the wheel and waste my money. It was almost surreal to me that with all these companies out there and this huge opportunity with $58 billion market growing, that someone hadn't already done this. So luckily I have a relationship and a connection with the CEO of Amazon Australia. So I went and caught up with her and I said, Louise, am I wasting my time? Are you guys doing this? Is someone else doing this? Are there people doing this? And amazingly, again, I still pinch myself, she said, no, Darren, actually there isn't. And one of the biggest complaints that we're getting back from the market here in Australia from our companies is this AI is great, everyone's raving about it, everyone's saying AI is the future, but how can we use it? How's it actually going to save us money? How's it going to make it more efficient? Following on from that, we actually had 7 meetings with Louise and the exec leadership team, which I'm extremely appreciative of. One of the greatest people and bits that helped us in there was Romain, who's their solutions architect at Amazon for AI. And he again reiterated that there's no one out there, even the big publishers that were trying to do their own things with AI hadn't done what we'd managed to do even with just the MVP proof of concept. He had a few suggestions for us, which was great, and we took them on board. But excitingly, some of the things he said, which I'll go through in a minute, we actually saw what he said was great, and we went 10,000 steps higher, and we're actually in the process of submitting patents with some of those features. So the problems are clear, just quickly on that. In the market, generating high-quality content at scale is obviously a problem. Lack of consistent tone of voice, right? So all these businesses from 7, 9, SBS, the pool company, everyone loves to have their own tone of voice. It's critical to their identity and their business brand. Some of them having multiple tones of voice, and it gets even more difficult when they want to keep that tone of voice not only in a website blog, but also on their social media networks. Not being able to react quickly enough to the fast trending, changing topics in the industry. That's, again, a challenge. It's a manual challenge. Here's a big one which I find really fascinating. There is an industry fear or an industry acceptance that if you use Gen AI created content, that it's going to be plagiarism of some sort. So even when we caught up with Romain, the solutions architect from Amazon, he was saying it's accepted by all these companies that there is plagiarism of some sort. Why don't you build into your product some kind of traffic light system that actually shows red if it's quite similar to some other content, orange or green? Took that on board, it was a great idea, but we actually went a bit further and went, no, we can do this and make it without it being plagiarised. So that's one of our unique selling points that no one's done, so we can demonstrate that for you later on. And most importantly, the true example that I just gave you about my sporting clients, there's no true automation. It's just a very manual process. So they're the problems in the industry. So let's talk about the solution and what Syndica does. We'd love to demonstrate for you if you get a chance later on, but Syndica finds, collates the relevant articles, research trends and topics, so you can literally put in all the search keywords. You can say must include, should include, very, very flexible, easy to use from that side. Takes all the data, creates a plagiarism-free, so that's that key point I said, we're actually plagiarism-free. So all these businesses, whether they be small sole trader through to a huge publisher, can be confident that what they're getting produced using the AI technology is plagiarism-free. The content is automatically structured and optimized for the different platforms, whether it be social media or a blog, does that in the tone of voice. And once your sources, templates, and the tone of voice is set, you can go to sleep, come back whenever you want. It's generating new stories continuously. You just have to review it, and if you're happy with it, publish it. So what's the key difference? Syndica, we're not writing another AI tool. We're not trying to do what all these 41 companies are doing and everyone's doing and writing AI. We're about fully automating that process that is currently costing companies a huge amount of manual resource and time and money, so they can focus on their business strategy, creativity, and growth. So thanks for your time. I'm going to hand over now to my co-founder and product director, Andrew Jackson. Andrew Jackson.
Hi there. Kind of out of time, so I'll just do this quickly. We've got an MVP. So AI it's not just the future, it's also the present. All right, the next 2 to 5 years, AI is going to change every industry. All right, the disruption is already happening. We have an MVP. Let me put this through. All right, so the ones that adapt, all right, will thrive. The ones that don't will fall behind. So we've got an MVP. We've tested it with the real clients. We've got a white label version already happening out there, running live, producing content 24/7. So we've done the groundwork. We've gone from 0 to 1. Now we need to go from 1 to many. All right. The opportunity in the market is $51.8 billion by 2028. So everyone that we have shown this system to loves it. All right. The MVP, everyone wants to use the commercialised product once we've got it there. We've shown it to one company that does SEO and SEM content for over 3,000 customers. So being able to partner with a company like that will obviously give us a lower cost of acquisition while scaling. All right, we're looking at raising, we'll go through this. Speed, so testimonials, these are some of the customers we're using with, or that have tested it. Channel 7, Mellors Ministry of Sport. Just quickly, sorry, need to get through. So the investment we're looking at this point, next, not going. Here we go. So we're looking for a $2 million raise. The $2 million is for building an exceptional team, commercialising the product, and scaling so we can capture market share at this critical point. Now, I've got 3 things to offer. We've got a team, an experienced team. Darren's got 20 years in the content industry. Mark, our CTO, has 25 years in building applications and running large IT teams. Myself, 25 years in starting businesses. And we've also done already done an IT startup and converted. The second thing we've got is a trend. All right, how do you make big money? You get in front of a big trend. All right, and AI is the biggest trend that has come along in the past decades. The third thing we have is a product. All right, the product is content automation, and it has a use case that has the ability for mass adoption. All right, so the 3 things we have, we've got an experienced team, we're building in front of a big trend, and we've got a product that has a definite use case with mass adoption. All right, if you would like to come and talk to us about this opportunity, we're easy to find, we're in the orange shirts, we'd like to see you. Thank you.
Thanks, Thank you very much, Syndica team. And last but not least, I'd like to introduce to you Freddie Lindvall, who's going to introduce a concept that if we think about blockchain, crypto, or let's think about crypto as a concept. We've created now a currency effectively out of nothing. Well, let's look at something like data and why. Think big here for the opportunity in the future. Potentially we can commoditize data. So please welcome Freddie to the stage from Me2B.
Hey, we're Me2B. We are building a massive marketplace. We're building a massive data hub on scale, an app filled with hyper-personalized data, and of course it's powered by AI. I'm Freddie. I am a Swedish-Australian tech entrepreneur. I'm a third-time founder. I have successful previous exits, and I'm the co-founder and CEO of Me2B. We're targeting two massive industries, telcos, brands and advertisers, which both are facing the same type of problem, very tough privacy data laws. They're just getting harder and harder every day. And to accurately target end users with consent and get that hyper-personalized data is just getting harder and harder by the day. So we said, why don't we use one of the largest commodities in the world, mobile connectivity and prepaid mobile data? Why don't we utilize that to create a real value exchange? Why don't we create a marketplace around that? So meet Maya. Maya is one of 6 billion users that tops up her phone on average 2.3 times per month. Maya lives in Indonesia, where 95% of the mobile populations are on prepaid solutions. Maya spends 9+ days on her phone. Scary but true. So we thought, what if we can build a marketplace? What if we can build a marketplace between all these users like Maya, telcos, brands and advertisers? And what if we can create a real win-win-win? So the concept is pretty straightforward. Maya goes into our app, she purchases prepaid mobile data. With consent, she shares all her preferences and all her personal data. The telcos, the brands and the advertisers, they get access to all that data, all of her preferences, and with consent. And in return, they give Maya extra mobile data and tangible rewards. And Me2B, well, we sit in the middle and earn revenue from potentially billions of monthly transactions. Maya wants real value for sharing her personal data, which today doesn't exist on scale. Today, Maya can't monetize on her data. Maya is not just after another free coffee for sharing her data. Maya wants tangible rewards that she can actually use to top up her prepaid phone, or buy digital services and goods, or pay for her train ticket, or maybe pay for her utility bill. Telcos, well, they want to monetize on their users. But today they struggle because these users are churning 80%. The telcos are also very heavily regulated, which means that they have to compete. So they cannot go together and build a solution on scale. It's not economically viable for them to set up their own solution. Brands and advertisers, well, we know what they want. They want to target these users with consent, and they want to do it accurately on scale. But they're struggling to find platforms like this to actually find these users. So Me2B, again, we provide a massive marketplace, a value exchange on scale, where everyone creates a win-win-win. So for end users like Maya, telcos, brands and advertisers. we're all about emerging markets. We're starting with Southeast Asia. We have one key partnership integration that provides us access to a massive distribution platform with the access to 900 telcos and 5.4 billion users. And additionally, we have made a revenue share model with the telcos to incentivize a faster and a quicker user acquisition push. We're pretty proud of Me2B, and we really believe in it. But what's even more cool are a few of those tech giants. I think you know some of them. Salesforce, Magnite, D2One, some of the best tech companies in the world. Well, they really believe in us. We bootstrapped the business. Our friends and family oversubscribed in just over a month. We've secured 1 million in capital. We've partnered with world-class partners. And we're currently raising a pre-seed round to help us scale. With my previous exits, I've also had the fortune to be an investor. So I've invested in over 10 startups. I'm on a lot of advisory boards and regular boards, and I've probably evaluated several hundreds of startups. So I know what a lot of you are thinking right now. All right, this is a big play. Huge play. He's talking about 6 billion users, 900 telcos, the world's biggest brands and advertisers. Sounds a bit too big to be true. A startup pulling this off? Well, come and talk to us. And we'll explain exactly how we're going to do it. We have the backing from some of the world's biggest tech companies in the world. They believe in us, so maybe so will you. Thanks for taking the time to listen.
Thank you very much, Freddie, for closing us out. And that concludes the Startup Nerds today. So thank you very much to the presenters. Thanks to the audience for your attention. And lastly, thank you to Wholesale Investor for giving us and these startups the opportunity. We wouldn't be here today on stage without you. Thanks.
So we had an amazing line of speakers until this point, and let's take a short break. I think you were all waiting for this moment. And let's take a 20 minutes and return in this event hall. Thank you.
Ladies and gentlemen, please make your way back into the presentation room. We are starting in 2 minutes. Please make your way back into the presentation room. We are starting the Venture Capital Investment Trends panel session in 2 minutes. Please make your way back into the presentation room. Can the panelists for the next session please go to the front row or to the back of the room? Thank you. Ladies and gentlemen, please make your way back into the presentation room. We are about to start the Venture Capital Investment Trends panel session. Please, everyone, make your way back into the presentation room.
Hashan. All right. It's very good, man.
Yeah, thanks, mate.
Yeah.
I'll tell you that.
People attended. That's great.
Ladies and gentlemen, please make your way back into the presentation room. We are about to start the Venture Capital Investment Trends panel session. Everybody, please make your way back into the room. Ladies and gentlemen, please make your way back into the presentation room. We are starting now. Please make your way back into the presentation room. Everyone, please make your way back into the presentation room. Yeah. The Venture Capital Investment Trends panel session is starting now. Please make your way back into the room.
Welcome back, everyone. I hope everyone had a very short but good break. Next in our agenda is our first panel session of the day, where our expert panelists will discuss the venture capital and later stage investment trends. Let's welcome our expert panelists, Kate Galpin, Senior Manager of Listings from ASX, Raj Gupta, Managing Partner from Allium Capital, Karen Chan, Portfolio Manager from Perennial Private Investments, and Stephen Xu, Co-founder and CEO from INP Capital. And again, Hashan de Silva, the Managing Partner and Founder, KPRX.
Good morning, everyone. Firstly, thanks to Bella, Steve, and the whole team at Wholesale Investor for inviting us to do this panel once again this year. It sounds like it's been a great morning so far, so yeah, looking forward to hearing from our experts this morning on the panel. We'll start with some introductions. Firstly, my name's Kate Galpin. I'm a Senior Manager in Listings at ASX. So basically, my role involves working with companies to consider and take on the pathway to an IPO, focusing mostly with growth companies in the tech and healthcare sectors. So to start with, let's work along the panel. Guys, if you could just introduce yourselves, your fund, and your investment focus, that'd be great. Stephen, should we start with you?
All right, thanks, Kate. Hi, everyone. My name is Stephen Xu, co-founder and CEO of INP Capital. So we are, an investment firm focusing investment in North America and the APAC region, which we have two major funds, early stage and growth stage. So early stage, quite industry agnostic. Growth stage, we allocate 50% capital to support our early invested companies, and then the rest of capital deployed to the sector. We've done the research from our research team. So currently, early stage, we quite focus on AI, sustainability and SaaS, enterprise to be SaaS area. And the growth, I think, is aligned. The journey is more support on that. Have a strong growth opportunity, AI plus, and the climate tech and the renewable energy area. Thank you.
I'm Karen Chan. I'm Portfolio Manager with Perennial Private Investments. We manage $700 million for our investors, focus on later stage growing private companies, and we also invest in pre-IPOs as well as IPOs and placements. We are a sector agnostic fund, but we are looking for high growth companies, so generally they would be more technology enabled.
Hello again, everybody. Hashan Silva, Managing Partner, KPRX. We're a healthcare VC. We do biotech, medtech, medical devices. We're a later stage investor than your typical healthcare VC. So we focus on drug companies at human trial stages, medical device companies closer to regulatory approval.
I'm Raj Gupta from Allium Capital. We're a firm that is 9 years old. We focus largely on mid to late stage technology innovation companies in Australia and New Zealand. Occasionally we will do some early stage. Since inception, we've returned about 22%, and that's been achieved through having invested in 70 companies. Whilst liquidity and outcomes is always a focus for us, it's in vogue now, and we've had about 35 exits since inception.
Great, thanks everyone. So we'll kick off the panel by diving into some of the current market landscape and dynamics in the macro environment. We're going to focus on the private markets in this panel, but just to give a public markets perspective, last year was a year of all-time highs, and ASX was no exception in that. Obviously, some very near-term volatility this week, but there's been all-time highs as well, from the beginning of this year. In terms of an IPO perspective, we're definitely seeing green shoots and momentum increasing. So basically, as of when Guzman and Gomez tested the market for the first time, mid last year, and the performance that they've seen through there, we've seen an uplift in interest. Digico raising the $2 billion REIT for the data center was the largest raise on ASX since 2018. And we've welcomed Chemist Warehouse through the merger with Sigma Healthcare. This month, we're forming a $32 billion market cap company. And obviously last week, Goodman raising $4 billion in the secondary market, which is the second largest deal in ASX history. So we're certainly seeing some green shoots there. In terms of the private markets, and Karen, I'll go to you first. What are you seeing in terms of market dynamics, and what sentiment are you feeling in the market as a whole?
I think in terms of the sentiment, we're seeing a lot more optimism this year, a lot more return to normalcy, and also sprinkled with a measured approach, because investors actually are very much focused on also returning capital to their investors. And because we are much more measured, we're not meeting the valuation demands of our founders that we meet. So there's definitely a closing of the gap between founders and investors. And so I think we're expecting to see a lot more activity, whether it's in investment, or divestments as well, and that could be through M&A and IPO. So I guess with also the regulatory landscape, I think that's also something that we're keeping in mind. We're also seeing ASIC, as you would have seen in the news today, also are doing a bit of a review on the private markets. But one of the key messages is that the investment ecosystem is very healthy if you've got both the public and private markets firing, and on the private side, investors are still very keen to put money to work.
Raj, Hashan, Stephen, anything else to add from your perspectives?
I guess in healthcare, like I said before, it's not great. Maybe an idiosyncratic thing with healthcare, what I've noticed is sometimes I meet a company, I might love what they're doing, but they need 20 million or 10 million to get to their next value inflection point. And I look at them and I say, I can't fund your trial. I got to syndicate that with somebody else, but there is nobody else to syndicate with. So if I do all of this work and say, all right, I'm going to commit $2.5–5 million to your company, you've got to go out and find the rest of it yourself. If there is no one else to find it from, I've just wasted a whole lot of time And so there's a bit of this kind of chicken and egg thing with the moment where companies are like, well, if you're the lead investor, we can go find somebody else. But then I'm sitting there going, well, I don't want to dedicate all that time into doing all the work and then not being able to fill the rest of that round. That might be idiosyncratic to healthcare because of the lack of capital in the private space. But yeah, I don't know, Raj, are you seeing something similar?
From an observation standpoint in tech and innovation, in calendar 2021, a company would come to you, you'd open the first page, and it would talk about total addressable market, which TAM for me is actually totally absurd metrics. But the point being now, when a company comes to you, the first page is generally about their pathway to liquidity and exit. So that is a paradigm shift. In 2021, it was all about growth at all costs, grow at 100%, we'll pay you a high multiple. Now, growth of 30% is exceptional, and you need that conversion from revenue to high gross margin to good EBITDA margin and net profit, and what is the company worth, and how do you realize or crystallize value as an investor through either appointing an advisor or assisting the company to get an advisor to get a strategic outcome in M&A, or alternatively going to Kate and saying, Kate, this company should do an IPO, can you help them? So liquidity is the biggest change that we're noticing, not only in what we do, but also the companies themselves. It's a critical outcome.
Yeah, I think it's, to me, what we see is cautiously recovery. So I think the investors still remain selective. So still, focus on more strong fundamentals rather than pure growth. So I think the founders need to really prepare to demonstrate you have a capital, efficiency, you have a strong fundamental, and the path to profitability, and then lead to what's your kind of like multiple axis strategy. I think that will be really important for your raising, capital or kind of for support your growth.
That's great, thanks. Stephen, I'll stay with you. So INP Capital obviously invest globally, so interested in your perspectives, from more of a global sense, and then also how does Australia compare and sit within the global piece?
Yeah, I think it's, so we invest more in North America and APAC, so much on the Europe. So what I see only on these two large regions. So North America is still dominating the venture capital, especially in that AI and deep tech. And the US, what we see is still leading in that later stage capital investment. And more Canada is more like a research driven, the capital investment on clean tech or other areas. Asia Pacific, we see is more like commercialization driven. So the startups kind of scale faster, especially in China, Southeast Asia. So the capital more focus on your market traction or revenue growth rather than long-term R&D investment. I think Australia kind of sit in the middle. So it has strong innovation, especially in that, biotech, agri-tech, renewables, that actually provide strong foundations. But what we see is it's been struggles on later stage capital constraints. So that is really forced companies to seek expansion overseas or early exit. So, and also the raising or the financing timeline is still longer than usual. So I think founders, although the environment is improved compared to last year, but it still take a longer period than what we think, back in 2020 or 2021. So that is, I think founders need to be prepared for that.
Guys, any other insights from your portfolio companies, how they compare to global peers or looking to expand globally on Stephen's comments?
I was in the US in January and at a fintech conference, and I think one of the themes that came out to me was that a lot of those companies raised in 2021 and haven't raised since, and so their messaging was more all around profitable growth. and growing into their TAM. And in their mind, their TAM in North America is large enough. I think in Australia we don't necessarily have that benefit. We do need to go out into the global markets for certain industry, or for most industries. So I think that was one interesting thing, was a lot of them were not interested in M&A by expansion globally. But that said, we're also seeing in our portfolio companies that are arbitraging the valuation discrepancy to make bids into our companies. And so that's actually one trend that we might be seeing. There might be more offshore buyers that looking to add to the product mix or customer base through acquiring companies here in Australia, and that could be an exit pathway.
I mean, for us, our companies are always targeting the US as the first market. The Australian market, we are small in population, but the price is also very low. So I've never looked at a company saying we're going to get Australian approval first and then look to go overseas. It's always US approval. And the company that we mentioned in our previous portfolio, the company Neuron, has had FDA approval for 2 years now almost, and still not approved in Australia. Because it's not easy to get approved in Australia, and the actual prize for getting approval is not big. And so, yeah, that's the kind of sad part about it, unfortunately. I feel like I'm being very negative. I'm going to be more positive in my next answer.
We'll try and make it more uplifting. Raj, I'll go to you. You might dip deep down into the tech sector, actually. So in 2024, for the first time in a long while, there wasn't a tech IPO in the top 10 IPOs globally. And ASX saw a similar trend. In the follow-on space, that was very strong. NextDC led the way, and the tech sector on ASX raised over $5.5 billion last year in follow-on capital, and the highest performing sector across all sectors on the market. So Raj, just given some of that, what's your outlook for the technology sector and tech businesses that you're working with at the moment, and any particular exciting opportunities that you're expecting this year?
All opportunities are exciting, Kate, but I think there's been a hiatus of IPOs, as Kate has alluded to, and most of you would have read. To give you some data, in calendar 2021, there were 257 IPOs that took place on the ASX. Last year was a 10-year low. There were less than 30 that went public, and there were none that were in technology. Digicom, that was late.
A REIT.
Correct, it was a REIT.
Technology
So there's been nothing. So in our portfolio, there are 3 companies that have been mandated to go public this year, so we're excited for that. But the profile of those companies is very different to what it was in calendar 2021. So one of our companies is generating close to $500 million of revenue, and it is quite profitable. That is the shape of what these assets will look like in the first phase of going public. As I mentioned in one of the questions earlier, liquidity is critical. You can get liquidity in private markets. It is very difficult. You can get liquidity with public markets. It's also difficult. But what is important in public markets is if you are committed to it, if you are the right size and you are well received, it's the secondary capital that you can raise, which is astronomical. So last year, $5.5–6 billion was raised in secondary capital on listed markets. The average that was raised was $40 million across all the companies that raised. In private markets in Australia last year, less than 10 companies raised more than that amount. So it shows you that the paradigm shift towards public does make sense. There is hesitation, but that hesitation has got to abate. But the company's got to want it, and the board's got to support it, because ultimately you'll raise a lot more money.
Thanks, Raj. Hashan, I might move to you next. So can't have a panel without mentioning AI. Just interested in your perspectives on AI, particularly in the life sciences sector that you're obviously focused on. How do you think it's impacting life sciences companies, and at what different stages particularly?
Yeah, so there's 2, I guess, broad buckets. The first one is AI to make drug development or medical device development easier, and the other is AI or software as a medical device to actually be used by a patient for whatever reason. So in the drug development side, AI can potentially speed up all of the preclinical, so before it gets into even animals. So what we're talking about is the basic categorizing a target, like what does a receptor look like, where are the binding sites, what do you want to do with that receptor, when you target that receptor, what happens in the cascade, et cetera, et cetera. And then also designing the drug, so the drug looks like a certain way, and you can do these, you used to be able to do it, but it was a bit cumbersome, you can do it a lot better now. It's called in silico high throughput drug screening. In silico just means in a computer. I don't know why in the healthcare space we've got to use different words, we just say in the computer. And they can do that very quickly, but does that really add a huge amount of value? We haven't seen it yet. So what has been the bottleneck in getting a drug to a patient has been the clinical trials, funding the clinical trials, recruiting the clinical trials. Designing the drugs has not really been the bottleneck, right? So if you go to any university in the world, they'll have thousands of drug candidates sitting on the shelf. And so inherently, AI in that drug development space hasn't really made too much of an impact just yet, unless there is a researcher that has a great idea and he's going to use AI to help him get that idea to a drug very quickly. In the clinical trial space, people talked about AI helping to match a patient with a clinical trial to speed up clinical trial recruitment, because that was the slowest part of running a clinical trial. AI is not really necessary in that, right? We're talking about matching a fixed protocol, which is the clinical trial protocol, with a fixed protocol, which is the patient, right? So you don't really need some genius whiz-bang AI to do that, right? Basic computer program could do that. But what we found once these products have been launched is clinical trial recruitment is very personal and very, very slow. Like the physician has to have your clinical trial in the top of their mind, has to make that recommendation to you as a patient, has to tell you why, effectively sell it to you, and then get you. And then once you're in, you have to be handheld through that clinical trial onboarding process. Because if you make a single mistake, then you're out of the clinical trial, right? And so AI hasn't really helped there either. Now we talk about AI as a product, software as a medical device. It has been unsuccessful, right? So the beachhead, or the first place where AI was going to disrupt, was diagnostic imaging, right? So reading an X-ray, reading a CT scan, reading an MRI. Now, I personally believe that the algorithms that we've got now can do as good a job, if not a better job, than a radiologist. But how do you prove that, right? So if a radiologist says there's no tumor there, but the AI says there is, the only way you can, what is ground truth in that trial? You have to cut the patient open, right? And you cannot do, no ethics committee in the world would let you do that, right? So the FDA has declared, has ruled a line in the sand, that what the radiologist sees in that image is the ground truth. So if the AI disagrees with it, the AI is wrong, right? So with that kind of a regulatory framework, how can you disintermediate the physician? How can you get rid, the only way that this is going to be commercially successful is if an AI can get FDA clearance to be able to read a CT scan without a radiologist. Because if the radiologist still has to read the scan, there's no value there, right? And similarly, a lot of the work that physicians do now is basic pattern recognition. I think AI can do a better job of that. Not really talking about replacing the physician, but we're talking about supplementing the physician, because there's always going to be a shortage of healthcare practitioners. So why can't a lot of the work that is being done now by the physician be automated through AI and only get kicked up to the physician if required? The bottleneck there is not the technology. The bottleneck there is regulatory. And unfortunately, the lobby groups that are lobbying for the physicians are lobbying against it, because change is scary and could mean less money in the and so that's what's really holding back AI as a product, not the technology, but the change in the regulatory and the way that we pay for healthcare. That was also negative, wasn't it? God damn it.
I'll try not lift it again, actually. Thank you.
Then I'd probably just add that I think at the more early stage VC investing side, from what I hear from my peers, there's definitely a lot of activity in AI applications that are sort of on top of these large language models. And this is actually it sort of materialising in closed deals, which a lot of have not yet actually been announced yet. So there's definitely a lot of focus, a lot of deal hunting in this space here in Australia. And then at the later stage, we're probably seeing more about how are our companies fending off the AI disruption, as well as what strategy do they have around AI more generally. And how about you, Stephen, on the global side?
Yeah, I think for AI, definitely it's a hot sector. So everyone talk about AI on different angle, pure AI or AI plus. What we see is, I think in the, after the DeepSeek come out, it's a lot of like, I think reasonableness and rethinking about, what AI really is and how that application to the industry and what's the cost. Is that the big boys, kind of games or, kind of like startup can, have a piece of cake. I think from the investor side, it's come to more realistic to ask what exactly the enterprise, adoption or monetization pathway is more critical to how we evaluate the AI, the business or the investment opportunities, not just kind of you put AI there, kind of like you really have AI application. So I think to the founders it's important is really what's your value proposition, your technology application there to demonstrate you really are AI or AI plus or what exactly you can monetize your opportunity.
Actually, I do have a positive, sorry, I just thought about it. So one of our portfolio companies, what they're doing is they're working with oncologists. The oncologist resects a tumor from a patient. They can get that patient-derived model and 3D print little micro tumors into 84 well plates. And into those many plates, they can run a high throughput drug screen with different types of combinations of drugs. Because the way oncology is treated at the moment, you have different lines, different combinations, and the permutations can sometimes be in the millions, right? And so they can run those millions of permutations in this mini 3D printed 3D organoid effectively, and then use an AI imaging model to then come back to the oncologist with a suggested treatment protocol. This patient's tumor does not respond to treatment combination X, does respond to combination Y. And so that because that's all within the approved, they're not a diagnostic aid, they're just helping they're not a diagnostic, they're a diagnostic aid. So that can help, at the moment the way that patients' cancers are normally treated is, it's very regimented. They get you need to take this course first, you fail that, you take that course, you fail that. Whereas this can go, this patient's tumor was most likely to respond to this combination of chemotherapies or immunotherapies or cell therapy, whatever it might be. And so trying to bring a bit more value-based care into the way cancers are treated. And that I think is very positive.
In our opinion, 7 or 8 years ago, blockchain became much more public and it became a protocol and people built businesses of it. In our opinion, AI is not dissimilar. People will build great businesses of it. However, when OpenAI launched ChatGPT in late 23, we saw a lot of businesses in calendar 2024 that were talking about AI, and the application that's been most pervasive has been around cost reduction and efficiency. There have been very few companies that we've seen, and we probably see 400 or 500 companies a year, that are genuine AI companies that help you generate incremental revenue. Most of them are still very much, in our opinion, around cost reduction and efficiency, but that will change. It's just it's a natural evolution. I'd also add the M&A that's taken place in AI in the last 12 months. It's been companies that want to buy products that also make them more efficient. So that, in many ways, does agree with what I said about it being an efficiency cost measure at this point, but that will change.
Thanks, everyone. I think we're running up against time, so we might just wrap up with one last question for the panel. Just interested in what you think is the greatest opportunity and the greatest challenge that we'll see in the private markets this year, and any outlooks for the market or your portfolio companies for the remainder of the year.
Yeah, I think I'll take a positive attitude here. I think it's 2025 is a transition year. We are still very optimistic about the opportunity ahead. I think the areas as what we seeing or focus on as AI is definitely one sector, but the other sector where we see strong opportunity is about the sustainability. So include climate tech, include clean tech, and how we can resolve our waste globally. So that's the area we see the opportunity there. I think for the early stage companies, I still have a lot more capital to support. What we see is a very active market in both regions. I think for the later stage, a little bit to challenge there because the valuation, the liquidity requirement, other factors in there. So, but we see if you can demonstrate, your capital, your efficiency, and your strong fundamental, like sustainable revenue models, profitability, I think you have a very bright future. At least, late 2025 and 2026. So we are very, positive about the trend.
I might just take a different angle here. I think one of the greatest opportunities this year is companies working with their investors to, manufacture potential outcomes, which could be an exit event or growth through merging with other businesses or even pivoting. So I think there is opportunity through that change. And I think one of the challenges for managers like myself would be, when would be the right time to exit? And so going on the same theme about being measured, we may need to actually deliver that liquidity and exit a bit earlier, but then continue to back those companies in other ways.
I think the thing that I'm most excited about is valuations. So like you mentioned, Karen, the valuations have come down. The gap between what a fund manager is willing to pay and what the company wants is closed, I think. So I think right now is really an amazing time to deploy capital, at least in what I can speak to in healthcare. The challenge, unfortunately, is getting that capital to be able to invest. So our LPs, they're not getting the exits from the funds they invested in, and so they don't have much capital left to invest in new funds. And on the other side of it as well is we need to syndicate, because we haven't been able to raise as much as we'd like. We have to syndicate, and then having to find that capital to syndicate on deals, that's a challenge. So we can find companies that we're very excited about. Valuation is incredible, but then it's just getting that deal over the line that is a challenge.
I think the opportunity in our mind has been going public, which has been very difficult for the last 3 years. But the reality is Australian technology companies are the most expensive in the world, and the reason is there's a dearth of assets. And to give you an idea, there are multiple technology companies in Australia that generate more than $1 billion. WiseTech does, Seek does, Xero does, and there's others. And they have astronomical valuations because everyone wants to own them, and many people do institutionally and retail as well. In private markets in Australia, it's very romantic to be involved in a private Australian tech company, but there's only 2 that generate above $1 billion, and neither of them are as expensive as the assets are that are public. So in our mind, going public does make sense. It's hard, but based on what Karen was saying earlier, and she alluded to ASIC, I think private market scrutiny will get hard. The ASX is difficult to list on, but it's always had the scrutiny. You've got to live with scrutiny.
Thanks, everyone. Thanks, Raj. Yes, we're definitely up against time now, so just wanted to thank all the panellists for your insights. I think we could chat about this all day, but we must hand back to Bella now. So thank you, everyone.
Thank you.
Thank you very much to our panelists. Moving forward, we'll hear from Helen Tarrant, founder of Unikorn Capital. Welcome to the stage.
That one. Morning, everyone. It is still morning? Yes. No, it's afternoon. Hi. In case you hadn't noticed, that's Helen. I'm Stephen. Now, we've been wandering around this morning and we've seen some products and some technologies that will probably change the world. Now, I've got to set the tone for our presentation. We're not going to change the world. We're in commercial property, but we probably will change your bank account. So my history in 30 seconds or less is my dad went into construction in 1945, so 80 years of family construction history. Helen has been in commercial property for well over a decade and has literally written the book. Helen, tell us about commercial property.
Well, what makes Unikorn Capital different is that we incorporate the fundamentals of cash flow, uplift and growth, knowing that the traditions of finding a property that just gives you some cash flow isn't probably going to be enough for what you want to seek if you want to grow exponential wealth. So we cut our teeth on delivering basic growth and uplift to everyday Australians. So when we talk about the secondary market, that's where we've been as a company. So from there, we incorporated Unikorn Capital purely because, is it that one? No, here. Oh. It's not shifting. Oh, thank you. Did we go out? Yes. So the reason that we went into the commercial property as in incorporating all of those is because we know that if you are looking for a property, the property itself needs to have foundation cash flow. That foundation cash flow needs to be backed by a secure tenant. That's your medical, your government, any of the larger corporations on the ASX. But it also needs to have an uplift strategy where you can reposition or you can add in new tenants, or the fact that you can uplift rent by 20 to 30%. That means you can get the exponential growth in value as well as cash flow within a 24 months period. So that's what we seek to do here at Unikorn Capital that is so different, right? So it's being able to have a high income distribution to our clients as well as being able to deliver a high value growth in the back end. Usually you sacrifice cash flow for security, or normally you have to chase growth but not have the cash flow returns, right? So this way it's to give you a combination of both as well. So just looking this, is this the slide that because that's not working here. Is that, am I meant to press this? Or am I doing this slide? Okay, got it. Sorry guys. So just wanted to look at the Australian capital market. It has been growing, and one of the reasons that it has been growing is that there's this current demand, right? The demand in the market is for that security, the capital growth, a yield, and a high return to investors. Normally, you can't get that in one property, and that's why people keep searching for the unicorn. And so as a result, what we have found is that we try to combine a group of properties that deliver all three of those strategies, but each property does what it does best, so that combined as a portfolio, it can deliver higher returns. So the ability to add more lettable areas, the ability to increase current rents with sitting tenants currently by 20 to 30%, ability to repurpose that tenant, so potentially an underperforming tenant that we could swap out, and ability to lease extend on the current tenancy as well. So we seek to identify those values. So we've got a couple of projects at the moment in the pipeline. At the moment, the first one is that Blacktown Shopping Centre redevelopment. So Blacktown is one of the fastest growing areas in Australia. Perhaps this is a bit you should talk about.
All right, sure. Blacktown is one of the fastest growing suburbs in Australia, and in fact everybody heard of Walker Corporation here, multinational developer? They are spending $2 billion reinvigorating the Blacktown main shopping area CBD, which is about 2 kilometres down the road from us. So what we've done is put together a neighbourhood shopping centre. We're buying the old shopping centre, knocking it down and rebuilding it. At the moment, it's got around about 2,600 square metres. It will have 8,000 when we're finished. 100 parking spots, over 200. We have extraordinarily strong interest from a major supermarket chain and their associated liquor brand. You've probably heard of it. It rhymes with Rolls. And they are looking at coming in and taking 4,000 square metres of space. Right. This is not designed to be your Westfield shopping centre where you go there and you spend half a day as an experience. This is your neighbourhood centre. You drive in, you park your car, you buy your groceries, you pick up your kids from childcare, then you pop into Liquorland and buy a bottle of wine so you can deal with the aforementioned kids that you picked up from childcare. It's that sort of shopping centre. In, out, done, go home. Right? This centre is, in round numbers, it's a $20 million buy, $46 million worth of construction, and that takes us into $66 million. We're anticipating selling it for over 80, and that means the returns to shareholders will be well over 30%, which is over 10% annualised.
Over a 3-year period.
Yep, it's a 3-year project. Okay, if you want to see us, will be down the back and we'll answer all these questions, but Helen hasn't finished. Sorry, I've got there too early, which gets you into trouble.
So our secondary project at the moment is combining a cash flow and growth. So most people want an anchor tenant, and the National Archives has been on this site in Burwood for over 30 years. So this is a cash flow, firstly as an anchor, followed by a repositioning of a Townsville showroom industrial centre with extra land of 7,500 square metres. Most of the rents in that area are about 20 to 30% below, and so combined we can give you really solid cash flow targeting around that 7% plus, moving upwards, plus a repurposing of some of the tenants and increasing the rents will allow the next 2 to 3 years to hit around that 9% in terms of distribution, as well as an increase in the capital value of these assets as well. So what we are seeking to raise is about 25 million overall for these projects at a minimum investment of 100,000. We have a booth next door, so do come to see us and we can sit down and have a chat to you. Some of our past successes have been here recently within a 24-month period, less than that. We did the first lot of acquisition, which is a small group of investors buying in on a high yield asset in Townsville and then renegotiating that lease with an international tenant and then selling that off for 9.275 million. We've since done a few others with private investors as well, but ultimately what we have that's different to everything else out there at the moment is that we're able to deliver the cash flow and growth component combined in one portfolio so that you can get your cash flow but not sacrificing growth. You can get the security in a property in the fact that it's backed by a government or a national or international tenant, as well as be able to have the uplift that comes with creating additional value and combining that, building a stronger portfolio. So if you want to invest with us or think about investing with us or want to have an appointment, you can scan that QR code or come and see us next door and we can have a further conversation. Thank you very much and look forward to working with you guys.
Thank you, Helen and Stephen. And next we have a presentation from the Deltine High Yield Motel Income Fund. Let's welcome David Toomey, the CEO, to the stage.
Thank you very much. Well, thank you very much for having me. Back to Wholesale Investor again. It's very great to be here. I recognise some people in the audience, some investors and some acquaintances from past events. I'd like to start by saying congratulations. Sincerely, congratulations for being here, because if you are in the room, it's likely that you're a wholesale investor, a sophisticated investor, which means that you've accumulated wealth over your career, you've worked hard, you've made some good investments, and now you're looking to invest some cash. So well done. So there's two things we say to our clients who find themselves in that position. Number one, don't lose it. And number two, make it work hard for you. Now, I found myself in the same position. I thought, well, where am I going to put my money, my hard-earned money? I want wealth preservation, capital preservation, and I want it working for me. I thought if I could find a 10% yield, it's like doubling my money because you're getting more income off the same capital. So we've landed in the motel sector, which is where a lot of people land in Australia when they're looking to preserve their wealth. It's commercial property. So what we've got is a motel fund. We're looking to roll up and consolidate the motel sector in Australia. The motel fund will invest in a diverse group of 50 motels. We'll invest in 10 a year for the next 5 years. The sector is ripe for consolidation. There's many sub-standard independent operators out there who are looking to offload their investment and looking to retire. So there's quite a succession component to it as well. The consolidation strategy is simple and proven. You know, pubs have been there, storage most recently, marinas, childcare. It's all happened in all of those sectors except for motels. There's 2,500 motels in this country, and no one owns more than 20 or 30 of them. So there's significant upside available because there is those operational improvements, and there's, you know, when you own a motel, you can't do everything. So there's always some centralisation of costs and efficiencies to be gained. So we're able to provide an income yield of 10% because it's a high yielding segment. You can buy these properties for 10 to 12% on the way in. It's a 5-year fund, so we're looking to have a 5-year term and sell the entire portfolio at the end of 5 years. So let me dig into that a little bit. Why motels? Well, it's prime property. Might not be prime Sydney property, but it's prime for Orange or Dubbo or Coffs Harbour or a regional centre. It's on the main street in the middle of town. Road frontage, high cash yield property. The track record of profitable operations is in the assets that we're seeking, and they're usually available at between 10 and 12% for purchase yield. So when you're starting at that sort of yield, it's great. It's easy to go up from there. There are essential service providers in the towns. So these are diverse towns with diverse economies. They house local, you know, visiting health workers, project workers, salespeople, people visiting family and friends. They provide essential services to that local community. And of course, we can get geographic diversification in the portfolio. So the simple strategy is that acquire 50 quality motels. Now we're talking motels between 30 rooms and up, so not the 10 to 20 room mum and dad motels. They aren't big enough to provide a good investor return. We need adequate scale to provide enough money to hire a professional on-site manager and have money left over to provide that yield. We're targeting towns across Australia with economic diversity, and we're looking for great towns with great infrastructure. Obviously airstrip, hotel, hospital and projects going on adds to that. Now in all of the motels we've looked at and the ones that we're buying, we've noticed that there's always some operational improvements to be had. So we're not looking for turnarounds, we're not looking for complex projects, but there's always something you can do. You know, the person running it is not perfect and not an expert in everything. So you can usually refresh the website, the booking system, do better promotion, have dynamic pricing and some tightening of operations or reconfiguring of rooms. Of course, the expense optimisation is a big part with centralising things like digital marketing, bookkeeping, procurement and things like that. Really letting the on-site operators get back to what we want them to do is be friendly to their guests, create a warm welcome and a friendly goodbye, rather than having to sit there doing bookkeeping and stuff and taking that task away from them. And then on exit in 5 years' time, by putting a portfolio of 50 diverse assets together, of course you decrease the risk of that portfolio and you can sell that portfolio for a 7 or 8% yield, which provides that increasing valuation at the end. So our priority is, number one, is to ensure low risk. So that means it's a property-backed asset fund, low LVR, so we want to keep that LVR low. We have resilient operations, we have independent trustee oversight, and we'll exclude high-risk properties like development and turnarounds. We're advised by the best. We have a very efficient and good legal structure in place, very tax efficient. We have a great corporate team looking after fund administration. So a 20% return, now that's a big number, so let me underpin it for you. So when you're stepping in at 10%, you're halfway there. But of course, there's a little bit, 3 to 4% available through operational improvement, 3 to 4% available through inflation protection, inflation of increasing room rates over time, and of course that kick at the end when you can sell the portfolio at a lower yield and a higher valuation. Now the first couple of properties that we've got, number one is the Motel in Seymour. Now you wouldn't think, well, why would you be in Seymour? Well, it's right next to the Puckapunyal Army Base. So all the civilians working on base can't stay on the base, so they all stay in Seymour, and this is the best motel in town. It's full Monday to Friday, and then on the weekend it's got travellers coming for the wine region. It's a really well-kept motel. We're picking that up for a purchase yield of 10.5%. It's a really good example of what we're talking about. With the other one being the Wine Vine in the Barossa. Again, a recently refurbished 40-room motel right in Tanunda, in the centre of the Barossa, and again, a really good track record of profitable operation. The other thing that's supporting us at the moment is the market fundamentals, three main components. Three main components is high construction costs, so you have limited supply, and then you have increasing demand coming from increasing overseas arrivals and more people in Australia travelling regionally now that the Australian dollar's low. And the third punchline there is interest rate environment. So we have a decreasing interest rate environment, which is going to keep our interest expenses coming down over the term. There's anecdotes there for growth in the sector, both room rates and forecasts sector growth for the coming years. With looking at other funds and other investment opportunities today, that's what you're here for, is to compare. What we've tried to do here, and what we've successfully done, is to make sure that we've ticked all the boxes in terms of the structure. We've got high income yield, regular distributions, equity upside, we have multi-asset diversification, we've kept the debt levels low, we have no development or turnaround risk, and we have an independent trustee oversight and an AFSL. So they're the things to ask yourself when you're looking at different property funds, whether the funds tick those boxes, and that's what we've done deliberately. As I said, the capital preservation is important to us, and that is what we've delivered. With the management team, we've made sure we've got commercial property experience, 40 years of hospitality, hotel management experience, good financial acumen with our Chief Investment Officer. We're all very passionate about this project. We've got our money in, that's where we're putting it, and that's what we're going to be delivering, as well as an advisory board. The advisory board, again, has amazing commercial property experience. One of the most preeminent hotel operations experts in Australia is on the advisory board. He's here today if you'd like to meet him. And also Oliver has got a track record of rolling up the senior living sector. Now I'll end by saying we're open for investment. We have good, strong investor interest. We're looking to close the first round soon. So if you'd like to see us, again, we've got the booth next door. We're here all day to answer your questions. And thank you very much for your interest, and thanks very much for listening today.
It's getting taller and taller. Thank you, David. Our next keynote speaker is a key leader in global markets and corporate finance, driving the expansion of HMHC Digital Group from Singapore. As head of global markets and corporate finance, Edward Carroll has played a pivotal role in the firm's growth. He is also a member of the investment committee, bringing deep expertise to today's discussion. Edward, welcome to the stage.
Thank you. I'll put the mic back up. How does this work? There we go. Afternoon, everyone. And thank you, Steve and team, for having us here today. This is my first time in Emergence, but it is quite the production. My name's Edward Carroll. I'm here representing a firm called MHC Digital Group. We're an investment bank for all things digital assets. I'm here to chat to you today about an investment theme which we believe is one of the most important asset allocation considerations of our time. That is, the investment into digital assets. What do I mean by that? Well, crypto. So a slight pivot from your previous property discussions. If you didn't believe it before 2025, it's clear now. What was once a fringe movement is now an unstoppable force. For years, digital assets have been the black sheep of traditional finance, dismissed and derided by Wall Street as a speculative fad or at worst a scam. Over the years, governments have done their best to stifle adoption, banks have prevented participation, but it seems the market has spoken. I've added some of my favourite quotes here from both sides of the aisle, but you'll see that some fairly meaningful traditional investors don't seem to like the sector, but then we've got a bit more interest on the right here. But I think what's clear to us is that the sentiment has really shifted, particularly the last 12, 18 months, and I'd like to talk to you about why and what that means to your portfolios. Let's start with what are digital assets. When I joined the sector 3 to 4 years ago, it wasn't really clear to me exactly what people meant when they said digital assets or crypto. Often people associate it with either Bitcoin or some sort of a scam meme coin or somewhere in between. The way we think about digital assets in general is that digital assets are basically anything that sits on the blockchain or uses blockchain technology. At MHC, we carved that out into sort of 3 buckets to give a little bit more clarity over exactly what that means. And I think it's important to understand that for consideration for investment allocation and for understanding the risks attached to each bucket and necessarily how you should look to allocate to them. The first is blockchain as a technology solution. Here we go. Blockchain technology can optimize a whole bunch of traditional financial products and services. This is typically referred to as tokenization. The sort of usual association with that is for fractionalizing real estate, fractionalizing bank bonds, basically representing anything real world on the blockchain. And I think this has been the focus of a lot of the regulators globally because it's largely captured by existing financial markets regulation. So it's just implementing an alternative technology solution to provide products and services which are already have an existing regulatory framework to support them. The second is blockchain as a payment alternative, and what we mean by that is stablecoins. We carved that out. Stablecoins are effectively the most obvious real-world asset representation using blockchain technology. If anyone doesn't know what a stablecoin is, it's in effect, it's a blockchain-based token representing a fiat balance sitting in a bank account. There are variations to that, but that's kind of the crux of what they are. We think that there's an enormous opportunity for this technology and this product to disrupt traditional payment services. We think that an on-chain FX market is the future of cross-border payments and FX hedging. Necessarily, we actually have announced a partnership the last couple of months with a company called Circle, who are the largest regulated stablecoin provider in the world. And the third bucket is the more sort of esoteric tokens which have been built on a blockchain, often creating ecosystems of value which previously didn't exist. The most obvious example of that is Bitcoin, but it also includes the sort of large cap opportunities in Bitcoin, Ethereum, a couple of the other larger cap ones, altcoins, and then you sort of go all the way through to meme coins, NFTs. But we think of that bucket as kind of like, that's the least understood, certainly from a regulatory standpoint, but also we think that there's probably the most opportunity there for allocation if you have the right manager and the right person advising you and managing the allocation for you. So for the sake of this discussion, we'll be largely focused on bucket number 3 with a real focus on Bitcoin because that's really the proxy for what we think is probably the logical starting point for anyone looking to allocate to the sector. Let's just move to the changing institutional attitudes towards digital assets. 2024 was a monumental year for the sector. We had the announcement of the first ETFs for Bitcoin. There's been subsequent announcements relating to Ethereum and Solana. But what that's meant is it basically gave a well-known and understood product for institutions to allocate to the sector. So we saw net inflows of $64 billion in 2024, which was huge. I think more key to that is that 94% of institutions in a recent EY study have indicated that they believe in the long-term value of digital assets, broadly defined. But as part of that, only 67% of them had looked to allocate at all, and almost all of them felt significantly underallocated. And we'll talk about what that means for the future of price action, demand, and how that should necessarily impact your views on allocating to the sector. But a couple of the more prominent institutions who've allocated, BlackRock, Fidelity, VanEck, JP Morgan, some of them were very critical to start with the sector and then have subsequently changed tune to provide access because the wave of demand from their clients has been too strong to deny that there's an opportunity to allocate here. Let's move to the investment case for digital assets. I want to focus here on really what the changing dynamic has been and what that's really driven by and why you should consider it for your allocation. And really what it comes down to is that regulatory clarity, it's catalysed an enormous paradigm shift which has drastically reprofiled the sector from a risk standpoint for consideration for allocation. And what that's meant is it's then opened up an enormous opportunity and it's basically given a green light to institutions to allocate. It's also given a lot more comfort for retail investors and I guess in general it really has just created a green light for a flood of additional capital and interest in the sector. If we just talk about as a general statement the effect of this regulation and what I'm sort of terming the flywheel effect here, the additional allocation that comes from the green light from regulators what it does is it spurs allocation to the sector, which then actually improves liquidity, which subsequently lowers volatility, which then in turn increases attractiveness of the sector by way of additional products being, a deepening product pool being provided to the sector. What we've seen is that there's been significant investment from banks and institutionally backed investment firms looking to build infrastructure for the sector. The quality of the product is improving, and it's basically overall massively improved the attractiveness of the sector for institutions. And I'll just add that the regulation is not specific to Trump being elected. It's also, we're seeing it's, I'm based in Singapore, we're seeing the MAS very, very aggressively going after building a framework. We have the EU's got a very strong framework coming out. The Middle East has multiple frameworks coming, all of which are very supportive. But the direction and the flow of the tide is very firmly in favour of adoption, and that's what's created this enormous opportunity. I think as a specific case in point though, and the effect of this on pricing, we're now very, very bullish about Bitcoin as a result of this. We think that firstly the opening up of ETFs, but then subsequently the kind of green light from the regulators around the world to allocate to Bitcoin, that's catalysed this enormous shift in the demand-supply dynamics specifically of that asset. Anyone that understands Bitcoin knows that it has a fixed supply curve, and what we think has happened on the demand side with this kind of green light to allocate more to the sector, what that has meant is that the demand curve, the demand is massively overwhelming supply. And we think that that theme will continue for a while. I get asked all the time what my view is on where we think Bitcoin's going. I recently said that I think that despite price action in the last 48 hours, that we probably will see $160,000 US per Bitcoin by the end of the year, and we're expecting to see $1 million within 5 years. And there are some significant, that thesis is supported by a number of bank analysts we've seen recently, and it's consistent with a lot of the more institutional types who've come into the sector recently. Just to touch now on the role of digital assets in a portfolio, very quickly, I've put some numbers on 10-year Bitcoin correlation with other asset classes just to show how much it does provide diversification benefits for investors. And I'll also add that I did just a quick numbers to show the effect of a historical portfolio allocation to Bitcoin within a traditional portfolio. So you'll see here, if you had allocated 5% of a $1 million portfolio 10 years ago into Bitcoin, and you dollar cost average that 50,000 allocation monthly over a 10-year period, the effect of the Bitcoin allocation would more than double your returns. So Bitcoin has historically played a huge role in portfolios. BlackRock suggested 1 to 2% allocation. We think that's probably a good starting point for anyone looking to come in. But there is really, in our view, an enormous opportunity to allocate to Bitcoin, and there's subsequently going to be significantly other opportunities for other digital assets as well in your portfolio. Let's move to us. So who are we at MHC? We are the investment bank for all of your digital asset needs. Our global markets platform provides wholesale investors in Australia with the safest place to buy and hold all forms of digital assets acquired through a state-of-the-art proprietary customer interface, providing institutional-grade pricing and custody. We'll soon be rolling out a suite of additional derivative products to allow our investors the best venue to both explore and monetize their holdings. In addition, we have a funds platform combining both venture and liquid strategies. This provides access to our industry-leading investment team and can give you a trusted manager for any kind of broad-based allocation to the sector. And our PM, I believe, is in the room, Andy Palmer over there, so please reach out to him if you want to speak about that. I think core to our kind of mission and our team is our founder, Mark Carnegie. He has a background in financial services. He built an investment bank, sold that, and we've got an adjacent alternative asset management platform. We're very focused on trust. We've built a team of very experienced people to be a trusted partner for your allocation to the digital asset sector. And so if you'd like to have a chat with any of us, please reach out. We've got a booth just out there. We'd love to have a chat. But I would strongly recommend considering allocation of digital assets in your portfolio because we think over the right time horizon, the only way is up. So thank you very much.
Thank you, Edward. Next, we have a presentation from Activeport Group. Please welcome Peter Christie, Chairman and CEO of Activeport Group.
Okay. Thank you. My name is Peter Christie, Chairman and CEO of Activeport Group. For those that aren't aware, Activeport listed on the ASX in 2021. We're a software company. We build enterprise software for telco and data centre. Now, when I present to technical conferences, we tend to talk about the technical advantages of Activeport's product. When I talk at investment conferences, it makes sense to talk about the investment quality of Activeport's product, which is what I'll do today. Having said that, let me give you a bit of an overview of what our software does. Activeport, if you think about the life of an IT manager, which is our end users, and I'm sure you probably don't think about the life of an IT manager, but if you did for a moment, if you were an IT manager running BHP's global network or Commonwealth Bank's national network or Louis Vuitton's chain of retail outlets, you spend a lot of time buying compute capacity and data storage capacity, and then you join those together with a network. And if you're an IT manager today, you can buy compute and storage quite easily. You can go to Amazon's AWS site, you can go to Microsoft's Azure site, you can go to Google Cloud, you can dial up compute and storage very, very quickly. It used to be a lengthy, capital-intense process, but today it's instant. But when you go to buy the network to connect your users to that compute and storage, that's still a very long-winded process. It can take up to 8 weeks to get a network service provisioned in different parts of the world. What our software does is cloud enable those legacy telco and data center networks. So when a telco adopts our software, they can now sell their network services to those IT managers in the same way that that IT manager is now used to buying compute and storage. It becomes a very instant-on experience. And so our software for our telco customers has got a very high utility because we can help them generate more revenue, generate cash faster, reduce churn. It's certainly a customer-facing product for our telco customers. So that's what we do. But if we step back from that for a minute and think about why Activeport is a good software company to invest in, I think it's always worth reflecting on what makes a software company a good investment in the first place. And the things that I always look for, and a lot of investors that I speak to look for, are these three things. A good software company investment has to be selling their product to a very large market. You want to have a deep, broad market that you know can generate a lot of opportunity from quickly. High ARPU, so average revenue per user. It's very good if the software product generates a lot of revenue per user. It's not essential. There's been some fantastic ASX-listed software companies. Dropsuite is one that comes to mind where their revenue is quite low. Their revenue per user is quite low, maybe $3 instead of $50,000. But typically, the lower the ARPU, the longer it takes to get to profitability and the more capital it requires to get there. And so a high ARPU software business makes a better investment, in my view. And then recurring revenue. We obviously want to invest in a company that doesn't have to get up every day and go spend money finding a new customer. We want to make sure that we've got solid recurring revenue. And in that context, if I look at Activeport, we definitely deliver. Activeport's target addressable market of telco and data centres is around $4 trillion. Now that's obviously a lot of infrastructure in there, but people ask me how much of that is licensable revenue for Activeport, and the answer is about $360 billion. So there is a significant target addressable market for us in that space. And the customers for us are all the major telcos that you would know, people like Singtel, Telekom Malaysia, Reliance Jio, Telstra. They're the sorts of customers that are in that sector. Our revenue per customer is in excess of $2 million per year. Obviously not all our customers are in that category, that is the high end, but we have a range of businesses buying our products. Some spend $10,000 to $20,000 a month, some spend $100,000 to $200,000 a month. So certainly a high revenue per customer or a high ARPU business. And then when we think about recurring revenue, our customers, once they're using our product and they're using it to be the primary front-end revenue earner for their business, it's a very sticky software proposition for us. Our customers typically look to us as a long-term partner in their business, certainly more than 10 years. So across those three factors of a large target addressable market, high ARPU, and solid recurring revenue, I think Activeport as an investment delivers in all those categories. But then it comes to why Activeport and why now. There are plenty of software companies on the ASX. Activeport itself has been there since late 2021. Why would you invest in Activeport today? And And I think you can classify that into 3 different categories, and that is risk, competition, and timing. You would invest in Activeport today because we're being successful across these 3 categories, and let me drill into that a little bit quickly. In terms of risk, any tech company that's a startup, and Activeport was certainly a startup. When we listed on the ASX in October 2021, we had no software revenue, and we scaled that very quickly to $6 million a year in software revenue. So we definitely classify ourselves as a startup. And like any startup, you have to go through a process of de-risking the business as you raise funds. And we've been successful in doing that. Our product now, after 4 or 5 years of very, very intense development, is broad and deep. We have a perfect fit for the market that we're chasing. So we've certainly de-risked the product. And then when we talk about product market fit, we in the early days, we experimented with different channels to market, and we certainly found that product market fit in the global telco sector and certainly in the data center sector. So our product market fit is perfect. Financial de-risking, I've got some information later on our balance sheet. I think we've spent a lot of time the last year and a half making sure our balance sheet is sound, and so I think we've de-risked the financial side of the business quite successfully. And then team. We've had to make sure we get the right people in place, and I think from around July or August this year we've achieved that. We now have the right size team with the right skills, and we're starting to move some of those people into different parts of the world to make sure we've got the right people in the right location as well. So we've certainly spent a lot of time making sure that we've got the right team. And so where we're at today in terms of our risk profile, we're scaling the business. We've dealt with our product, we've got our market fit, we've got a sound balance sheet, we've got the right people in the right place, and now we're really focused on scaling the business up. And so out of the 3 factors of why Activeport and why now, risk is one. The second one to think about is competition. If you're going to invest in a software company, you want to invest in a software company that is ahead of the competition. And I think we certainly tick that box. Across our 3 product sectors or license revenue sectors of software as a service, enterprise licensing to telco and data centers, and our hidden gem, our GPU orchestration business, we certainly have what a lot of investors refer to as a moat, or we are building a strong moat in at least 2 of those sectors. How do we know that? When we bid for tenders, RFPs, RFIs in the major telcos around the world today, we typically find we're the only vendor. The last RFP that we bid for, we were the only vendor. The customer had to ask other vendors to bid to make the process look a little bit more competitive. And so if as an indicator of competitive advantage in a market like ours, the fact that we are one of the few products in the market globally that can do what we do for a global telco or a data center operator today, I think is a fair indication that we're competitive and we're building moats. And then the third factor of why Activeport, why now, is timing. One thing that we have had is fairly lumpy revenue for the last 3 years, and a lot of analysts say to me, well, we're trying to understand what the underlying recurring revenue looks like, and I think this half-year result and the last 2 quarters has started to highlight what that looks like. You can see here that our recurring revenue in FY24 is $11.7 million. The numbers we put out today show 5.3 as recurring revenue. Whether it's a blessing or a curse, we have some large one-time license revenue deals that we've booked over the years. It seems every year we've done at least one. This year is no different. We have a one-time license revenue deal that we haven't booked yet because it's conditional of $4 million. So our total revenue at the moment is looking at 9.3, and we've got half a year to go. What I really like about this, though, is as we've been shedding some of our legacy lower margin revenue and focusing on our software revenue as our GP is going up. So our GP is up from 54% to 67%, and it will continue to grow into the high 70s, perhaps into the 80s as we add more software license revenue and less services revenue. One thing about some of these one-time license deals or any of our license revenue, there's almost no COGS attached to our license revenue. So when we book a $4 million deal, the $4 million of cash goes straight to the bottom line for us. That particular deal, if it closes in the year, is actually $6.2 million in net cash to Activeport. So I think from the financials, in terms of timing, you can see now that our recurring revenue is starting to shine through. It's good revenue with high GP. We're still booking the one-off license deals, which is the cream for us. And we have a lot of potential new revenue coming through in the AI market from our GPU orchestration product. What I'm particularly happy with is the bottom line there, the debt line. At some point in the last 3 years, we had $4.8 million of debt on our balance sheet, and some analysts were a little bit concerned about that. It was what I would call safe debt, but it was important that we cleared that. We're down to $1 million as of the end of the half, and we don't intend taking on any new debt. And so we've got a very clean balance sheet, and of course if we book these one-time deals, will be the reverse of debt. We'll have a very significant positive cash balance, which will give us the war chest we need to really scale the business quickly. So in terms of why Activeport, why now, we've de-risked the business. We've got a very competitive position in the global telco market, which is very deep and very broad opportunity for us. And our balance sheet is looking very, very strong. So the opportunity for us in the next half and going forward is this. We really want to get to a recurring revenue base above our cost base. We need to add another $500,000 of recurring revenue per month to achieve that. We think we can get there this year. And the metrics demonstrate that that's achievable. With our current average revenue per user around $50,000 a month, we have a pipeline of 2,000 prospects around the world. We're dealing with some of the major telcos at the moment in regions, so Telecom Malaysia, Singtel, Bharti Airtel, Lightstorm, a raft of telcos through India, through Southeast Asia and through the Middle East, and we'll broaden our reach out into Europe and the US as soon as we can. But from that 2,000 prospects in our pipeline generating the revenue we need to get our recurring revenue above our cost base is imminently achievable. And of course we have leading technology. We have some fantastic technology. We have some brilliant products coming through that will accelerate the revenue growth, and so I think we're in a very strong position to be very, very successful in 2025 and beyond. That is it. Thank you very much. We have a table out today, so if anybody has any questions, we'll be out there for the afternoon. It'd be fantastic to talk to you. Thank you.
Thank you, Peter. Now let's hear from Future Property Group. David Cummins, Managing Director, will take the stage. He already took. Welcome, Dave.
Which button do I press?
This one over here.
Okay. G'day. Ooh. Sorry. I'll just do this. I was in the Maldives a few years ago and went on a surfing adventure with my 20 best mates. We decided to go on to Ninja's surf break, which is one of the biggest surf breaks there. It's a 5-metre swell, and for those not familiar with a 5-metre swell, it's bloody big when you're surfing a 5-metre swell. I popped up, jumped on the first wave, and I actually felt like I was flying until I realised I wasn't actually flying, I was more falling, head first, down a 5-metre wave into the coral bed below. How long does it take to fall 5 metres? It is literally about enough time that this is really, really, really going to hurt as you go into the coral bed below. So I was washed around in the wave, literally cut up and pierced by every sea urchin and coral in the area. Now in this situation, what actually happens is you actually wait for the board to take you to the top. But in this situation, because my board had broke, my leg rope had snapped, I was actually being caught this way. And instead of going up, I was going horizontal instead. What was actually happening was my leg rope had actually caught under a bedrock, and so I was actually caught under the wave, and I literally couldn't reach the air. Then I soon realised that I was actually being connected by the Velcro strap itself. So quickly took off my Velcro strap, rushed to the air, and emerged to the oxygen. From there, I was spat out to a nearby island, to which I had to wait there, and this is true, for over an hour because my friends didn't realise I was missing. Good friends, so be it. When I was actually on the island, I was lucky enough to actually explore the island. Even though I had blood and water coming out of me, I was actually strong enough to actually look around the island, and there I discovered something phenomenal. what was actually happening there was a community there that was based purely on nature. It had bamboo walls and leaves for roofs, and it was actually a place which had homes that were in harmony with nature, which is a phenomenal concept. From that, because I've been working in the construction industry for over 20 plus years, and my last job was actually the National Director of Construction and Development with over 60 projects, 40 hospitals and $2 billion worth of work. I'm always looking for new innovations and new ways of construction. At that situation in itself, I was able to actually think, even though this community here, from the present and from the past, is there a way that we can actually together work out a better way to live and a better way to build for the future. The way we build today is unsustainable for the future. The way we power our buildings, operate, and actually run our buildings is unsustainable for the future of today, future of tomorrow. So I have to press this button. Cool. So at Future Property Group, for the last 2 years, we have been working on what is called nature positive design, where nature itself not only protects you, but it actually enforces an oxygen positive environment that actually protects the environment as well. Our vision is simple. Homes that not only shelter us and protect us, but actually heal and rejuvenate the environment. We're currently in pre-seed phase and in the design phase, and what we've got is we've got green walls, green roofs, a biosolar roof, and its own independent water system. What that is doing is the theory is, through our prototype, is it's going to help heating and cooling loads, it's going to help from a biophilic point of view, so access to nature, and it's also going to reduce the operational costs of the building. Our calculations predict that for every 30 eco-lodges that we build, we'll be able to save enough carbon, which is the exact same as 96 return flights from LA to Sydney, which is actually equivalent to 5,000 mature trees in saving oxygen per site per year. This is a great investment opportunity because at the moment there is 9 out of 10 homeowners that would prefer to choose an energy efficient home that actually helps reduce their energy cost. One such couple is Miles and Jenny. Miles and Jenny own several caravan parks in South Australia, and they're the home to our prototype, which is at Gawler Caravan Park, where this prototype will be. What they've done is they've actually identified that even though they would like to have a more sustainable living and for their guests in the ecotourism area, what they actually have the biggest concern with is their actual ongoing energy bills. Now, peak demand charges, for those that are not familiar, peak demand charges is where, in the equivalent of a car registration, whether you're driving your car for just 1 day a year or every day of the year, you still have to have your car registered. In this situation, in the caravan park sector, Miles and Jenny will still have to pay $12,000 per month, even if they're only connected to the grid for 2 to 3 weeks a year. So even though we can provide them with energy efficient homes, their main pain point is actually the ongoing operational energy costs. So after a few years of research and a lot of discussions, we were able actually to create a world first energy system. This world first energy system, as opposed to greenfield, is able to take existing infrastructure like this building and take it completely off grid. We have now painted it, which I'm very happy to talk about. But what that actually allows us to do is it actually takes, for this building, for example, take away all energy bills for 25 years. So therefore, no more operational costs. Miles and Jenny are very happy with that, and so am I. I've been told, our service offerings are smart, they are simple, they are sustainable, and they are scalable. Today I'm inviting people who would want to come on an adventure with us to kindly seek approximately $600,000. There you go. This will help with our prototype, to which we have 3 universities who will also be doing a 12-month study. It's really important to us as a team that we actually have empirical data to prove our product. Too often there is greenwashing out there where people say they know it's green, it's sustainable, it's 6-star, it's neighbours, whatever it may be. It's really important that we as a team have these universities to prove our product. Once we have proven our product, we already have an existing growing base. We have had interest from the mining sector, we have had interest from the caravan park sector, and from government for housing as well. Through Miles and Jenny alone, we have approximately 12 to 15% of people in the caravan park sector alone interested in our product. But at this point, we refuse to continue to engage, continue to engage conversations with them because we just need to prove our product first. The University of Technology Sydney will be led by Professor Sarah Wilkinson, who is a globally renowned industry expert and written many books on the world of sustainability. Professor Sarah has already had early discussions with the World Health Organization, the state and federal government, talking about our project to try and make sure that, it is viable. The next 5 years, you'll hear a lot more talk about nature positive design. Nature positive design in the next 5 years will become a regulation and a protocol for governments in Australia and around the world. Currently, we are targeting Currently, we are targeting a sale price of $150,000, which is similar to our competitors. We expect a profit margin of about 10 to 15%, and under this model, we expect a return on investment of about approximately 2 years. We've already had other interests from other sectors, such as mining, which is a big one, residential and government housing, but as mentioned before, we do not want to continue those discussions until we've actually nailed down our product. Our finance team has run several models. They expect a company valuation of approximately $1 billion within the next 10 years, and I do believe that is achievable through the scale of growth. After that wipeout at Ninjas, my friends and I did go out the next day. This time we had done our research, planned our takeoffs, and looked after each other. Not only did we surf the big waves, but for this story alone, we had no more wipeouts. There is a famous quote, "You can't stop the swell, but you can learn how to surf." Ordre Group now has a diverse team of 50 plus industry experts. We have regular catch-ups, we look after each other, and we have united in our goal to reduce the carbon footprint of the property sector. I'm here today and tomorrow. Thank you for your time. I look forward to meeting anyone that wants to go on a big wave of success with us and talk and partner with us how you can build a more sustainable future for today.
Thank you, David. Up next is Kitea Health. Please welcome Simon Malpus, the CEO and co-founder of Kitea Health, to provide insights into the company's innovations and contributions to the healthcare sector.
Thank you very much. Great to be here. Probably the most diverse presentation, I think, today. So I would like to begin by introducing you to Jane. Jane's 17. She's actually just about to start university, but not long after her birth, she was diagnosed with one of the most common childhood neurological conditions, hydrocephalus. We often call it water on the brain. It's characterized by too much fluid being produced around the spaces in the brain, and it must be fixed by placing a tube, a shunt, to drain that excess fluid down to the stomach. If this procedure is not done, it is universally fatal. So, the problem is that Jane's parents were told that this is life-saving. So her young baby, when she was just after being born, she was diagnosed with this, they did the surgery, but then the surgeon said, the bad news is that this tube, this shunt that's draining that fluid, has the worst failure rate of any medical device. 50% of these shunts will fail in 2 years, 100% in 5 years. Now that means that her parents knew at that point, it's a train crash that's going to happen, but you never know when. Their lives were changed. So she's had periods, long periods, up to a month in hospital at a time. A total of 6 months of her short life has been in hospital. So what's going on? When this shunt begins to fail and not stops draining the fluid, pressure rises in the brain. And the most common symptom for pressure rising is a headache. It might be irritability. It might be energy loss. It might be vomiting. Now, those are all terribly common occurrences in young children. So the surgeon said, yes, it has a very high failure rate. Yes, the way you'll be able to tell is she'll get a headache or she'll vomit. So her poor parents would endlessly take her to hospital, just as any parent would. Turn up at any hour of the day or night. Now, they live 3 hours from the nearest neurosurgical hospital. They'd get there, she'd be admitted for a day, up to 10 days at a time. She might have a CT or an MRI scan to try and figure out what's going on. Has that shunt, that tube, stopped working and is no longer draining the fluid and pressure is rising in her brain? But in fact, most of the time it was a false alarm. She's had 15 times where she's been hospitalized for a period, all the scans, and that's turned out to be a false alarm. She's also had periods where they've monitored, drilled a hole in her head because they really can't decide, and they say, well, we've got to measure the pressure directly. So this is the paradigm of care for people like Jane and others around the world. Healthcare is reactive. It is not looking ahead. It is not measuring. It's relying on those nondescript symptoms of headache. So it leads to poor outcomes. People wait at home and eventually go to hospital. And it's expensive. False alarms are expensive. Kitea Health is about a proactive care solution for people like Jane. We know that if we can monitor the physiology accurately, we can catch these changes occur, not rely on symptoms, and that reduces costs and improves outcomes for people like her. So what is it about? We are an implantable medical device company. We have developed the world's first brain implant that measures pressure. It's also the world's smallest brain implant. We measure pressure in the brain. Now, I'm talking particularly about the brain, but our same core platform technology is applicable throughout the body and the heart and other areas as well. But hydrocephalus is our first clinical indication. So, you might think that's a really rare disease, isn't it? I don't know anyone that's got that. And indeed, you can live a normal life expectancy. But 1 million people live with this condition in the US. It is lifelong. You are a lifelong patient with this condition that must be managed with this shunt. And you know that there will be failures. 2/3 of the time people are coming to hospital, it turns out to be a false alarm. There's cost, and that's where we can really reduce it. You might still say that's a very small market, only 1 million people. It's a $2 million serviceable market in the US alone. And if you still think that's a small number, we can service the same number of patients as the cochlear device that's currently used for treating hearing loss. So we have that market cap in mind. We want to be the next cochlear device company in scale. So what is it about? We have an implanted device that is placed in the brain at the same time a shunt tube is placed. So it's not a special surgery, don't get that in mind, that it's very complicated. It's 5 minutes of extra surgery time, only 5 minutes. It's energized externally by a wand the patient takes home, because the whole idea is we want to allow home-based care rather than them having to go to hospital. The information goes from the wand to the app running on their phone and then on to the hospital, where the physician can be remote and still get that information. So you might think that's really sci-fi. Wow, that's out there. No, we're a University of Auckland spin-out company. We have 15 years of research experience in this space. I'm a neuroscientist by training. This has been my research area for over 20 years. How is pressure controlled? We have raised over 15 million of non-diluting grant funding that set us in train all the initial development. We went through all of the animal trials, all the safety testing, all the compatibility. That is all done, and we are in clinical trial. So this is one of our patients, Josh. He's at home in his bedroom. The first time in the world he is able to take his own brain pressure measurements. Instead of relying on a headache that he does get regularly, mostly through dehydration, as mother tells me. Instead of doing that, he knows when he should go to hospital now because the physicians and himself have actionable data. So we're doing a pre-Series A round. We're raising about 10 million. We have commitments already of 7 million. We have a term sheet, a subscription agreement is all done. We have a range of lead investors, venture capital firms that are on board, including some impact funds. And the funding will be used to run a larger scale pivotal trial. So we've finished the adult section of the trial. We are enrolling children. We're going to be running a US trial. We are targeting initially US regulatory approval before backing into approval in Australia. So this is the main pathway for us. So why Kitea? We are a novel medical device. There are no predicates in the market for this. This means that we can own that sector. It is servicing an unmet clinical need. There is no technology that enables brain pressure to be monitored for patients in their own home. It's a game changer for neurosurgeons. We are a team that is very experienced, 25 years of experience in medtech, a number of exits and myself, and we are in clinical trials. So our risk profile is massively reduced. Safety is all done, all looking good. We're on a clear pathway for regulatory approval with the FDA. We meet monthly with them. We are targeting FDA approval within 2 years and looking at an acquisition not long after that. That's our target. From our seed round, internal rate of return, 200%. Previous investors, we're offering a direct ownership in our company to help us grow, to help us get this to market. We're targeting absolutely economic returns, financial returns to investors, but also we are totally focused on making a difference for children and adults. Thank you.
Thank you, Simon. Now we have a presentation from our sponsor, ReachLX. Please welcome Paul Findlay, the CEO and co-founder, to the stage.
Hey everybody, we'll have a little bit of a change of pace. That's amazing technology. I'm very humbled to be coming after. My question to you before we get in is just have a think about that. Imagine if you could use AI to give every leader in your business EQ. We'll have a look at why, but also why does it matter? How and why does it matter? Let's take a look. I'm so excited to be at Emergence with a category creating moment. I'm sure everybody in this room knows the significance of category creation. Uber created category, Airbnb created a category, so did Salesforce, and today we're introducing software for leadership. It's a strange thing that every role in the world has software. Leadership has the ambiguity, the complexity and the pressure, and yet there's been no tools for the job. In fact, we have a saying in our country that when you move into leadership, you move off the tools. Why don't we give tools to our leaders? Now, I know this is a category creating moment because I'm going to talk about the status quo and everybody in this room is going to agree with me. I'm then going to share the problems and you're all going to agree that you have the same problems. And then we're going to talk about the how it helps us, and you're all going to agree that we'll see immediate benefits in our companies or our portfolio companies. So what is the status quo? Well, to get started, let's think of how we promote our very best people into leadership and then watch them struggle. Once again, we have sayings around it. We promote people out of their competence, right? And we see them struggle. It happens all the time. In fact, 60% of our new leaders fail in the first two years of their role. And then there's the rest of our leaders. Let's think about this. Do you know the majority of leaders that go into leadership, 82% in fact, have no training in leadership. So not only do we not give them tools, 82% have no training and then they wait 10 years for their first leadership development opportunity. So we have the majority of the people, the majority of our leaders leading the majority of our people that have no training and no tools for their job. Do you have any other role that spends 10 years learning through trial and error? So what's the outcome? What's the outcome of the status quo? The outcome is that we start to talk about HR stuff. We talk about retention and productivity and accountability, and we ask HR to change their name to people and culture. They're not HR problems. The problem is that we don't give our leaders tools or development opportunities. We just put them into the role and hope for the best. So let's have a look at what we can do to fix these problems. Let's start with retention. Now, we all have heard the adage that people don't leave companies, they leave bosses, and we'll come back to that. Before we do, let's think about what else we can do to improve retention and what the current problem is. Did you know, how's this for irony, that 30 to 40% of your top talent, your most skilled, capable people, leave because they don't get the opportunity to contribute to their full potential? Isn't that crazy? We're trying to get performance, we're trying to get contribution, and they go to another company to contribute more because we don't give them the chance. So what if we could look across our entire portfolio of companies or across our company to find the people that we needed so that we could give them the opportunity to contribute to their full potential, so they stayed with us. So we had increased mobility, talent mobility inside our portfolio or inside our company instead. So if we've got we can have a whole of portfolio view, right, and we can find people based on their personality or their skills or their attributes, their aspirations, their leadership abilities, their licenses, their certifications, even the feedback scores that they've received from their manager and the way that they've rated themselves. So imagine if instead of having our people leave us to contribute, we can look across the entire portfolio and have better workforce mobility within our portfolio rather than having them move out of our group. So we have the ability now to instantly, within just a matter of clicks, find the people that we need. And that is 30 or 40% of the reason people are leaving us in the first place. And there's our people. So, do you know which are the people with the skills and the abilities inside your portfolio and your entire workforce that would love to contribute more? Do your CEOs? Let's look at the next thing. So, what's another reason people leave? Another reason people leave is because we don't do something that is free and fast. We don't give enough feedback. Have you seen the impact of feedback? Negative feedback, so what you could have done better, improves performance. Positive feedback, great job, improves performance. A lack of feedback leads to resentment. It leads to active disengagement because people believe that nobody cares. So while they're with us, they're not contributing, and in fact, they're actively working against us, and then they leave. But here's the drum. 65% of employees don't get enough feedback. Does anybody in this room reflect on the 44 or the 22%? 44% of managers lose sleep over giving feedback. We've got a little acknowledgement over here. 22% just simply don't get round to it because it's too awkward. Yet we just saw the impact of performance. So now we come back to what if we could have AI that gave our leaders the EQ to have the confidence and the competence to have the conversations they currently find it too hard to do. What if we could do that? What would the impact to our business if all of our leaders had the EQ to have those all-important conversations?
I need to give feedback to Dimitri Developer. Give me 3 tips to ensure it lands well for him based on his reach style.
Based on Dimitri's reach style, here are 3 tips to ensure that your feedback lands well for him. 1. Provide clear objectives. Start by clearly outlining the objectives and expectations of the feedback session. Dimitri, being an analytical and reflective individual, will appreciate having a clear understanding of what needs to be addressed and why. 2. Focus on data and evidence. When giving feedback to Dimitri, make sure to provide specific data and evidence to support your points. As an analytical thinker,
we get the idea here. So, Dimitri, imagine the time it would save in our annual performance appraisals. Imagine the ability to have day-to-day operational feedback as standard because our leaders had the insight and the confidence to do it. The last thing, which we'll touch on now, we all focus obsessively and appropriately, by the way, on our P&L. The thing is, it's looking through the rearview mirror. It's the output of the inputs. What are the inputs? To create value faster, we need to have a people P&L that we can look across our entire portfolio that give us the leading indicators. So we know the organisational health and predict which organisations are going to perform well, and then have our value creation partners know exactly where to focus and what to focus on so we create value more quickly. So imagine if from a single place you could get clear that we had the right mix of people. They would recommend our company. Our customers would recommend our company. We had strong leadership compared to the global benchmark. We knew which part of our culture was strong and what needed some focus. We knew whether our new hires hit the ground running. We had a great sentiment in our workforce, where we had the skills, the traits, the competencies across our roles, so that we had all of the criteria to have a high-performing organisation. So when we go to look at the P&L, we know exactly who's going to be, which organisations are going to be performing well, because they have all of the management, the leadership and the talent in place, so we know it's going to perform well. So we can't just spend our time looking through the rear vision mirror of the people of the P&L. What we need is to have a people P&L for every company in our portfolio. And by the way, this is one of those rare circumstances where clearly having higher performing leaders, more engaged workforce, deploying people so that they can contribute to their full potential and solve our problems. We understand that we have all of the right formulas in place to have a high performing organisation. We are actually reducing costs and simplifying systems at the same time. So we're able to have a much higher performing organisation with clarity and whilst we're reducing expenses. So ladies and gentlemen, welcome to a world where we have software for leadership. My name is Paul Findlay. I've got Paul Sanson with me. I'll see you at the stand. Thank you.
Thank you, Paul. Now, bringing extensive experience in medical technology innovation, our next speaker is Andrew Shute, Senior Vice President of Business Development at EBR Systems. Andrew, welcome.
Great, thanks for the introduction there, and thanks to Steve for the opportunity to present for the third year running at this meeting. So my goal is to share with you why we believe we're a de-risked investment opportunity, and we've laid the foundations to be a rapidly growing medical device company. So we've developed a novel device, the world's only leadless pacemaker to treat heart failure. Now, while we participate in a market dominated by three major players, Medtronic, Abbott, and Boston Scientific, we aren't directly competing with them. In fact, we see ourselves as being complementary to them. Our TAM at launch will be $3.6 billion in the US only, and this is treating patients that have previously failed to get a therapeutic benefit from lead-based cardiac resynchronization therapy, and we only see this growing as we expand our indications and move into additional markets. Our pathway to market's really been underpinned by two things. One, our compelling clinical data, and two, the FDA's breakthrough device designation. And that has helped us provide a direct informal communication channel with the FDA over a number of years. In August, we submitted our final module of our PMA submission to the FDA. December, we completed our 100-day meeting, and in January, we passed the last milestone, which was our pre-approval inspection. And we're on track to receive FDA approval in just over 6 weeks, on or before the 13th of April. Now, our pathway to commercialization has also been supported by the FDA's breakthrough device designation. That automatically will grant us two reimbursement schemes, the ANTAP and TPT, which will give us an ASP in the US of $45,000 per system. So we don't need to sell that many systems, so 2,200 systems, to reach that milestone of $100 million in revenue. So we participate in the cardiac rhythm management market, and this is made up of three main segments. We've got pacemakers, which treat slow heart rate or bradycardia, implantable defibrillators, which shock the heart for those patients at risk of sudden cardiac death, and the segment we compete in, cardiac resynchronization therapy, also known as CRT, or biventricular pacing. This treats a subset of heart failure patients that have ventricular desynchrony. That's where the left and right ventricles beat out of turn. And the therapy works just by pacing the left and right ventricles simultaneously to try and restore that synchrony. Now, there's a term I'd just quickly like to introduce you to called pacing-induced heart failure. So 100% of patients who receive a pacemaker or implantable defibrillator actually develop ventricular desynchrony because we're only stimulating the right side of the heart. And after about within 4 years, around 30% of those patients go on to develop pacing-induced heart failure, and they needed to be upgraded to cardiac resynchronization therapy or biventricular pacing. So what's, I guess, over the last 50, 60 years of cardiac rhythm management, the leads or the wires that deliver the electrical stimulus to the heart have been the Achilles heel. These have known failure mechanisms. These leads can migrate after implant. They can fracture. And also if the patient develops a pocket infection, those leads can actually act as a conduit to deliver the infection to the heart. An endovascular infection has a mortality rate of around 30%. So to address those limitations with these leads or wires, the wider market's been moving to leadless pacemakers in the top right-hand side and leadless defibrillators on the bottom right-hand side. However, EBR has developed the only leadless pacemaker able to pace the left ventricle for heart failure. And that's because these other leadless pacemakers, which are only used to treat bradycardia or slow heart rate, are 20 times larger. So if they were actually implanted into the body of the left ventricle, they would be thrombogenic. If a clot was to develop on them and break off, it would float to the brain and cause a stroke. So in contrast, our electrode becomes completely endothelialized, meaning the heart's own tissue grows over that and encapsulates it within about 30 to 45 days, removing that risk of clot formation. So as we have a different indication, we've got an indication for heart failure, we're not directly competing with these other leadless pacemakers in the market. And as I mentioned, we see ourselves as being complementary, because even 30% of the patients who receive a leadless pacemaker will develop that pacing-induced heart failure I mentioned earlier. And we provide the only means to upgrade those patients to CRT in that event. So the greater success, the greater adoption there is in the market of leadless pacemakers, the greater our future market space will be. So our pivotal results were presented at the Heart Rhythm Society meeting in May 2023 and then published last year in JAMA Cardiology. And the headline was a phenomenal 16.4% reduction in left ventricular end systolic volume. That's essentially a measure of how much blood is left in the heart at the end of the contraction phase. So the less blood left in the heart, the more efficient the heart is and greater the cardiac output. And studies have consistently shown that if you have a 10% reduction in left ventricular end systolic volume, you have a significant improvement on both mortality and quality of life. And it's really that compelling clinical data that leads to support from key opinion leaders around the globe. And I think that's best summed up by Professor Betts from the Oxford University Hospital. Without WISE, these heart failure patients will be relegated to progressive deterioration of their condition and repeated hospitalizations. So as I mentioned earlier, our pathway to commercialization has really been underpinned by the FDA's breakthrough device designation, providing that informal communication channel. We've passed our day 100 meeting in December, as I mentioned earlier, our pre-approval inspection in January, and we're on track for FDA approval on the 13th of April. Now, I've already been asked a number of times today, what's the impact of the recently announced FDA job cuts? And we're pleased to confirm that, one, our review team have not been impacted by that. And in fact, there was news reports over the weekend that a lot of those dismissals have been reversed and those people have been reinstated anyhow. The next step for us is reimbursement. We expect that to come online on the 1st of October, which place will begin commercialization. So the US is our target market for a number of reasons. Firstly, we've got strong engagement and support from key opinion leaders. And secondly, it's a really concentrated market. In the US, there's around 2,000 hospitals that implant CRT devices, but 50% of the market's in the top 250 hospitals, which makes it easy for a company like us to target. And we can get there with 35 sales territories. And I touched on reimbursement. We've been working with CMS for a number of years. We already have WISE-specific procedure codes in place, which already map to an interim payment tariff. And as a result of the breakthrough device designation, we automatically qualify for the NTAP and TPT reimbursement schemes, which will allow us a $45,000 ASP. And then in January, we announced that we were we believe the first technology accepted onto the CMS's TSET reimbursement pathway, and they've announced they're only going to accept a maximum of 5 new technologies per year. So we're very excited by that, and that'll run in parallel with those other reimbursement schemes. So our initial year of commercialization, we're really going to consider a limited market release. We're just going to be focusing on those sites that work with us during our clinical trial. And there our goal is to achieve a sustainable utilization rate of 2 implants per hospital per month. And once we start to achieve that, we'll move on to our phase 2 sites, which are those additional high volume sites where we already have strong physician engagement. And to support this, we'll be utilizing a direct sales force. At launch, we'll start with 7 sales territories. Each will be made up of a clinical or technical specialist as well as a sales rep. Anyone who's been following us on LinkedIn will notice that we've been recruiting aggressively, and we've nearly filled our core group of high-performing sales reps. And these are people that really specialize in introducing new technology into the hospital setting. And we've traditionally relied upon contract manufacturers, and in 2020 we commissioned our first clean room to bring some of that manufacturing in-house. And then in January we had another announcement. We'd signed a lease on a new facility. This footprint is 4 times larger than our existing facility, and this will have a couple of benefits for us. Firstly, it allows us to increase our manufacturing capabilities. We're able to bring more of the manufacturing in-house, and secondly, it'll allow us to expand our capacity where we'll be able to meet the demand for the foreseeable future. I can see I'm just running out of time, and so I'll just comment on 2 things. So we mentioned our TAM of $3.6 billion at launch. To expand that, we're going to be starting 2 clinical studies in Australia and the UK, one called TLC, or Totally Leadless CRT, and this will support our transition from treating previously failed patients to treating newly diagnosed heart failure patients. And I'd just like to wrap up by just reiterating that we expect FDA approval in around 6 weeks on the 13th of April. We expect on the 1st of October to have our TPT and ANTAP reimbursement in place, which will allow us to have an ASP of $45,000 US. So myself and the team will be around for the rest of the afternoon if anyone would like to ask any detailed questions. So thank you.
Thank you, Andrew. Now it's time for a well-deserved lunch break. Enjoy, and we'll meet you at 2 o'clock. Thank you. Welcome back. Welcome back, everyone. Now we have a panel discussion on the evolving world of crypto. From market trends to regulation and investment strategies, our expert panelists will share insights into what's next for the digital asset space and how investors can navigate this rapidly changing landscape. Let's introduce our panelists: Alice Siu, co-founder from Transhuman Coin; Pratik Kala, portfolio manager and head of research, Apollo Crypto; Ryan McMillan, CIO from Merkle Capital; and Edward Carroll, head of global markets and corporate finance, MHC Digital Group.
Hello and welcome back, everyone. Welcome to today's panel on crypto. I hope you are as excited as I am about this panel. This panel will explore the accelerating institutional adoption of crypto and blockchain, the impact of increasing regulatory clarity, the emergence of new applications, and the opportunities and challenges for investors. So if you're new to crypto, or if you are accelerating your adoption of crypto, this panel is for you. So my name is Elise Su, co-founder of Transhuman Coin. We are a decentralized science token, or DeSci for short, and we're going to be on a reality TV show called Killer Whales. It's Shark Tank for crypto startups, so check us out. We're going to be on Amazon Prime and Apple TV next month. Now, so to our panelists and today's topic, first we'll like to cover institutional adoption. So, how has the perception and adoption of crypto assets changed among institutional investors in recent years, and what's driving this shift? Now, I'll ask my panelists to also briefly introduce yourselves before you answer the first question. And I'll probably get Ryan, you to start, given that you've worked at major asset management firms like BlackRock.
Sure, thank you. Ryan McMillan, co-founder and chief investment officer at Merkle Capital. We're a high conviction, long only crypto fund. The last year has been really good for that institutional change of mind, and that's really been spurred by the launch of Bitcoin ETFs, particularly a BlackRock ETF, which gives investors a real lot of confidence that a big name is backing the sector. And before that, there was only a handful of investors like Tesla who would put Bitcoin on the balance sheet, and that got some positive and negative press as well. And another thing that's happened, that had kept corporates out of investing in the space really was some accounting rules. So they changed late last year as well. So it's now a lot more attractive for corporates to be able to hold Bitcoin on their balance sheet. And you're also seeing sovereign wealth funds like Abu Dhabi also taking positions in the Bitcoin ETFs, and 13F filings show thousands of institutional investors now taking a position in Bitcoin ETFs. So yeah, that's been the real big unlock.
Hey guys, Ed Carroll. I run a firm called MHC Digital Group. We're an investment bank for digital assets. I'll just add to what Ryan was saying. I think that 2024 was pretty transformational for digital assets. I think there's been increasing regulatory clarity. I know we'll touch on that in a little bit, but I think what that really did was it did unlock the opportunity for institutions to start to allocate quite aggressively. Our view is that allocation still has a long way to go, particularly as we find the regulation becomes a bit more nuanced, and the ability for investors to get more comfort around their allocations and what that looks like becomes a bit more clear. I'd also add that various other applications of blockchain technology in general, specifically as it relates to sort of stable coins, the use of blockchain for tokenization and various real-world asset applications for the technology. I think all of those things are getting a lot of traction with the banks, and as a result, other institutions are looking at them as well. So I think 2024 was a very, very big shift in the mindset for the sector and for the technology, and it's only just getting started.
Yeah, thanks. Hey, it's Pratik from Apollo Crypto. We run 3 crypto funds across different strategies: Delta Neutral, Long Only, and some other strategies. After 2024 and the launch of the ETFs, I think institutional adoptions has gone up and to the right, and I think it's just the beginning. There's one thing about launching ETFs, but after that, we've seen a deep options market and other derivatives market come online as well. And a lot of institutions that were originally not able to invest in this asset class can now not only invest via ETFs, but they're also doing all types of different strategies, such as the CME basis trade and taking long and short sort of views via options. We're also seeing a lot of corporates, such as MicroStrategy, buying billions of dollars, and they're not alone. We are seeing corporates buying Bitcoin as part of their treasury strategy. There's MetaPlanet in Japan. There's a firm out of Hong Kong. There's several of them in the US. So we're seeing a lot of that, this diversification of the treasury happening as well, with Bitcoin as a core part of the asset base in the treasury, aside from just treasury bills and bonds haven't done that well, or gold or just currency. I think Bitcoin's actually also forming a place in that, and pension funds are also looking at it that way now.
So we've talked about corporate adoption, such as Tesla and a MicroStrategy, now called Strategy, who've put crypto on their balance sheet. Now, what about the regulatory side of things? So obviously when institutions are looking at crypto adoption, there's lots to consider in terms of the reg side. So what is, or how is the regulatory landscape evolving for crypto, especially in relation to family office, high net worth, and corporate adoption? And what impact will this have on our industry? Are we moving towards a more standardised and accepted framework? Now, I'd like to direct this firstly to Edward. Given your experience in licensing and regulatory engagement, and feel free to talk more about what your firm does.
Sure. So what I would say is that the answer is yes, we are moving to a more coherent sort of framework globally. I'm based in Singapore, but we've looked at regulatory frameworks across the Middle East, Asia, certainly Australia. In Australia here we have a fully fledged wholesale AFSL across the spectrum, so we can look at those derivative products we were talking about before as well, alongside a bunch of other products. But then you look at what's going on with the kind of crypto task force in the US, the EU. I think there is a concerted effort globally to support this asset class. And I guess what that means, to answer the other part of your question relating to the kind of more sophisticated allocators to the sector, being the family offices all the way up to the institutions, is that that gives a lot more comfort around allocating and allocating at scale. I think the framework itself is a little bit more nuanced than just saying we're going to regulate crypto. I think that you have to be a little bit more, I don't know who was here for my talk earlier, but we do think about crypto as being a kind of multifaceted asset class or technology solution. So, I mean, like you've got regulation for blockchain as a technology solution for like tokenization. You've got specifically stablecoin regulation we think will be carved out individually, and it's very important that is a kind of globally a global standard so that stablecoins can be used for cross-border payments and other necessary use cases. And then I think regulating the more esoteric tokens, the bitcoins all the way down to Ethereum and then more altcoin, meme coin, NFTs, that's a separate framework in and of itself. But I think the overall theme is very, very strongly in favour of regulatory support, which should facilitate that adoption we want to see.
Any thoughts to add, Ryan? Do you agree?
Yeah, I think it's been really hard for fiduciaries to allocate in size to the space without that regulatory certainty. So that really has kept pension funds and the like out of the space so far. And to get that regulatory certainty, you need political will to create the legislation. And we've only just seen that the last election in the US really did bring crypto to the forefront, and there were voters and there were blocks and there were a lot of support for the crypto sector there. And we're hopeful we see something similar here in Australia, where we hope to see some crypto policy by both parties soon with an upcoming election. And that's really where it has to come from, that top down to get through to everybody else.
What do you think, Pratik?
Yeah, I think it couldn't be more bullish in terms of regulatory, on the regulatory front. We had a very hostile SEC in the US. They were basically harassing crypto founders, businesses. They were debanking them. It was pretty severe, pretty bad. Nobody could build anything in the US. Now with Trump and his executive orders and the AI and crypto czar David Sachs, they have timeline to produce a favorable, somewhat of crypto framework in the US, we should be hearing something in 180 days to 360 days, and optimistic that we will get some pretty clear direction from the US, and the rest of the world will follow. The G7, G20 countries should follow what the US does. So it's never been better on the regulatory front since the inception, since Bitcoin started.
I agree. These are exciting times in terms of the reg side of things, especially with a major country like the US looking at putting Bitcoin in treasury. So that's a pretty good segue into investment strategies and performance. What do the investment strategies look like for crypto, and what are the key factors driving successful crypto investments? Are there specific sectors or types of digital assets that are particularly attractive right now? Pratik, I might get you to start with this, given that Apollo Crypto is one of the best performing funds.
Yeah, thanks, Elise. Crypto investing is more of an art at this point in time. In traditional finance, all of you are used to cash flows, and you could do your GCF analysis, you could do PE, PF ratios, you can do all of those things. In crypto, you can't do that. In crypto, by nature, it is a decentralized blockchain system which is powered by its own currency. So you could imagine it like if you're operating in Australia, you need the Aussie dollar. If you're operating in the US, you need the US dollar. Britain, you need the British pound. And you need to operate on a blockchain using its own currency. However, these currencies are not sovereign currencies. They are currencies that power the blockchain because it's a decentralized network. And in order to use the services of the blockchain, you need to buy that currency. So that's sort of like the core of why any of these coins exist and why people purchase them. It's because if you want to use the service, you got to use the coin, you got to buy the coin to transact in that currency, to do things such as DeFi or any other things you want to do, even stablecoin transfers. So when we look at it from an investment strategy perspective, we can monitor this stuff. Like blockchains don't lie. Blockchains get updated practically every 10 seconds or every 10 minutes. In the case of Bitcoin, they don't lie. It's all transparent. We can very easily track in real time whether or not a blockchain is being used in terms of the daily active users, the number of transactions being done, the amount of gas that is being spent, gas being the currency in several different blockchains. And we can devise an investment strategy looking at all of these on-chain metrics in real time and getting a pulse of the network of the entire thing. So we have some real-time feeds, we monitor that, and we can then backtest it and determine, it looks like this economy is growing, so to speak, because you're seeing the flow of money and the flow of stable coins and the flow of transactions happening on-chain. And so we would then obviously have a view and a thesis for the year, and then we adjust it month on month, quarter on quarter, depending on what we're seeing in the market. And then we back-test it with obviously what is actually happening on-chain. So very easy to see, like, daily active users on Solana was spiking last year, has come down now. A lot of that is flowing to a new blockchain called Sonic. Things like that, we could track that and then make our investment decisions as such.
Ryan, what are your thoughts?
Yeah, I think in terms of investment strategies, it's best to have a strategy. A lot of people invest in the space without a strategy, and that's the major pitfall. So it's sort of like a meme that people buy the top and sell the bottom, but the data does show that that's exactly what happens. And the best thing you can do is buy and hold or dollar cost in, and that's probably the best strategy for most people. We look at adoption rates on chain and use that. Are there more transactions happening here? Is there more wallets here? Where's the activity? And that sort of gives you an indication of where they're going. And then if you can understand what type of activity is happening there, they're the blockchains we're sort of attracted to. And also understanding the cycles as well. To date, there's been pretty strong 4-year cycles. We think they might start to get weaker and weaker, but to date, they've been there. And certain periods of time, you'll see Bitcoin outperforming, and other periods, you'll see altcoins outperforming. So we try to be really observant of those cycles and try and maximize returns for our investors by getting as much out of that knowledge as we can.
Yeah, I'd just say that I think that, kind of to Pratik's point, the fundamentals of investing in this sector are very different, and it depends on what you're investing in the sector. But I think the thing I struggled to reconcile early days was how you could possibly have the token be representative of the actual value of the ecosystem it represents. So that kind of, and that's because like my background's traditional private equity, so I was looking at it with metrics and with a hat on, which is a little bit more traditional. But it kind of requires, I think the point being, it requires that you look at things in a slightly different way to see, to kind of get a feel for value and get a feel for what the world perceives to be value. The one thing I would say as a carve out to that thesis is that I think that Bitcoin has kind of, in the last 12 months, established itself as on an island in terms of the way that you look at allocation towards it and necessarily the way you value it. I think that it's a little bit more vanilla in that it has a fixed supply curve, the demand as a kind of inflation hedge, or necessarily, as basically its use case as a corporate treasury hedging mechanism or otherwise. That kind of thesis has carved out as a standalone, partly because there's been more support for it, firstly through the ETFs and then through the kind of regulation that's coming afterwards. But I think that overall, it's just a different way to think about investing, looking at this sector. And so that's why it's actually very important that you either do a lot of work yourself or you allocate through someone you trust, because it really is quite nuanced and very different to any other asset class I've ever seen.
This was alluded to before on the panel, and it's about looking beyond just Bitcoin and Ethereum. There are many other different layers of the technology out there. There's different types of tokens for different use cases. So my next question to the panelists is, beyond Bitcoin and Ethereum, what other crypto assets or blockchain applications are gaining traction and showing promise for long-term growth? For example, have you considered DeFi or decentralized finance, NFTs, Web3 or Layer 2 solutions? What excites you?
I can start. I think DeFi has the most compelling use case. It was in 2017-18, and it's probably the most compelling use case right now. I worked in traditional banks and consulting and stuff for a decade, and it is absolutely ridiculous and ludicrous on the amount of IT and security and resiliency and middle back office accounting audit tasks that goes into it. It's like 80% of all the friction that happens in the organization in large banks at the moment. This can all just be very simply replaced with atomic transactions and swaps on the blockchain. Stablecoin transfers, like think about it. Today, if I've got a CBA share, if I've got 10 and I want to give 10 to you, on your birthday, I sort of can't. It's sort of practically impossible for me to do that. Where we are heading right now with DeFi and tokenization is I should be able to transfer it to you like a WhatsApp message. In 5 or 10 years, hopefully we're in a world where, I want to transfer 10 stocks to you. Here's like a WhatsApp message. I just send it to you and it's in your account. And it happens in 5 seconds. That should be possible, but it's not today because of this really heavy friction-filled financial system built on COBOL databases from like the 1980s. So I think the future is where we're heading into stablecoins and atomic swaps and transactions and stuff. And once you do that, you should be able to then use DeFi to its full extent and be capital efficient. So if you've got allocation in, for example, the Apollo Fund, say you've got $1 million with us, right now that money is just deployed and it's locked until you redeem. We are heading towards a future where you can give us $1 million and there will be lenders on chain in DeFi, and you should be able to redraw $500,000 by pledging it as collateral, and that should happen within a minute, like WhatsApp messages, within a minute or 5 minutes. So that's the future, and I think that's being built in the next 5-10 years, and very optimistic about that.
I'm excited. Edward, what do you think?
I'll be a little bit more vanilla. I think stablecoins, the more sort of basic applications of stablecoins not related to DeFi, I think is the near-term future for the technology. I think that stablecoins have an enormous place in the world to disrupt traditional cross-border payment services. We firmly believe that there's going to end up being an on-chain FX market which will strip out a significant amount of the costs in the system to move money around, and that will then facilitate significantly more additional sort of derivative products and services which can all happen on-chain, which kind of then leads into your DeFi solutions that was just discussed. But I think that the logical place to start right now is things that are relatively well understood and applicable to the real world, because that's where the regulation is going to start, that's where the institutions are going to understand, that's where the banks are going to support. And so I think that stablecoins is the logical place to do that. And we actually are the partner of Circle in Australia, the largest regulated stablecoin stablecoin company in the world. We announced a partnership with them in November last year to help facilitate that kind of adoption of stablecoins, because we firmly believe that that has a really strong place in the existing financial ecosystem.
Yeah, I think stablecoins are going to be really super powerful. There's also obviously gaming, there's NFTs, there's decentralized physical infrastructure networks, so that's actual telecommunications networks built on chain. So there's so many different ways we can go here. DeFi has been a pretty solid performer, and you just want to see activity, wherever the activity is, that's often where it is. We also really like Solana as well, the ability, it's the fastest blockchain of the majors, capable of up to 1 million transactions per second. So that in the future, we think will replace something like the NASDAQ, where you can then trade Apple shares with somebody, you can custody them in your wallet, and there's no other chain at the moment that's capable of doing that.
I just also add, I think that one of the critical things that regulators have struggled to get their head around, and I think it's part of the reason there's a lot of reluctance in general to the token economy, is that what kind of happened with the evolution of tokens as either, whether they be like an ecosystem, a utility token for an ecosystem, or effectively functioning as a quasi-equity piece for certain projects as well, is that it kind of removed the protections for retail investors that typical public market products have. And so until the regulators figure out a way, like, I totally agree with you that people should be able to move their shares one to another, and it should be autonomous. It should be a lot more efficient. It doesn't need to be intermediated all the time. But the problem is that at the end of the day, when people start losing money, they're going to blame someone. And so it's very important that there is some protections in place for retail investors to prevent that. That's a very non-crypto kind of mindset, by the way. It's very much about disintermediation in this sector. It's about freedom of choice. It's about being able to do things and use the technology for the best, for the benefit of however anyone wants. But the problem is that what happens is that people then pile into things they don't understand, and then they get caught losing money, and then they blame someone. And so I think, like, until that problem is solved, it's not really clear to me. I mean, maybe you guys have got a view on this, but it's not really clear to me how that problem is going to be solved to provide necessary protections for retail investors to ensure that they are protected in the event that they get access to things they otherwise wouldn't be able to see.
No, that's right. Is there going to be a walled garden and a casino? Potentially, right?
Yeah, I mean, some products are being built right now which are using biometrics like a Face ID. And so everything is sort of KYC'd. So when you transact, for example, I send you 10 CBA shares, my Face ID, your Face ID, and then it's sort of recognized and KYC'd. And those type of things are being built, but then there's concerns about privacy and stuff. So it's all going to get worked through, I think, over the next few years.
I think you already kind of started to touch on my next question, which is around the risk and challenges. So in addition to what you already just mentioned, are there any other additional risks and challenges still facing the crypto industry? And how can investors and companies mitigate these? And maybe just focus on one big one that you think that people in this room should know about.
I'll echo what Ed said. Right now, in crypto, it's still pretty easy to get hacked and rugged, as they say in crypto. So you would accidentally sign a transaction, and the transaction has malicious code behind it, and then before you know, all your money's gone. And because crypto is irreversible, once the money's gone, it's gone. There's no customer support or banking hotline that you can call to freeze the assets or recover it. That's the nature of crypto as a decentralized currency. I mean, it was built because it has to be outside the system. I think regulations are coming in to put in place things with real-time risk and fraud monitoring. Insurance is sort of coming in, so those things are being built. They aren't there today. But that's still the biggest risk. So there's an education aspect to it as well as usability. So the Face ID thing that I was talking about, a lot of the crypto people were anti it originally, but I think we're finding a balance between mild amounts of KYC with Face ID and freedom of transfer of assets and so on. So it's still the biggest risk, I think, is education and not getting hacked at the moment. So there's some work to be done over there.
Yeah, I think it all really comes back to regulation at the end of the day, just having a clean slate and a common base for everybody to work from. It's not going to stop all of the scams. Their scams exist everywhere. But hopefully it does there's still a lot of not particularly great projects in the top 20 market cap of crypto, and they don't have a lot of users, they don't have a lot of activity. It's not entirely clear what they're doing there, but they're great marketing machines, and people are still buying them without really understanding what they are. So I think education is also a big part of that too.
I would just say that I think that there's a perception of the risk of the quality of the service providers in the sector from people who are not in the sector. At the moment, there are a number of high-quality institutional-grade platforms, custody providers. I mean, like, part of what we're trying to solve in our firm is providing really high-quality institutional-grade trading for crypto, custody for crypto, derivative products for crypto, and then separately funds products as well. But I think that perception that there isn't enough support, like high-quality service providers, still exists, and I think that the best part about this kind of regulatory wave that's coming is that it's going to make a lot of those who are not yet in the sector realise that, one, there actually are some good ones in there, and two, there's going to be a lot more investment into that infrastructure, and hopefully that solves a lot of the security concerns. It helps kind of facilitate the next wave of allocation and the innovation that should happen as a result of that as well.
All excellent points raised. Now, this is the last rapid-fire question to our panellists. Looking ahead, what, in your opinion, is the single most significant development or trend that will shape the future of the crypto industry?
At the moment, I think it's the proliferation of stablecoins. Right now, still moving money is a pain. I think stablecoin is step one. Just like I mentioned, I should be able to transfer Apple stocks to you like a WhatsApp message. Stablecoins are level one of that. Once that gets a framework around it, then we'll move on to the next level, which is stocks, and then eventually private credit, other things will come on chain as well. So I think that's happening, and a very exciting thing.
Yeah, I'd have to agree. Stablecoins is the killer app really still for crypto. If you're in Asia, Africa, South America, you can now get your hands on US dollars, a much better store of value than whatever your domestic currency is, and that's super powerful. You can hold it in your wallet. You don't have to go and open a bank account, which you'd never be able to do anyway, and you can hold $10 of US currency.
I agree with you guys, but I'd also add, I think another major one is a Bitcoin reserve for governments. I think that is going to open up an enormous wave of corporate activity to kind of spur additional treasury management using Bitcoin as an additional kind of inflation hedge on balance sheets for those with a lot of cash. And what that will then do is it will facilitate further deepening of the derivative market and the quality of the services provided around that market. And I think as well, personally, that will also lead to a significantly higher Bitcoin price, which is only good for the sector.
I'll actually echo on the strategic Bitcoin reserve a little bit more. So they were talking about in the US, Trump promised it. We may still see it, but the US is also talking about a sovereign wealth fund, which the US doesn't have, like Norway has it, Australia has it. And I am 100% certain that Bitcoin will find its way into that sovereign wealth fund. The reason why is if you do the traditional portfolio management, backtesting Bitcoin, Sharpe ratios, max drawdowns, all of that, and you fit it into a traditional 60-40 portfolio, even if there's commodities and stuff in that portfolio, the returns are always better risk-adjusted returns. So even if the strategic Bitcoin reserve doesn't happen, I'm very optimistic that it'll find its way in the sovereign wealth fund in the US.
There you have it, Bitcoin reserves and stable coins. Now, we come to the end of our panel. Please thank our panelists.
Thank you to our panelists for the very insightful discussion. Up next, we have a presentation from FC Capital. Please welcome Christian Brem, the CEO of FC Capital, to the stage.
Hello, thank you everybody. I've been told I only have 8 minutes, so I'm going to make it short. I'm the CEO of FC Capital. Here, a quick disclaimer for us. And I don't want to bore you with what we are and what we do. I just want to tap onto the problem most people have nowadays and the potential solution we offer as a firm. As an investor nowadays, you have multiple problems. You have high volatility in the markets, which relate to high returns sometimes, but can also relate to losses. You have, as of the last couple of years, a lot of instability and uncertainty on a global level, which can impact us also in Australia. You often have the need of stable cash flows. Where do they come from nowadays? yes, our interest rates have gone up, but how do you generate a cash flow you can actually, count on and, get on a potentially monthly basis? And then in Australia, often we find that looking at various portfolios, there's a diversification issue. How do you diversify away from real estate and fixed income, leaving equity out for now? For the institutional investor class, it is also a J-curve problem. What is a J-curve? It's basically you deploy capital and the actual capital get put to work. That's mainly a problem for larger tickets which have been drawn over time and drawn on funds. So what is the solution here? We as a firm, we focused on private credit. Our FT Senior Credit Income Fund provides a solution for that. It's not a full solution. It is a solution as part of a portfolio usually. These are monthly paid cash flows, monthly paid distributions. Currently in this vehicle, which we offer in Australia, it's 12.65% annualized. It's net of fees, cash paid. It has a low correlation to the public markets, and that's something which most people often forget, that various products, even their fixed income, they are correlated to the public market, and the correlation has been shown over the last couple of years that there is a correlation. And an element in terms of what we do and what the rest of the potential market also doesn't do is we do not focus on real estate. Our main focus is corporate lending, asset-backed lending, and lending into receivable books. So meaning you have assets which are traditionally different to what you probably have seen in the other private credit markets, but these assets are in Australia pretty much untapped. In the US and in Europe, it's a fairly well-established asset class which outstrips the real estate sector by a fair amount. In this particular vehicle, there's no J-curve. If you commit and we accept, then the capital is deployed and will yield the relevant distributions. So that's a solution which we have, but let's just talk about performance a little bit and why this is a solution which might be of interest to a potential investor. You see in the grayed out strip is basically what we would probably call the private market segment. We have put in our returns, our historical returns, which we have achieved since 2017 across our pools of capital. We don't have to hide, and as you can see, we on a compounded level, you would have gotten 2.5 your money back. 2.3 times your money. In a non-compounding situation where you take your distributions, it's 2 times. So that's something which is fairly attractive, considering your money's out of the door for 8 years. Trumped is this only by private equity, but that has a different risk and return profile. So that segment in general is fairly attractive. In the past, the segment was mainly only accessible to institutional investors. That has changed over the last couple of years. In Australia, it is probably a fairly new asset class. We're talking 10 years, 12 years. This asset class around in the US and Europe, it's more than 10 years, 20 years. So large institutional investors have massively allocated and reshifted their books into this asset class because you have the stability, you have the returns, and you have a return profile which offers you various positive elements compared to a true equity investment. You've seen the other end of that chart, which is at the bottom. Essentially, we have a pure cash investment, we have an actively managed bond investment, and we have the ASX 200. Since 2017, they have performed, but you can see there's volatility in it, and they have not outperformed the private markets. So, not saying you should all put your money into private markets, but I think it's a consideration worthwhile as part of your portfolio construction. In terms of the advantages of private debt compared to equity and fixed income and other asset classes, I think you would look into getting stable cash flows, a reliable income. You have inflation protection, which is fairly important right now and was fairly important. You've seen our interest rates have gone up. Have your return gone up on the bond side? Yes, they have gone up, but if you have invested at the wrong point in time, your principal would have gone down. Further down the line, we have a capital protection mechanism in our investments, because they're senior secured usually, meaning something goes wrong, you're getting paid well ahead of equity, if there's anything left for equity in some circumstances, and the security which is there is registered. So basically you can rely on that the security is not just on a piece of paper, it's actually in Australia very easy to check in a PPSR register. So in terms of Investments. Over the last couple of years, we have seen that the pipeline and the demand has increased. So we can be fairly selective when it comes to investing in these opportunities. For us, and we will touch on this a little bit later, we probably convert 5% of the opportunities we are seeing, and that's more than enough at the moment. Overall, I think in Australia, the investment class, as I said before, is new. On a global scale, there's massive demand for it. The demand has been seen in the US, in Europe. The demand is basically swapping over into Australia right now. We see a lot of firms focusing on Asia, and then, where do you focus on Asia? First point of call is basically Australia. We see massive demands of capital coming into Australia, focusing on this particular asset class. The question is, how do we serve that and what do we do as a firm? We are focused, as I said before, on corporate situations, corporate lending, asset-backed lending. We usually target 13 to 15% gross returns. That's our standard at the moment. They were slightly low, obviously, 2 or 3 years ago. Our loan size are 5 to 40 million. We can go higher than that. We would probably bring partners on board. We focus on companies which are not institutional grade, so revenue profiles lower than $250 million. Typical terms are 2 to 5 years, and the returns as well as the interest paid is monthly. And it's cash paid. In terms of our AUM, we are managing roughly $1 billion at the moment across a couple of pools of capital. The majority of our capital comes from the US, to be honest. We are sort of building up the Australian pipeline as we speak right now because I think it's fairly attractive. Main focus is Australia and New Zealand. I would love to see more New Zealand opportunities, but we're only having 4% in our book at the moment, so it's a bit underrepresented, but that's probably the nature of the market. And the focus is senior secured. We look at mass opportunities from time to time, but to be honest, at the moment, mass is not really attractive. The risk profiles are fairly high. Execution takes a long time. Uncertainty of recovery. That's why we sort of have cut this out of our portfolio at the moment, mainly senior secured. Pipeline-wise, we are digesting as a team at the moment roughly $3 billion worth of opportunities in our segment, and that excludes property. The market opportunity. The market has been established in Australia 2018 via regulation, and I don't want to bore you anymore with that. The market is expanding as we speak, and our pipeline has doubled over the last couple of years. Just one sec before I get kicked off here. Our team is well established. We have 20 people in the firm, 10 investments. We have an organized approach in terms of how we invest, and the pipeline at the moment is 3.3 billion per annum. We have seen this pipeline growing on an ongoing basis, exceeding partially in terms of what we can actually digest or can deploy. I think if you want to have more information, please talk to myself. We've got a booth out there. My 2 colleagues, Danny and Georgia, happy to sort of give you a rundown in terms of what we do in more detail. Thank you for your time.
Thank you, Christian. Now we'll hear from real-time data. Let's invite Lang Solberg.
Good afternoon, everybody. You can probably tell already I'm not from around these parts. My name's Lang Solberg. I'm the US co-founder of Real-Time Data, coming at you from Seattle, Washington. And we build a solution for workers in harsh environments. And the solution has been strongly validated across 4 countries so far, along with the Walton family, who own Walmart in the US, whose family office invested in us a little bit over a year ago. Speaking candidly, this is the shit that people like fishermen have to put up with on the front lines every day. People are still on paper. People are still trying to fit Excel spreadsheets into their smartphones. While in this example, trying to drive a boat into 25-foot walls of water, keeping their crew safe on deck, trying to find fish to stay profitable. These are people's livelihoods. Their safety's at stake. And software has left them behind. Office 365, as I just mentioned, Excel on a smartphone, legal pens and pads aren't going to do it for these folks, and we've built a solution to address this problem. Our solution is 2 parts. One, a tablet-based application called Deckhand. Deckhand. 2, the customization tool that we call Catchflow, which is an integrated development environment that allows us internally, as well as third parties, our customers, independent software vendors, to build solutions on our platform for maritime, seafood, and other primary industries. Picture it like a car. Deckhand is the chassis. It looks the same in New Zealand as it does for our customers in Costa Rica or in Alaska. But Catchflow, our customization tool, is how we add the bells and whistles in the trim package. Our customers come to us regularly saying, we have a problem. We're going to build a custom app to fix it. But when we show them this, they quickly realize that they can do it for 30 to 50% less of the cost with a UX featuring a lot of bells and whistles off the shelf that are already tailored for the challenging nature of the environments in which they operate. Some of these achievements so far range from interesting data throughput metrics right here in Australia and New Zealand to verticals that we ourselves didn't imagine we'd be entering into just a few short years ago. And here are a few examples of customers who are already winning using our product, from North America's largest vertically integrated seafood company, Trident, to Dragonfly Data Science in New Zealand, the Nature Conservancy, and many others who all had a problem to address with difficult operating environments, workers who needed a solution that worked for them and not the other way around. Workflows that these customers are using on the Deckhand platform are solving problems ranging from regulatory compliance, dovetailing with AI models, collecting dockside samples, flying around in spotter planes, assessing biomass below, operating alongside cutting-edge hydroacoustic and electronic monitoring technology. The opportunities are really endless here. And they all had one thing in common. They needed this thing built for a very specific set of challenges that their firms and their workers faced, and they built it using Catchflow, and it was delivered on our Deckhand platform in a stable and consistent manner. Our solution doesn't just work in rugged environments, it freaking excels, to be blunt. Our user experience literally means that an operator can hit the tablet with their elbow, big buttons, vivid colors, while trying to keep their crew safe, trying to juggle critical tasks where people's safety and their own profitability is on the line. The workflow approach, which is decoupled from our core software, means that a customer's solution can evolve nimbly and rapidly with the evolving nature of their business. And we're experts in this. We're experts in the tech, and we're experts in the industry, in these primary industries, and we wake up every day absolutely loving the heck out of solving problems at this really interesting intersection of industries as old as time with software, with innovative software. McKinsey, as late as 2015, said that agriculture and other primary industries were laggards in digitization, but our customers are telling us they're ready. One corporate customer said that they know they have to modernize at all costs to stay competitive in the rapidly changing global landscape in protein markets. We know the opportunity extends well beyond fishing and seafood. We have an aquaculture customer in the pipeline right now who says, and this is a narrative that is a common refrain, we have a great analytics package, we have fantastic software in the back office, but our people out on the farms are using Excel on their smartphone, or they're still using pen and paper. We need something that works for these people and that can integrate with our systems. And Deckhand can do that. We've gotten to where we are today based on trust and quality. Quality as evidenced by less than a 1% churn. But we know scalability for our company lies in a product-led approach. And whereas we've built a lot of the workflows using our Catchflow customization tool in-house. We're now deploying it more and more to third parties to build their own workflows on the platform, and we see evidence of traction. Thus, the top row, which is where we're investing resources, people, and a lot of time to make that top row, the value-added reseller channel, our path to growth. The middle channel has been important. As I said, relationships are critical in business, as we all know. And marine electronics distribution, interestingly, has helped cater to customers in remote rural environments who often find themselves adjacent to billion-dollar resources that governments and firms need to take account of and keep track of. Our team is fantastic. Gary is a world-class technologist with a history of building and selling software to clients as big as Microsoft. And Brendan came to us from a company down in Adelaide, recently acquired by Honeywell. Our board, they're incredible and supportive and have global B2B exit experience. And we're here today asking for US $2 million in a seed round to help us primarily expand significantly our sales and our marketing pipeline capacity in our growth market, which at this point is focused mostly on the US, while also investing heavily in the platform, in particular the Catchflow engine, so that it can appeal to a much more diverse cross-section of potential customers across all the primary industries, well beyond just fishing and maritime. So please join us, join Walton and Builder's Vision, AC Ventures, and our fantastic team. Stop by our table. We'd love to chat with you more. And thanks for welcoming me to Sydney from Seattle.
Thank you, Lang. Next, we have the Ordre Group. Please welcome Simon Locke, CEO of Ordre Group, to the stage.
Thank you and good afternoon, everyone. Great to be here. I'm Simon Locke. I'm the CEO and founder of the Ordre Group. We're a fashion technology company, and I want to tell you about an investment opportunity, our latest technology called Authentic Vision AI. But this is a bit of a full circle for me because in 1995, around this time of the year, I stood on this stage and actually launched Australian Fashion Week, which was the first company we created here in Australia. I'm still the chairman of that great event, some 30 years later. But it started us really on a course of developing business-to-business businesses in the fashion industry, which eventually led us to the development of the Ordre Group and a number of fashion technologies that we have established. We operate primarily in the Northern Hemisphere, in Paris, London, and New York. But we're very proud to have a number of existing investors from here in Australia. We have a group of international investors, including Alibaba, who are very interested in our counterfeiting technology for obvious reasons. Chale's a big financial services company, SVK Crypto. But here in Australia, and we've had a number of our shareholders here with us today, Perennial, Alliston, Regal, and others. So if you become an investor in our company, you're going to be in very good company. We're also very proud that we've developed an incredible group of clients that use a number of our fashion techs. We've had a long history with these clients, high returns, some of the best known brands in the world, from Louis Vuitton to Balenciaga to Balmain to Michael Kors to Alexander Wang. And they've learned to trust us as a technology provider. And so in introducing our new technology, Authentic, it's really giving us a running start because they're already working with us. They already have a respect for what we do, and they continue business with us. So we've got a seat at the table with their innovation departments often. We have really been able to bring together an incredible team in the Ordre Group that I work with every day.
Many of them have had experience in the fashion industry. We're fortunate to have our CEO, who's actually based here in Sydney, Mark Kelly, he's outside manning our desk at the moment. He's a former publisher for Vogue and Marie Claire here in Australia. But also we have incredible technologists and engineers, and Stephen and Simon, who are ex-CTOs of the Activeport Group in London, a very experienced group in fashion technology. We've got people who have had specific experience with the luxury brands, people like Daniela Ott, who's a former director at Keyring, and has been the CEO of Aura Blockchain at LVMH Group. So this is the group of people that I work with every day. Special shout out to my co-founder and wife, Kirsten Locke, who's a former fashion editor for Harper's Bazaar, which really manages all our content, our socials, and making sure everything we do looks great. So let me tell you a little bit about Authentic. Authentic is really cutting edge technology. One of the biggest problems we have in the world in the fashion industry is there's trillions and trillions of dollars that are going into the buying of counterfeit products. And the luxury brands really want to protect themselves against this. They want to be able to say to consumers, you have bought an original product. And they've searched for a very easy to use consumer solution for many years, and we believe that we have developed it. A simple technology which allows you to, with any smartphone, basically scan a product and be told straight away whether it's fake or real. So you can just imagine the applications for that in the fashion industry. How the technology actually works is that in the factory, as product comes off the production line, we just take a small photo of a certain area. So it's just a photo. It's not non-intrusive, not putting a tag or writing a sign or anything. It's just a small photo. That image is then microscopically analysed to such an incredible degree that something like 20,000 points of reference enabled to be able to got just from a 1 centimetre by 1 centimetre digital image. You'll see some of the scanning and process here. That microscopic analysis is then transferred into a piece of code. That code is then placed in the cloud, or can be placed in the blockchain as a perfect match to that product. So all that's required is you to go to the area where the digital fingerprint is, scan it to see whether it creates a match with what's been recorded or not. You would have seen there some of our work with Burberry in the factory where we're digitally fingerprinting products. The luxury brands really love it because it doesn't interfere with their production. We're not having to add a tag or do anything other than just simply take a photo. It's very, very simple. The ecosystem of technology, while the end result is a super easy to use application, the back end, as you appreciate, is driven by AI and our visual recognition. It's very sophisticated, but from the consumer front end, it's very easy to use. And our tech stack includes an admin panel so that clients are able to control the digital fingerprints, who's interacting with them, and it has a number of apps, one that captures and creates the digital fingerprint and another one at the consumer level that allows consumers to interact with the product. This is all built. This is all working. We're already in field with this product. We've been doing pilots with Givenchy, which is one of the big LVMH brands, very successfully. We've done a great commercial pilot with Patou, again, one of the LVMH brands. LVMH is our biggest client within the group, and they were our development partner. They actually gave us access to a Louis Vuitton product and Givenchy to do our proof of concepts. So it sort of followed suit that they were one of our first clients. But we're doing a lot of work with them, and also a huge big pilot in Burberry. You'll see next door one of the Burberry scarves. It's one of the most highly counterfeited products in the world, and this is the first product that we've started to work with Burberry, because if you're paying €1,200 for beautiful cashmere staff, you want to be ensured that it's the real deal. We've been getting a lot of interest with the press.
particularly the industry press in the fashion industry, which has really enabled us to really explode our sales pipeline right now. And basically, that's what we're here doing. We're looking to raise another 5 million plus to accelerate the scalability of Authentic. We're finding it difficult to keep up with our sales pipeline at the moment. We need more operators in factories. We need more product development. And obviously, it's a great opportunity to maximise our marketing and sales. And so we think an investment in what we're doing is really valuable. And so you can get on board with us now when we see huge acceleration over the next 2 or 3 years. The great thing about the acceleration behind Authentic, it's not just visionary technology here. We've also got the wind of legislation coming behind us. So things that are really excelling with the market at the moment, no one wants to put an NFC chip or a horrible QR code on a beautiful luxury product. And so we've become a real alternative because all we need to do is take a small photo and then we can create the digital fingerprint. So a lot of people are using NFC chips. NFC's chips only last for a couple of years, then you've lost the connectivity with the product. Our digital fingerprints last for the lifetime of the product. Also, we're able to apply them to sunglasses, to jewellery, to watches, where NFC chips really aren't valuable in that area. In Europe, starting from next year, every single product in Europe is going to have a digital product passport. You're going to have to be able to scan the product to go to the digital product passport to give you all the information about sustainability, who made it, where it came from. And of course, Vision AI and Authentic Vision AI is going to be one of the primary data connectors. So this is really going to explode our addressable market, particularly in Europe, but this is going to flow through to North America and eventually Asia. And then there's multiple applications. We're working with Rolex at the moment for return fraud. Believe it or not, there's a lot of people that will buy a legitimate Rolex watch. They'll get a fake and they'll try and return it and get their money back. Rolex can't even tell if it was the fake. That's how good they are. But if it's got a digital fingerprint, they know it's the watch that's been sold to them. So that's one application in terms of return fraud. But we've seen a lot of applications for just connecting to DPPs and also just for consumer authentication. This product is real. So multiple applications, and we're targeting all these areas for growth. The wonderful thing about our business is that you just don't have to invest in an early revenue technology because our other technologies are well embedded with the luxury brands already. One of our most successful technologies is this one, Orb 360. The fashion industry had a huge problem. We need to, in one day, digitize our collections. We need them in 360 to use in virtual showrooms, to use in e-commerce. And so we actually invented a technology in this area which delivers great results. And this is used by about 300 brands around the world. It's already generating great revenues. So the good thing about investment with us, we've got established ongoing revenues and we've got huge acceleration with Authentic. I think my time is up. Please come and see us next door. We've got a number of products to give live demonstrations to you today. Thank you so much for your time. We really appreciate it. Thank you.
Thank you, Simon, very much for your time. Now let's turn to Old Quarter Coffee Emergence. Please welcome Amelia Hicks, the CEO.
Hello, everyone. Who here drinks coffee every day? Can I get some hands? Oh, look at you all. Is it 1 cup a day? 1 cup? Oh my God, barely anyone. I love it. 2 cups? Hello. This is getting into confessional territory now, but 3 cups. Can I get some hands? Okay, my people are here. So with responses like that, it is not a surprise that 70% of Australians drink at least 1 to 2 cups every day, and that is fueling a $3 billion market in Australia alone and $470 billion globally. So another quick question. Who knows where the coffee they drank this morning came from, or maybe the person who grew it? Oh, literally no one. Oh, just one guy, thanks. Who knows if the person who grew that coffee had a sustainable livelihood? Yeah, nobody. Because the thing is that as consumers, we just don't know. Got to figure out my clicker here. So in the global supply chain, consumers really do lack the traceability to know if the coffee that they are buying is ethical. And then on the other side of the supply chain, the farmers who actually grow this amazing product, they lack the stability and the pricing that they need to thrive. They lack what they need to have sustainable businesses. But at Old Quarter Coffee, so we source 100% of our beans directly from smallholder farmers across 7 unique Asian origins. And amazingly, this gives us an exclusive product range that's available nowhere else in Australia. We go direct, we cut out the middleman, and we build these long-term relationships with farmers. So with our vertically integrated supply chain, the great thing about it is, welcome friends, come on in. The great thing about this vertically integrated supply chain is that everybody wins. So it's like win, win, win. Consumers, they get traceability. So they get that to know where the coffee comes from. They get to feel connected and a part of something bigger. They get to know that that daily ritual that they do 3 times a day is actually doing good in the world. And they get to taste rare coffee. So consumers, they're winning. And our farmers, our farming partners, they get stable pricing, they get fair pricing, and they get an opportunity, to change their lives. And then Old Quarter. We get an amazing competitive advantage. So we get the stable pricing, we get the brilliant quality, we get an exclusive product range, and excitingly, we get this brilliant brand story to share with our consumers. So I'm Amelia. I am the CEO and co-founder of Old Quarter Coffee. I actually hate being behind a lectern. It's very uncomfortable for me, but I'm making it work. My co-founder and my partner, Yos, and I, we spent a decade in Asia. And we were living and working there, and yeah, it changed us as people. It changed the trajectory of our lives. And when we fell in love with coffee, we actually, firsthand went to the farms and we experienced the challenges that farmers face. And we were driven to start a company that would solve that problem for farmers and, ultimately give back to the people and the places that had really given us so much. And so in 2017, Old Quarter Coffee was born. And since then, we have been scaling fast. So we've grown 10 times the industry average. We have grown from just one little baby pallet of 700 kilos to 45 tons in 2024. And we've generated $1.23 million of extra revenue for smallholder farmers and ethnic minority people across Southeast Asia, something that we are so, so proud to have done. Our wholesale business is also thriving, so don't get scared by 0%. That actually just means that we have never lost a wholesale customer to a competitor. And we've been growing 46% year-on-year average for the past 5 years in the wholesale business. Our venues, they are also doing amazing. So they're actually profitable within 5 months, which, if you know much about our industry, is very fast. Great, so our business model, our Australian expansion, so we import the coffee, we roast it ourselves in northern New South Wales, near Byron, but don't judge us. And then we sell that coffee to 40 wholesale customers across the east coast of Australia. We have 4 company-owned stores, and we've got a thriving online business as well. You will see that all of these channels are EBITDA positive. Very healthy percentages, just take note there. Cool, so what is the competitive advantage that sets Old Quarter apart? Really, if you boil it down, it's the trust and the loyalty that we've built at every step of the supply chain since we started. It's a trust with partners and the customers here in Australia. We have never lost a wholesale customer to a competitor. We have 5-star reviews across every venue and just loyal people who really believe in the purpose of the business. But that trust and that loyalty is also the reason why our competitors between 2023 and 2024 experienced up to 40% price increase. And Old Quarter experienced just 1%, because they don't have the relationships that we have built over the past 7 years. So like while others in the industry are really flailing, I would say, with the chaos in the supply chain, they also have disruptions, quality issues. We just don't have that. We're insulated. Okay, so I've told you a little bit about who we are, and now I'll talk to you about the investment opportunity. We're in a safe note round. We're raising 1.5 million, but we've already raised about 1/3 of that, and we're going to use that money to continue to scale our Australian business. So we're going to go from 4 to 6 of our profitable venues, invest in Green Bean, this premium product, enough supply for us to keep scaling, and we're going to triple our production with a new roaster. We'll also invest in marketing, which is going to help with the brand awareness and the customer acquisition. This is a very unique opportunity to join us before our valuation increases, and so we're offering a 20% discount on the next priced round and a 7.5 million valuation cap. I will just say that this is very much a stepping stone to our Series A raise. This is about taking Australia to the next level, but we are gearing up for a much bigger global expansion. Cool, so what are we going to achieve? The thing is, we've been growing fast and we want to continue to do that. We're going to take what is really profitable channels and just take the Australian overall company to that profitability. I'm doing good on time, I promise. I'm going to be done in about 30 seconds. So just super quickly, I mentioned this is a bridging round. Series A is coming in 2025. We already have a joint venture partner already located in Laos. We have a land partner. We have a farm site selected of 200 hectares, and this is going to enable us to properly vertically integrate. It's going to allow us to take advantage of the global green bean demand that is not going away. So we're going to set up our export hub. We're going to be able to export to ourselves in Australia and waiting customers that we already have in the Middle East, in America, in Europe, and also in China. And that 47 tonne that I talked about before that we consume in Australia, one customer is 100 tonne waiting and ready. Just one purchase from one person. Also, Laos will be the home of our first Old Quarter venue in Southeast Asia, but it will definitely not be the last. So we are experts at rolling out venues, and we're looking at testing that in Laos, and then we will take that to neighbouring markets, starting with Vietnam. So this is just very much the beginning of our journey. So why invest in Old Quarter Coffee? Very driven, committed founders at the helm of this company. We have a proven track record of growth over the past 8 years, and a product moat around us, you know, with 7 unique Asian origins, of which you do not see anywhere else in Australia. Loyal business relationships that insulate the entirety of our supply chain, and global expansion plans very much ready to execute. And ultimately, this is a very timely investment opportunity for you to join us before we scale even further. So thank you so much.
Thank you, Amelia. I feel like I'm the time monster today. Let's welcome back Ryan McMillan, the CIO of Merkle Capital, to the stage.
Hello again. Ryan McMillan, Merkle Capital. We run the MTC Digital Asset Fund. It's a high conviction, long only liquid crypto fund. It was actually the best performing fund in Australia last financial year. So I'll talk a little bit more about performance later, but I also want to talk to you about Bitcoin, about changes in US policy recently, about our fund's investment approach and why a fund structure can make a lot of sense to investors. Yeah, so let's dig in. Bitcoin, you know, it sounds cliche, but Bitcoin is a new paradigm. That's why nobody intuitively understands what it is. I think a really good framework is to break it down and compare its qualities against some similar types of assets. So gold and the dollar here. You know, for a long time we've had the US dollar and the gold. Gold has been a better store of value. The US dollar's lost 98% of its value against gold over the last 100 years. But gold is very hard to move. It's quite expensive to store. And it's not very divisible either. So there's a bunch of qualities here of these different assets. US dollar, on the other hand, very easy to move, very easy to store, highly divisible, but supply is unlimited, which is why it's lost so much of its value. It debases at around 8% per year, where gold is closer to about 2%. And there's a lot of work, obviously, in digging gold out of the ground. Then along comes something like Bitcoin. So the supply is fixed, which makes it actually more scarce than gold. So it's actually a bit better at gold in terms of scarcity. So that makes it a better store of value. And it's also faster and cheaper to move than the US dollar. So we think it's not unreasonable to think that a lot of money can be attracted to this asset class. We like to think about it in two phases. So the first phase will be Bitcoin being used as a store of value. And as price increases, its volatility will start to reduce, and then it will be started to use as a global reserve currency as well. So that first stage, what does that look like? If 18 trillion of capital has already been attracted to the gold market, we don't think it's unreasonable to think a similar amount can't be attracted to a better store of value, which would take the Bitcoin price to $1 million or so, around that mark. Once that'll take a few years, a lot of estimates around 5 years, maybe around that time period. Once that happens, the volatility will start to come out. You'll have a serious asset then that's worth 18, 20 trillion, and then you'll start to see that sovereign adoption in terms of a global reserve currency, because not only does it have these qualities, it also doesn't have that counterparty risk. It's not somebody else's debt. It is. It has no sovereign risk, so and it's faster and cheaper to move, and it's open 24/7. So there's a lot of benefits and reasons why you would naturally move towards it. In the US, obviously, we've had a big election recently, and this was really big news for crypto. What sort of has come out since the election is that the Biden administration was covertly hostile towards the industry, debanking participants, not providing rules, and sending Wells notices to pretty much any crypto startup. So what we're going to see now under Trump is clearly quite pro-crypto. The difference is going to be from night to day, so a really huge boost for the whole industry. Trump also benchmarks his performance in terms of asset performance. So he has benchmarked himself against the S&P. He'll say, look, his equity market's flying. You're welcome. That's me. He's also mentioning Bitcoin in that same sentence now and repeatedly doing it. So he sees Bitcoin being higher as a benchmark of his success. So we think that's certainly worth keeping an eye on. His focus is still there. We talked about a Bitcoin strategic reserve a little earlier. This is what's happening in the States. So the States are also exploring a Bitcoin strategic reserve. There's 32 at the moment that are considering it and passing it through the legislative process. Not all of them will make it, clearly, but we think a bunch will, and they could be as meaningful an impact as the actual federal strategic reserve. We haven't heard much about the federal Bitcoin strategic reserve since the election, or even Trump taking office. And I think that's probably been a little bit of a headwind to the market at the moment. So we do think that to implement a Bitcoin strategic reserve, you actually have to do it strategically. And on day one, if he was to come out and say, we're going to buy 1 million Bitcoin,
the whole world would front run him, and so that's not really strategic. What I think is more likely to happen is the recent announcement of a sovereign wealth fund gives the Treasury and the executive branch more ability to start their own crypto holding and turn that into a strategic reserve. We know who's running that strategic, that sovereign wealth fund, Scott Besson and Howard Lutnick, who are both big Bitcoin and crypto believers. So we think it's pretty certain that that will happen. And I think the states also, are giving you a pretty good hint on where they think that the federal system is going to go to as well. Oh, and also the SEC. So I want to talk about the SEC. Obviously, they've been really hostile to crypto for some time now. Under Gary Gensler, that anti-crypto agenda is now finished. We've seen already a repeal of SAB 121, which effectively kept Wall Street banks out of offering crypto services. They're already into the market pretty quickly, and offering, bringing Bitcoin to a more financialized state that you can actually use it as collateral. So that's a really big move, and we think that and a positive SEC, we'll start to see a lot more IPOs this year, a lot more M&A, and a lot more activity now that participants can actually operate in this sector with confidence. So why invest in a digital asset fund like the MTC Digital Asset Fund? You get to leverage professionals' expertise. These markets operate 24/7. They're obviously highly volatile. They're fast-moving and really not suited to part-timers. So professionals are better able to find the alpha that is out there as well. So, and there's a lot of that. There's a real information discrepancies out there as well. So professionals are better able to unpack that. The other benefits you get from a fund are obviously institutional custody. You don't have to worry about keys or wallets or these different counterparties. That's all wrapped up in one simple solution for you. Asset selection is also pretty tricky for most people as well without having the time to do that research. And obviously simplified tax reporting as well. If you're staking assets, there can be daily transactions, and if you're doing that within your SMSF or wherever it is, your accountant is going to get a hell of a lot of transactions in a fund structure that's all wrapped up into the one spot, and you just get your unit price moving. We like to pitch ourselves as the most conservative way to invest in crypto through a fund. So what does that mean? It means, we're high conviction and we do a lot of deep research, so we have a really strong belief in all the assets that we hold. We focus on the top 50 assets and don't really go out into the VC space, which has lockup and liquidity issues. We also don't use leverage or take short positions, so and we're not traders, so we think this really is a really simple way to investors to get good exposure to the asset class and really set and forget from their perspective. So just briefly on performance, performance has been really good recently. The last 2 years have returned over 100% since the start of inception for that A class. So it returns nearly 250%. And yeah, please, thanks for listening, and please come and have a chat next door to myself, Dean, or Asha. Thank you.
Thank you, Ryan. Our next company presentation is from our sponsor, Chefin. Let's invite Petko Petko, the CEO of Chefin, to the stage.
Thank you. Okay, this is working. Perfect. Hey guys, I'm the founder of Chefin, and we are a booking marketplace for private chefs. We've been running for a while. We've got over 6 million of revenue, and we want you to actually invest in entertainment. Entertainment can be turned into investment with Chefin. We are powered by a really, truly amazing community actually of private chefs and individuals. We change people's lives. We've had people meet their wives through dining experiences. We've had chefs save and open their own businesses and flourish. We have chefs traveled across the whole of the United States or around the world to actually cook for individuals, and we are quite proud of it. At the moment we are doing a crowdfunding race and also a wholesale investor race as well, so everyone is welcome to join on the journey. I want to talk today about the dining revolution. The world started dining for a very long time, obviously. Everyone's been eating at home with mums and grandmas cooking. But in the 1800s, the first restaurant sort of appeared formally in France. And then it sort of moved into that digital fast food economy, everything moving really fast, and then into the digital e-commerce economy where you can order takeaways and order things online. And today, we're really about experiences. People want to actually feel connected, they want to have memories about a particular experience and something that they'll relate to in the future. Our customers like to say that the way we make them feel and the way that we make them sort of look impresses their guests and makes them feel special and memorable, and these experiences they talk about for many years to come. We have one of our really cute customers, Kelly, in Kellyville, actually, in the Northwest. She orders a private chef every year for Christmas, and it's the moment that the whole family waits for with excitement. They pop up some lollipops, they have their own little branded cups with the name of every person on the cup, and they celebrate with a private chef every year, a family Christmas. It's amazing. Yes, as I mentioned, we've done 6 million of revenue so far. We're running on 1.4 million ARR every year, and we're growing up 700% in the US. Something that's really interesting for us is that we notice all the luxury brands around the world actually starting to play into this space. We've got LVMH purchasing a fine dining restaurant in France. We've got Armani and Bulgari owning hotel chains and getting into the luxury hospitality space. We've got obviously Apple inventing the experience stores and then everyone copying them, from like Tesla to Cupra and to Microsoft and everyone else wanting to actually do experience stores. And then very interestingly, we've also got the Vogue Cafe here launching in Sydney in Darling Harbour. So all of these brands are sort of trying to dip in into the experience space, into the hospitality, and connect with consumers on another level. We are the experts of it, and we've been doing it for a long time. It's a very big market. I think not many people talk about it, but we have a very niche and very targeted audience. We are targeting billionaires and millionaires around the world, the top high net worth individuals. This population is actually growing. It's more than doubled in the last 20 years, and it's going to increase by another 19% in the next 4 years. So our market is growing. It's worth over 140 billion. And it's a very, very nice and attractive market. What is the really interesting part of it is that there's no one player that actually dominates this market. So we're here to actually shake it up, dominate the market, consolidate it. We've already started purchasing little businesses. We tried to enter the US like in 2022. It took us like almost a year to actually get to establish a footprint and convert deals there. And we did that by actually purchasing local small businesses, onboarding them into the platform, digitizing them, and turning them from little catering and individual chefs to a private chef marketplace, basically. The other thing that is also interesting about the market is we have around 2 million millionaires in Australia and 25 million, so almost half the world's millionaire population is based in the US. So the US is a huge market for us that we are targeting. We're growing every week. We have 13% weekly growth, and the experience economy is very highly profitable. In comparison to traditional hospitality and old school businesses, where the margins are shrinking every year, your rents are increasing, it's harder to actually operate. We have very stable and increasing profits year on year, and we are able to self-fund ourselves. We have 12 months runway at the moment. We are cash flow positive. We've grown ourselves to Hong Kong. We've expanded to Brazil, and we are almost launched in France. We've done the website, and the tech is adjusted, and we are ready to launch in France, basically. So what we need is capital so we can scale. We have a really nice order value. Average order value is $2,465. We have a very strong luxury brand with a great presence across consumers, very high NPS, 90 NPS, satisfaction on every booking. 60% of people actually come back to us and tell us what they've experienced, and it's all positive feedback. So really enjoy that. We had negative feedback in the beginning. We learned from it. We improved a lot of things in the platform. We improved how we actually match customers with guests. Our real sort of mod, if you want to call it, is how we actually match the right chef with the right customer. It's a very complicated process that we've digitalized and created an algorithm for. And at the moment, we have around 98% success rate on matching the right chef to the right customer and creating the right menu from the first set go, which is amazing. So we've built that in our tech. We've served over 110,000 people, 117,781 as of yesterday. We have 1,035 chefs when I checked, and we have chefs across 116 cities in 16 countries. So we're ready to actually launch in these countries. We've got the landing pads. It costs us around $250 to actually acquire a customer, and that gives us a 10x return on every dollar that we invest into the business. From $250, we turn it in $2,465. So it's a really good return on investment. We've been doing that ourselves with bootstrapped cash. We've been growing significantly like that. And another thing that is really interesting for us is that we have a very strong referral growth engine. All the customers that attend and the guests that they invite are potential customers for the future. They get to know about the brand, they connect with us, they may attend multiple dinners, and we usually have around 3 referrals on average from every single dinner that we do. So you do 1 booking, we take cash, we get 3 future customers coming through. So it's a great opportunity to actually scale the business. We make $4,000 over the lifetime of a customer in pure profits. That's around $12,000 in booking value. Customers stay with us for 9 years, 6 years, depending on the customer, and they book every year around 1 to 2 events with us. Our customer acquisition to LTV ratio is 7, as I mentioned, so it's really good. I've got a really sort of pretty chart here, which can be a little bit confusing, but it's a really interesting chart because we've actually spent a lot of time validating what we're doing. We've spent time to understand the industry, to learn about the market, to learn about chefs and the customers and the hospitality in general. And we are now into the scaling stage where we know what works. We have clear path to profitability because we're bootstrapped at the moment. And we also know what our return on customer acquisition is. We're looking for $3 million in growth capital. We invest majority of the capital into acquiring customers and growing across different regions, 36%, and then 20% in engineering to actually continue improving the product based on customer feedback and be able to launch in new markets. And then we want to have some cash for cash reserves and also for corporate partnerships and hiring people. We've got a very good diversified team, many years of experience in IT, market research, customer experience, and branding. And we are based across the world. Luigi is in Italy. Marek, Suki, and I are here. We have team in Poland, and we also have team in Brazil and in Austin in the US. And we are offering a bit of a sweetener. For anyone that invests over $100,000, they'll get a lifetime chef supply. So every year you're going to have a chef coming to you and cooking for you for a birthday party, anniversary, or whatever you want, once a year. So invest and turn entertainment into investment. Thanks, guys.
Thank you, Petko. We now turn our focus to private credit investing in 2025. To discuss opportunities and trends in the space, we welcome Brett Craig, Director of Private Credit at Ordre Group.
All right, good afternoon, everyone. Obviously, some really exciting equity investments there that can be made. We're going a little bit more vanilla with some debt investing now. And obviously, look, private credit's been growing at a pretty rapid clip in Australia in recent years, and we've been there for 8.5 years in the sector. And most of the team who are here today are out of the banking sector. So I think we've seen some interesting press in private credit. I think there's been a really strong focus on returns, and now we're starting to see the shift into what risks you're actually taking to generate the return, which we're very happy about because as a team coming out of the banking sector, we are used to measuring risk, quantifying it, and obviously disclosing it to our investors. So as a business, we started 8.5 years ago. My background, I was at Macquarie Bank for 11 years before rolling out to start this business in a joint venture with Ordre Group. From a standing start, we're now managing over $1.1 billion in assets. Our wholesale fund has returned 9.63% per annum since inception on a compounding basis. And while doing that, we've retained a $1 NAV. We've also been the top performing fund in APAC for 22, 23 and 24. And what they take into account there is not just your outright return, but also your Sharpe ratio, growth, etc. Back to the team. So there's a team of 7 of us within Aura Private Credit and over 61 years of experience there. So what's the thesis? And look, I think we heard a little bit about this with the FC presentation earlier. Australia's in a really nascent stage with private credit. So if you look at Europe and the US, they're markets that are very mature. So over 91% of lending is done in private markets in the US, so 9% in the banking sector. 65% in Europe is done privately, whereas Australia, 9% of lending is done in the private market. So you can see when you look at those global peers, we've got a very long way to run in the Aussie market. The other point to note, and this was something that was really fundamental when we started up the business, is the funding gap. So post-GFC, Australian businesses in that SME to mid-market corporate space have had reduced availability of capital. That's a real problem. The SME market employs over 70% of our workforce, and as seen during COVID, it's really the backbone of the economy. So what we're looking to do is raise capital and deploy that into Australian business lending, and we do that through what we see as best of breed Australian business lenders. We've screened a significant number, coming up on 200, and we're funding 8. Now, our core objective as a team is to preserve capital. So, unlike some of the VC investments, which will provide you a 10x potentially, we are there to have stability of your capital. That's our core objective, and then provide an exceptionally strong risk-adjusted return. And in doing so, we've returned over 9.66% this year and 9.63% with no capital volatility since inception. And one thing I'll note is we do impairment test the portfolio on a monthly basis, and that is audited by EY. So we adhere to the accounting standards on valuation. Now, one thing we didn't do, or we didn't set out to do when we launched the vehicle, the wholesale vehicle, was to compare ourselves to equity markets. But fortunately, our performance has been strong enough that we've actually exceeded equity markets for the majority of our life. So if you look at the ASX 200 on an accumulation basis, we've basically matched the returns there since inception with no volatility. Now, the other proxy that you'd be looking at within your portfolios is either fixed income, general fixed income markets, or your high yield index. And as you can see from when COVID kicked in back in February 2020, fixed income markets, particularly in that high yield space, came back significantly and have not really recovered. We've been able to sort of truck through that. Now, the next thing is just that consistency of return. So what investors should look at with our asset is a vehicle where your objective is limited movement in your capital base and then that monthly income. So we see our assets as being pivotal or a real core for particularly superannuation funds or retirees who are looking at income within their portfolio. Or for younger investors who are looking at building out their portfolio, this is a real growth engine where they're able to fund capital calls in VC funds as an example. Now, one key differentiating factor in what we do, we're very much focused on diversification. So it's a spreading of risk across a broad number of industries, geographies, and loan types within our portfolio. So we've currently got exposure to over 13,900 loans within the portfolio. So if you're looking at a lot of other private credit providers out there, they'll have fairly lumpy portfolios. What we're very much focused on is spreading that risk. So one of the biggest risks we see in all credit markets is sort of deep, prolonged recessions and the impacts that will have on a business's cash flow. When you spread that risk over a broad variety of industries, geographies and loans, you mitigate a lot of those risks. Now, the other thing we don't do is property development. You'll see there we do have exposure to the construction sector. So our industry splits are based on ANZIC codes, so that's the ABS codes. And if you look at construction, it's a very broad category. So it'll take anything from your local plumber through to Lend-Lease. What we do with the construction lending that we're completing is predominantly property backed, so that's a completed property, not under construction as your security. 95% of our construction exposure is property backed. Now, the other thing we don't do is unsecured lending. So we have some form of security on our lending. So that'll be general security agreements, personal guarantees, property, assets, invoices, livestock. We do legal disbursement funding also. We're very much agnostic on the loan type. So we're currently funding 8 lenders in market. So as I said earlier, we've screened over 200 and we've funded 8. So a circa 4% hit rate on what we'll fund. We're very selective, and as I said at the front end, we are not here to provide you a teens plus return. We're here to provide a 9 to 12% return, and our target is to provide capital stability there. Now, we've got a very robust analysis of lenders. We look at it from 2 main lenses. One, what characteristics does that business have? How well capitalised they are? What's board composition? The players, so the people within that business, are they well qualified? Do they have a credit background? What has their track record been like? And then we look at a more fundamental credit analysis, looking at their risk policies, procedures, and we build a lot of portfolio parameters to protect capital within a structure. So one of the key benefits of warehouse financing, which is what we get involved in, is that the lender will always have some skin in the game. So that'll be their NIM, their fees, their equity capital at risk to a level. Now, one key differentiator with respect to warehouse financing versus direct lending is you do not get that layer of protection. So you'll see direct lenders out there who will deliver you a higher return, but they are missing that critical layer of protection that we have in our warehouse facilities. And then looking at risk, so once again, taking that bank lens, we've actually engaged for $250,000 a year. We've engaged an external party to assess each of the 13,900 loans in our portfolio from a default perspective. From that point, we run over 1 million simulations on a monthly basis across those loans and derive a loss given default. So what that comes out to is within the Aura Private Credit Income Fund, an investor could expect a negative return in 7 in every 1,000 years. Now, to put that into some context, in equity markets, an investor would expect a negative return in 1 in every 4 years. So just looking at that volatility measure, it's fairly different. And if you bring that back to a public market sphere, coming out at a current BB level, and look, as a team, we've got an objective to push that towards a BBB internally. So looking at it from a risk-adjusted returns basis, we're getting outsized returns when you compare that to public markets with monthly liquidity, monthly income. So a key differentiator in what we do. So if you have any questions or if you'd like to invest, please get in contact with us. You can contact us through the Wholesale Investor platform or directly with our team members. So thank you very much for your time. Have a great afternoon.
Thank you, Brett. Today we've been discussing different market opportunities and trends from fashion, food, real estate, and crypto. And our next presenter is another interesting one. Please welcome Clive Mayhew, CEO and founder from Golf.ai Investor Club, to share their vision and innovation.
I took a set up some tech. I'm the only one who's prepared to do a live demo. How good is this? Okay, are we ready? Can we just check? Sorry, I just said I'm the only one prepared to do a live demo, so I'm just putting up some tech. Okay, are we ready just to check this, please? Okay, thank you.
Hi, I'm John. Can I help you book your upcoming golf round in Spain?
Thank you. This microphone, thank you. Guess most people are asleep by now, so I'm going to wake you up a little bit. Four. So imagine, ladies and gentlemen, I'm standing on the 18th fairway. I've just hit a wonderful drive. I can see the pin. I'm 3 shots from making my record score of 74. But I'm unsure about the ruling because the ball's next to the sprinkler. It's a tricky lie. Which club do I pick? The wind is blowing. Certainly, you're on your phone. The wind is blowing, caught you. How far to the bunker left? What do I do? Now imagine having a caddy, a rules expert, and a performance coach all in my pocket. You ask them a simple question just by talking through your headphone or your AI glasses. It answers in your ear, clarifies the ruling, gives you the confidence to make the shot. It recommends an 8-iron. Its final suggestion to me is pause and breathe. I've just hit a cracker of a shot. Come on, for Pete's sake, I've just hit a cracker of a shot. Hey, thank you very much. And the reason being is my AI caddy from Golf.ai. And you're all looking at me going, he's lost the plot. My AI caddy is live today. It's being used by over 1,000 golfers around the world, 40,000 golf courses, in 29 different languages. Good afternoon. My name is Clive Mayhew. I'm the CEO and co-founder of Golf.ai. I want to change it now because I want to talk a bit seriously about what I call interactive AI. How many people here use AI every day? If you're not, you should be. If you're not, you won't be here next year. It's simple as that. I'm going to talk to you about interactive AI. It's a definition of AI which particularly is relevant for the consumer space. Imagine a future where your devices become your personal caddies, coaches, and strategists, intelligent enough to not only follow commands, but to truly understand your intentions and adapt in real time. AI understanding your intentions and adapt in real time. That's what I call interactive AI. That's what we have right now with AI. So my AI caddy example I gave before, what's my best shot here? My intention of my shot. Am I entitled to relief from a golf rule? That's the example I gave at the beginning. Your AI caddy assesses the wind, the lie, the hazards, your play history to recommend clubs and strategies. It uses GPS course mapping to instantly provide accurate golf rules. Intent-based coaching, intent. Instead of it looking at your stats, the AI says, did you just hit a fade? Did you just hit a fade? gives you feedback on your intent, not just the result. Again, I use the word interactive AI. So let me introduce AI Tee Times. Tee Times in golf is a $20 billion opportunity by itself. Yes, over $20 billion per annum is spent booking golf tee times around the world. How do people book today, and how much time does it take? Have we had anyone who's booked a tee time recently? Simon, how painful is it? Painful. It's so painful. It's time-consuming and painful. Using AI Tee Times, you simply ask it to organize a trip with my mate Peter and our 2 wives in August to Tasmania. I'm going for 3 nights away. We're going to have 2 games of golf, a 5-star hotel with sea views. Tell me what's available. It comes back with the itinerary, tee times, hotel, and flights for your dates in August that work for you based on looking at your Google Diary. It also then, it asks if you want to reserve them or talk to Peter first. It sends Peter a WhatsApp message. It adds the itinerary to your wife's phone, etc., etc. That's what's coming with interactive AI. It's the future. How long away is that scenario? Well, we're building it right now. We're building it right now at Golf.ai. Initially, it will book your tee times, then it will book your travel services to follow. How is this possible, you might say? It's really all about building API integrations and developing what we call smart booking agents. That's what we're doing at Golf.ai. Currently, we're working with 5 API partners around the world, Dubai, Europe, USA, and here in Australia. I'm going to demo a really fun demo about booking tee times in Ireland, Spain, and Portugal in a minute. Our first pilots go live in April. Our goal is to have AI Tee Times fully working by the end of Q2 around the world. So let's do the demo.
Can I help you book at your upcoming golf round in Spain, Portugal, or Ireland?
John, I want to go to Portugal on the 16th of September, play golf with 4 people in the morning.
I can help you with that. In Portugal, we have the Quinta do Lago golf courses, which include the South Course, North Course, and Laranjal. Would you like to play at one of these courses? Let me know which one you prefer, and I can check the availability for you.
Let's play the North Course, please.
One moment while I search for tee times at the North Course in Quinta do Lago for September 16th, 2025. The North Course is known for its challenging layout and beautiful scenery.
So you can actually, it's actually a US number. I was demoing it at the PGA conference a couple of weeks ago, so there's a bit of a lag between the call with the US. But you can understand the concept there. That's using an AI tee time booking agent. That's what we're developing. We're going to develop it so it's not only a telephone service, it's a WhatsApp message as well. So you can actually use WhatsApp for AI tee times. It's what we call in the AI space an AI agent. And it's very, very exciting technology. So interactive AI, we have AI Caddy, which is live and being used today around the world. We have AI Tee Times, which are coming in Q2. Connect the 2 pieces of software together. We call these AI agents. So when you arrive at the golf course, we know your tee time and when you are playing with and who you're playing with today. 30 minutes before you tee off, Our software agents talk to each other. Our AI Tea Times connects with our AI Caddy. The AI Caddy then welcomes you to the course, tells you the weather, says it's going to rain, suggests you pack your wet weather gear and your umbrella. He excites you with an overview of the first hole. You're ready to play. Interactive AI, it truly is a game changer. Golf becomes more intuitive, accessible, and connected. AI doesn't just make golf easier, it makes it more human-centered, enhancing creativity, strategy, and social connection, all while preserving the soul of the game of golf. Welcome to Golf.ai. So I want to just say we've started an investor club. We're raising $1 million in this round. We're making an investor club for a purpose. It's going to be people like you investing $40,000. We're looking for 20 investors. We want a true club of investors. We'll play with you golf once a quarter. We'll give you an update on AI. We'll connect you to the AI community. And we'll also have fun doing this. So that's in the investor room right now. Please connect to the deal room. Send me an email at the deal room. I'll connect you in. We'd love to see you as part of that. Thank you very much. And thank you again for your time.
Thank you, Clive. Next, we have Oz Premium Finance. Let's invite Carl Kirsten, founder and director, to the stage to present their latest advancements.
Excellent. Thank you for having me today. There we go. And that. Good afternoon. My name's Carl Kirsten. I am the founder of Oz Premium Finance, a new insurance premium funder that has recently entered the commercial insurance market in Australia. We are offering a fixed term investment with monthly interest payments at a reasonably low risk. I'm a barrister with trial experience in the state and federal courts. Over the last 10 years, I've worked in the business and finance world. My family was involved in finding and starting the Millennium Coal Mine in the Bowen Basin. I've helped run and sell a family radiology business and a venture capital fund. And recently, I've co-founded an international bank. All these experiences have led me into the insurance premium funding world, a commercial lending market with historically low default rates and high returns. Oz Premium Finance provides stable, long-term investments for wholesale and sophisticated investors. We do this at an investment-grade counterparty risk, that is, a reasonably low risk. We are seeking risk-averse wholesale investors that are after low-risk, stable investments that pay a monthly debenture. We suit investors looking for long-term opportunities. This is an investment that you can sit back and forget about, like a bank term deposit. And like a bank term deposit, we seek a fixed term investment. Ours is 12-month terms. Please ask yourself, are you a wholesale investor? Are you looking for a high yield cash investment? Do you want that high yield to be a low risk? Do you want a stable monthly income from your investment? Are you happier with longer term investments? If you tick a few or all of these boxes, then please consider Oz Premium Finance for your next cash equivalent investment. What is insurance premium funding? You all have probably seen at the bottom of your commercial insurance bills an option to pay in 10 monthly instalments. When you choose that option, an insurance premium funder then pays your insurance bill directly to your insurer. Insurance premium funding is an industry approaching $8 billion in revenue in Australia. It currently covers 35% of insurance premiums, and that figure is rising. It is rising both in real dollar terms and in the percentage of the industry. We all know insurance premiums are rising every year. As our insurance bills rise, more and more people are choosing premium funding to pay their insurance bills. Businesses like it because it helps with their cash flow. For the business owner, it is an extra form of credit that is easy to apply for and easy to use. Every year, more and more people are electing to use premium funding as their method of paying their insurance premiums. Insurance premium funding is a growing industry. Why do I say it's low risk? Firstly, we do our due diligence on our borrower. We perform background checks, proof of income checks, credit checks. Is the borrower a secure entity to lend money? Are they safe? Through this initial process, we get to pick and choose our customers. Who is their broker? What insurance company are they with? Will they be able to pay their bills? Does their premium fit into our predetermined monetary value? All these factors are assessed before we accept their premium. Secondly, insurance premiums are very important to people, businesses. Most businesses and households prioritise the payment of their insurance premiums. Insurance premiums generally get paid first. It is a very important part of running any business. You have to be covered, even more so if the business is under stress. Additionally, we set up direct debits so that they are automatically paid. They don't have to remember to pay their instalments, but they want to remember because insurance is so important. We also send out automated reminder messaging about the time of their payments. Thirdly, and most importantly, it is a very low risk investment because we have a right to cancel their policy. Our loan is secured against the very insurance premium that it is for. That is the main reason this investment carries an investment-grade counterparty risk. If a customer defaults, we follow a very tight default process and ultimately hold the right to cancel their policy directly with their insurance provider. And when we cancel the policy, we are given the refund of the unused portion. Due to the way the payments are structured, this leaves us ahead on our loan and repayments across the entire cycle of the loan. We run a tight ship and any default is able to be handled very quickly. This makes this investment a secured loan. Lastly, default rates industry-wide in Australia and overseas are close to zero. They are at 0.1%, almost nothing. People very rarely, if ever, default on these payments. And that is for the same reason I've just mentioned. People pay their insurance premiums first. Insurance is important. So we lend into a product that most people prioritise and that is secured against a liquid asset, a product in an industry with very low default rates. This investment is stable and predictable, offering monthly payments at a high interest rate, all round making this investment very low risk. Who is running the fund? I'm Carl Kirsten, a barrister. I've run a venture capital fund and more recently founded an international bank. Jared Herring is the general manager. He has 20 years of banking and executive experience with NAB in Melbourne. Jade Murray has over 24 years in the insurance premium funding industry. Henry Downer is a chartered accountant with over 20 years experience, including 15 years at Deloitte. Phil Rickier is a professional finance sector non-executive director. Phil has, among many other things, previously been a director of the Risk Management Association of Australia. We have a strong team with proven experience in managing funds and managing premium funding companies with a focus on capital preservation. Our role is to maintain your capital, your investment, making sure the money is lent out to safe and secure customers and in an efficient manner to ensure the regular income you are seeking. Why now? Why have we started this company? At the moment, the insurance premium funding industry is going through some change. A government industry recently highlighted some conflicts of interest that have arisen between premium funders and their insurance companies. Some of these conflicts of interest have made it into the media in the last few months. You may have seen some of them. Services have dropped and as a result, brokers are looking for new sources of premium funders. Our business model is to be the provider that is approachable and flexible. It is an excellent time to be establishing a new provider in this growing market. We are also an ideal alternative to your current bank hybrid investment. You would have heard that APRA has made a decision in December to stop banks raising their capital through the hybrid market. It's a $43 billion market in Australia. AusPremium is a great alternative for those of you looking for a place to move your hybrid investment money. We have built our systems over the last 2 years, written deals with my own capital over the past few months to establish our market presence. We have integrated into brokers' management systems to enable instant quoting and a seamless approvals process. We are on the ground and generating demand. So, again, if you're looking for an investment in a cash or cash equivalent, if you're a wholesale or sophisticated investor, if you're seeking a stable monthly income, if you're seeking a high yield investment that has a low risk investment profile, then please consider AusPremium Finance for your cash equivalent. Please put your phones up and click on our QR code. Otherwise, I'll be out in the foyer or at my table for a few minutes and welcome any further questions. Thank you for listening.
Thank you, Carl. Now we have a presentation from Expression Capital Partners. Please welcome Elliot Hall, founding partner, to share more about their work.
Hello. Hello, everybody. I'm not here to talk about healthcare or AI or solar panels or anything like that. My name's Elliot Hall, and we're here to speak about entertainment, industry of fun. So, we have two partners, and both of them have been around for over 100 years. The first one being Hasbro. And Hasbro has around 1,500 brands, of which over the last 10 years they've exploited less than 1% of them to turn them into location-based entertainment. So if you think Hasbro, toys, games, movies, for many years, nearly 100 years, they've all been either on the table at home, on the TV, or toys with the children. The partnership we created is that they want to work hand in hand with Expression and turn as many of those as possible into location-based entertainment projects and socially competitive gaming. So over the last 10 years, they've kind of put their toes in the water to see how things are going, and clearly they're already doing good on their numbers. And surprisingly, a lot of people do actually want to go out and have a real-life experience and not just being sat at home on the telephones or two screens watching the TV all at the same time. The plan for Expression Capital Partners is to work with all of the Hasbro heritage brands, all of the biggest ones, turn them into location-based entertainment. Not everybody knows who Hasbro are, but for sure, everybody in this hotel and probably everybody in Sydney at some time in their life have had an interaction with a Hasbro brand. Hasbro is the third largest entertainment company in the world, behind Disney and Warner Media, with over 1,500 brands. Expression, along with Hasbro, we're going to create Hasbro-themed holiday resorts, cruise ships, Hasbro-themed water parks and theme parks, Hasbro-themed social competitive gaming super venues, Monopoly hotels, Monopoly casinos, and then the second partner that Expression Capital Partners has is a company called the International Association of Amusement Parks and Attractions, IAAPA for short. IAAPA has 7,000 members around the world in over 100 countries, and those members range from a small startup right through to Disney, Warner Brothers, Six Flags, Village Roadshows, Merlin Entertainments, Looping Group, and all of those members will be part of like a tripartite agreement between Expression and Hasbro to open as many venues as possible. Leisure and entertainment is an industry that's been around forever, and it will be around forever. If you're happy, if you're doing well, if you're affluent, you've got money, you'll go out and enjoy yourself and you'll be looking for experiences. But if times are not so good and it's tough, you know, even more so, you want to go out and escape, let your hair down, and enjoy experiences. We've got a really strong, established team of managers, operators, builders, designers, and financiers that have been in the industry for, well, going back the last 30 years, but add it all together, however many 100 years.
Our founders.
So we've got IAPA, an association around the world with the 7,000 members. If you're a member at IAPA and you're looking for investment, you want to invest into the industry, you're looking to buy or sell or merge a business together, Expression Capital Partners is now the trusted partner of IAPA around the world, and IAPA are normally inundated with inquiries every year, inbound inquiries looking for money or where they can spend the money. Expression Capital Partners is now the go-to place and where we'll be able to help. So Expression Capital Partners, we're raising a fund of £1 billion. It's a minimum of 10 million per investment, but we will allow nominee companies where a group of smaller investors can all chip in together to invest into the fund. Thank you very much, and I'll be around for the next couple of days.
Thank you, Elliot. Next, we have a presentation from our sponsor, Acuity Development Group. Let's hear from Melissa Fisher, the founder and the managing director.
Thank you. Well, hi everybody, I'm Melissa Fisher, and yes, I am the founder and director of Acuity Development Group. Now today, I want to speak to you about a project that we are undertaking in the Yarra Valley. Now, it is an amazing project, but before I get to that, I would like to talk a little bit more about the amazing team that I have and a little bit about Acuity Development Group as a whole. So Acuity Development Group has been around for around about a decade, but it is formed by decades of wisdom and knowledge. Myself, I've been in the industry or the business for 30-odd years, and my team adds up to hundreds of years of wisdom and a lot of depth of knowledge and information. So we are leading in innovative concepts and solutions. We are known for the developments that we undertake and the solutions that we actually bring into the industry and all of our projects. Vision, collaboration and relationships, it's what we're built on. And we undertake great relationships with all of our partners, consultants, our internal team, as well as local government, state government, and certainly our capital investors. We're leading property innovation, absolutely, creating world-class projects. For us, it's really important to break down the boundaries of culture and certainly various different countries. So what we do, we take to a global market and certainly a global arena in outcomes that we create and what we collaborate with and bring together. We do significantly increase the value of our assets. So while we're looking at projects, we're looking at not buying what is already an end-of-the-line product. We're buying things that may have challenge, that may have creeks to move in various different aspects, but we come with solutions. So we're looking to create better outcomes, better use of land, better use of existing product, and in return, we get to offer great returns, outcomes, and win-wins for everyone concerned. This includes our tenants, our investors, but certainly local communities as well. So end of the line is not what we are starting with, but it certainly is what we deliver, and we deliver great end of the line products to everyone that we actually undertake business with. Passion for what we do, every single one of us internally and externally have a massive passion for what we do. I have a great team around me and I'm very blessed for that, but they all come with varied passion. Passion for the industry, definitely. So each and every one of them have a large passion for the property industry, but independent passions are what make us a great collective team. Yes, we utilise all of our independent passions and talents to come together to form an amazing team and be able to deliver at every single level that we need to. As we're outsourcing, and we do, I have a small internal team. I have a very integral and talented internal team, but we have a very, very large external team of consultants, every single one of them hand-selected for what they truly believe in, what is true to them, and then what they bring to the table for every one of our developments. And I could not be more grateful for each and every one of them, to be perfectly honest. It is collaboration at its very best. It also gives us the opportunity to bring together the expanse of wisdom and experience that we actually can. Our team has expanded globally, which is very exciting for the products that we actually get to deliver. Relationships are at the heart of who we are. My internal team, we are a very close team, but our external team is no different. So for everyone we partner with, we're forming relationships. It's not a transaction. We're looking for long-term relationships, and we have had many for lasting years, and that is what we're here to talk about today and actually offer to you. So a little bit about our team. So Nadeem, he is here with us today. He is our CFO, absolutely amazing. That is what he does, but he does a whole lot more than that internally for us in our development. We have Rob, who is not here today. He is off working on site as our internal development manager. He is internal, so he's in-house to us. He's certainly not the only one that we actually undertake. We have Alison that heads up operations, Lincoln drafting in-house, and of course we have an EA who runs around like a mad woman making sure things are actually organised and done, which is incredible. But like I said, it doesn't stop there. We engage externally with a lot of consultants, and again, I'm very, very blessed to be able to demonstrate the names of some of the people that we have the luxury of actually working with and what they bring to the table. So it is a very large collaboration of everyone we bring together, and everyone does deliver a lot to every single project. Like I said, we're not transactional at all, we're very relationship based. Now let me talk to you about the project. This is a project, I said this is my baby, this one. This is our latest project. We have quite a few projects underway at the moment, but this is the latest one that's come to the table. So it is in the Yarra Valley in Victoria. So it is Coldstream, the gateway into the Yarra Ranges. So a gateway project, we're working very closely with state government and local council on this one. It is tourism led, but the industries or the aspects we're tapping into are a little bit different. The Yarra Ranges itself, wine region, for all of you that don't know, it is cold climate wine region, and it is well known right across the world for it. It has a lot of great culture, but entertainment, what we've just heard about, entertainment's incredible. So Dame Nellie Melba actually has her name on this parcel of land. So there are many aspects that we are dragging out of history and bringing into the forefront of this project. So it is, while we talk about tourism and well-being, it goes beyond the standard of what we actually know. Tourism and hospitality meets tech and innovation. This is exciting for us. A very deep passion of mine is to see things into the future and ensure that we do things in a better way than what we previously have. There's a lot going on in the tech space, and there's a lot of new innovation that is coming to the forefront. Tourism has had its challenges for quite some time based on the traditional way of doing things. So for us to be able to bring the two together and create great outcomes is very exciting. It also puts us in the forefront of a lot of incredible people. The project itself, yes, it is a gateway project, and it will actually break down the barriers of traditional hospitality, creating a world-class destination. Airport, yes, bought this with a large parcel of land and an airport that comes with it. So now we're bringing multiple industries together, which again gives us diversity in the project, but gives us great opportunity in what we are able to deliver. 374-acre development. This blends cutting-edge design, culture, heritage and environmental stewardship. Master plan led, yes it is, but the forefront of this is well-being, education and experience. So well-being is a very, very large part of what this project is all about, but that does not start with day spas. Well-being for us actually starts underground, and it works its way up, weaved through every single aspect. So we give consideration to the air that is breathed right through to every environmental aspect, how water is treated, and then definitely the experiences are created. So when people leave, they leave feeling a whole lot more alive and a whole lot more better than what they did when they arrived. We also like to leave a footprint into the future with everything that we do. So we are looking at a lot of research into the future of wellbeing. What that actually looks like means there will be a research and development aspect to the project. So Again, whilst we look at what is current today, which is amazing, this project will get delivered in 5 years from now. So what is current today is certainly not going to be current in 5 years, let alone 10 years. So there's a lot that's said for being able to see into the future and understanding what people are actually looking for and where that ends up in years to come. Education is essential. People only know what they know. So bringing awareness to things is paramount in all of our projects, and that starts with our team, but it actually leads through to all of our guest experiences as well. We get to bring the opportunities of ancient wisdom blended with the future of what well-being and wellness actually will look like. Agriculture is a massive, massive industry, especially in this country with where we look at the tech side of it and where it's headed. It's exciting to work with that industry on this project, maintaining what we call the absolute true paddock to plate experience. So it is grown literally on site. And will be delivered to your plate. But there's a very big educational side that is being delivered in the agricultural space. Luxury accommodation, just imagine a 7-star luxury accommodation retreat at the doorstep of an amazing wine region. So we have 4 stages of accommodation. We want to make sure we can cater for families, as well as being able to create the privacy of luxury accommodation. World-class wellness, this is just a snippet of some of the things that will be included in the project, and then the innovation of dining and entertainment. So state-of-the-art venues, bringing immersion and virtual reality into it, tying together nicely with history and then leading into the future of all of the industries that we will be working with and making some interesting changes in. Experience. We want to create a place that absolutely leaves people having new experiences. The experience of today will be different to the one that they have tomorrow, so encouraging them to come back and immerse into the space more than once, to tell their friends, but more so, every time that they leave feeling better and more alive than they did when they turned up. Aviation, like I mentioned, we bought this with a small aerodrome. It is being extended. So the runway itself and the airport will be extended to enable private charter to come in. The industry, aviation, is moving in a very quick way for what it is, but it's moving into some very interesting spaces as well. So we will lead the way in aspects of that. We have some incredible people in that space that are working with us and that are going to partner in the airport side of it. The training aspect of aviation will certainly help fill the gap with the shortage of international pilots with a major training school that is there. Education and regenerative experiences. Everything from curated walking trails, immersive virtual reality installations, hands-on experience, you name it, it will absolutely and utterly be brought into this space. Education is a very big part of who we are, what we do, internally, externally, but ensuring that we can deliver that to our guests and bringing generations together is a very exciting space to be in. So a couple of things that we look at, economics is one of them. Like I said, we work quite closely with the state government and local councils. We give a lot back into our communities in various different ways, and for every development that we do, it's really important to give consideration to the local communities and be able to make the benefits that we possibly can from an infrastructure perspective, but also being able to ensure that the communities can come in, utilise the product and enjoy the experiences that we create. We are addressing demand for international pilots, catalysts for regional economic growth, absolutely, and develop hospitality and wellness resource with innovation training facilities. Unwavering commitment to excellence, it's where we start. We say anything below excellence is not acceptable. And we have formed this internally as a business, and we expand it across all of our developments. This one will be no different. So excellence is our baseline. It excites all of us to be able to exceed that, and I think we deliver that in every step that we actually take. Future vision. Like I've said, this project will be delivered in about 5 years. Right, so we need to be future vision. We need to be giving great consideration to what that actually looks like. Otherwise, you actually miss the point. And we are well in front of the 8 ball, certainly not behind it. And economic and industry impact. Impact is something that I think we all consider part and parcel of what we'd like to do every day. So again, it's something that we overlay into all of our projects. So an opportunity, absolutely, to partner with Acuity Development Group on this, investing into the next stage of our project development. This stage has a 2-year horizon. So this will take us through to planning scheme amendments and full development permit, which gives us an exceptional uplift in the asset that we're actually sitting on at the moment. The investment opportunity to participate in notes to be issued to our special purpose companies for the project, and each note will have a coupon of 15% per annum delivered. Now, investors can exit at the end of 2 years. You don't have to stay in, but anyone wanting to stay in will actually be given first option before anyone else is able to invest in the next stage of this development. There are opportunities for equity participation. We will be here for the rest of today and all day tomorrow. We are at booth, I think, 15 next door. Come and see us. We're happy to chat about all opportunities. But capital's not the only thing we're looking for. So we're also looking for strategic partners that actually, while I say this, let me let you read the disclaimer. Strategic partners in tech space and other innovations. Like I said, we're very much in collaboration. So if tech is your thing and wellness, tourism, hospitality is something that excites you, we'll certainly be next door, and I look forward to talking to you. Thanks very much.
Thank you, Melissa. Now let's move on to Frontier Pets. Please welcome Simon Potycary, the CEO, to present their company's vision and impact.
Good afternoon, everyone. Right, it's my pleasure to introduce you to Frontier Pets. So we're the #1 producer of freeze-dried pet food in Australia. We're making some of the best food on the planet. And we're really excited to take that a bit further forward. So we're in the middle of an equity raise. We're raising around $5 million. There's $2 million remaining. We've already received $3 million of that a cornerstone investor from Kitea Capital. And that funding is going to allow further expansion of our sales channels and further capital investment in our freeze-drying technology. And also enable us to further optimize our factory and make sure we can be as efficient as possible in our production. We're in the good growth space. We're growing currently at about 25%, and we're forecasting that we're going to get up to about $40 million of revenue by about FY28. So a strong growth trajectory. So we're looking to raise a bit of capital, and then we also do have some convertible note options for if anyone wanted a sort of a earlier exit and a smaller stake. So let me tell you a bit more about the business. So Frontier Pets is all about pet food with a purpose. So we're on a path to reduce the impact of intensive factory farming. And the second biggest consumer of factory farm products is our pets. So we're using grass-fed beef, free-range chicken, free-range pork, looking for proteins that help support sustainable agriculture. So not only do you get to feed your pet with some of the best pet foods in the world, but you also make a sustainable long-term difference to the future of the planet. So that gives us a real point of difference. Nobody else in the world is making the range of free-range products that we are, and there's no bigger manufacturer of freeze-dried pet foods in Australia. So what's all the fuss about this diet? The diet is really a biologically appropriate raw food. So the idea of raw food feeding is it mimics the diet that cats and dogs had in their ancestral days when they were running wild. So the 4 core pillars of it's raw and minimally processed. So a number of people look to raw feed their pets, and that's increasingly the sort of gold standard of pet nutrition. But raw feeding is challenging to do. It's time consuming, it requires a lot of fridge and freezer space. You end up dealing with some offals that might not normally be part of your normal dietary shopping. So at Frontier Pets, we take all of that pain away, and we produce a freeze-dried raw version that you can store and use in the same way that people store and use kibble. It's that simple. Wherever the bag of kibble sits, the bag of Frontier Pets sits. And it's all whole food ingredients. So we take whole chickens, whole fish, big sides of pork and beef, process those in our own facility with organic vegetables, all sourced from Australia. And there's no grains, so it's a low carb product, and there's no unnecessary additives. So it's a very, very simple process, and it produces a very, very high quality pet food. So essentially we just take natural meats, proteins, 100% Australian made, we waste very, very little, and then we freeze dry it into these pellets. The recipes were all vet developed, vet supported, and increasing numbers of holistic vets sell and recommend our products across Australia. It's very easy to use. You can feed either wet or dry. So essentially it's the convenience of, it's raw food made easy. So it's very easy to use and easy to serve. Now in the business currently we have 3 state-of-the-art freeze dryers. So these are American Parker freeze dryers. So some of the most sophisticated freeze drying technology in the world. We've got 3 one-ton dryers, if you will. So you load in 1,000 kilos of wet produce and you get out 300 kilos of dry. And so we're doing all of this process in our own facility. And one part of our challenge last year was to get our move done. We moved from a small facility at Evans Head up to a significantly bigger facility in Brisbane. I'll talk about it a little bit more. But we've got room for 10 freeze dryers in that facility, which would give us the opportunity to scale the business to $50 or $60 million of revenue. So I'll tell you a little bit more about freeze drying because it's an amazing thing to come and see. So there's 3 main stages of freeze drying. So freeze drying, the first stage is we freeze the product, and that takes it down to around minus 40 degrees. So this, during that process, turns the water in anything into ice. Then we go through the first stage of drying. So the machines create a vacuum. And then in that vacuum, the pressure is lowered down, and this moves the ice in the food through a process called sublimination to move as a vapor out of the food. And then it reforms as ice on the walls of the machine on special ice retaining pallets. After all that ice has been removed, there's a little bit of a heat process to remove any more moisture, and then the product is ready for packing. The whole process takes about 24 hours. And so we've got 3 of these machines currently. They're worth about $1 million each. 2 of them are unencumbered. So there's certainly some asset stability within the business. And what we're looking to do is to be able to buy some more freeze drying capacity. And to facilitate that, we're ready to scale within that volume. We did a manufacturing transfer last year, so we moved from Evans Head in northern New South Wales up to Brisbane. And we completed that transition in May over a sort of 2 to 3 week period, and we've been manufacturing in there since then, and we're up to full capacity within that site. So the new facility gives us 10 times more space, and we can get up to 10 dryers in there. And then also, obviously, being in Brisbane versus in a sort of small regional town, we've got significant improvements in raw material supplies, so we're able to reduce our costs that way, access to better quality talent and people, and the ongoing ability to scale and grow. And scale and growth is very important, obviously, and then the pet food market continues to offer significant opportunities for growth. So Australia has the highest percentage pet food ownership in the world. So some 69% of Australians have a household pet. So that's some 6 million dogs and nearly 5 million cats. So that's a huge market just in Australia. And consumers are increasingly focused on feeding their pets as well as they can. So pets are the new children, is essentially how we're looking at it. And so in the same way that you look to feed yourselves and our children as well as possible, but if we look after our pets, then they'll live longer and look better. So the market is continuing to grow, and the online space is also a key driver of success. So we have, on our run rate now, we're running at $10 million of revenue, EBITDA positive at the half year. So we're fast growing. I'll talk about it a little bit more in a minute. But the Australian market offers significant opportunity for growth, both in direct-to-consumer and also as we strengthen the brand and offer the brand in wider channels. And we've historically grown successfully over a number of years. So taking the business from around $1 million in 2018, so we'll hit our forecast of $10 million 2024-25. And we're seeing that growth across a number of areas. So strong revenue growth. So at the half year, we're growing at 26.5%. Online sales in Australia are growing at over 20%, 23%. And then what's been a significant driver is export sales. So export sales are growing at 36% this year. We've seen over $1 million of revenue in Korea, and it continues to grow. We've just launched in Japan with Japanese-based products. We launched at the Pet Show in Hong Kong in January, and we've got further exhibitions in Japan and Singapore later in the year. So freeze-dried product from Australia is very marketable in Southeast Asia. It basically follows the path that Australian beef has been beating for years. Very similar to consumer in the sense that they're young couples very focused on looking after their new child/pet. So huge opportunities for growth. We're continuing to grow across all the key markets. So a big part of our business is subscription growth. So we've grown our subscriber base from 40% of sales to 80% of sales now. So once we get someone, we keep them, and they continue to buy their pet food, and it's a strongly forecastable, reoccurring revenue. The weakness in the model is Australia Post. If they stuff it up, then our consumers are upset. But as long as we get that bit right, then people return and continue to buy more. So we've got a steady growth trajectory. We need to get 20 new customers a day. We do that pretty much every day, and then they turn into subscribers. And if we continue to grow 140 subscribers a month, our subscriber base continues to grow at 45%. Just not massively complicated metrics, not wildly optimistic. We just need to get 20 new customers a day. And we're continuing to do that on a regular basis. And we've got a number of growth pathways to hit that $10 million this year through domestic growth. We've also launched a cat food. Our export markets get stronger and stronger. And also we've got a range of new products coming into the business. Yeah, so I think I've pretty much done. So anyway, thank you very much for hearing about Frontier Pets. As I say, we've got a huge number of growth opportunities. We're out on stand 10. Please come and talk to us. We'd love to hear more. Thank you very much.
Thank you, Simon. Up next, we have a presentation from our media partner, ausbiz. Please join me to invite Nadine Blaney to the stage. She is the head of growth of ausbiz.
Okay. Not quite sure how this operates, so we'll just roll with it. Look, ausbiz, I hope you have heard of us. So we are a business and finance streaming service. We are live on air Monday to Friday when the market is trading. So pretty much from about 9:30 these days until we get to about 4:30 in the afternoon. That being said, we do have a couple podcasts that we do. We have a couple of newsletters that we have as well, and yeah, that's sort of what we're doing. We've got 2 studios that we use. One is for the live stream, and one we do sort of video production. So 6 hours a day. Mostly people are watching on our website, but our channel is also on Samsung TV. It's pretty popular there. We also have an audience on 7+. And our content is also on Iris terminals for anybody who's familiar with Iris. So we do all of these interviews throughout the day, and then we publish all of that information and all of that video, interviews and shows to ausbiz.com.au. It's mostly consumed on demand by our high-value audience. We think they're very high value, of self-directed investors primarily. But we really do like to think of ourselves as more than a news channel. think we've really evolved into that. So we see ourselves as an investment platform that's providing analysis and opportunities across asset classes to both public and private markets. So this is who we are. So our team has a very long history in the industry. Our chairman, Kylie, who's our MD, Kylie Merritt, have been making business TV in Australia literally for decades. In 2008, Kylie and I were part of the founding team for Sky News Business, if anybody remembers Sky News Business. Simon Van Ness actually just joined us last year, and he's building something called ausbiz Capital, which will be offering investment products to our audience that are vetted by our investment committee. And our head of product, Mike Payne, so he is taking the lead when it comes to this labs business, which I'm here to speak with you about today. He has a very long career in product management. He's worked for the likes of Telstra and the A-Leagues. So his real expertise is in streaming media. Let me see, how do I move this along? So next month, this is just a very brief history. Next month will be 5 years since the first iteration of ausbiz went live. At that time, it was not much more than a little website that hosted videos, but it did get us started. And then in 2021, we rolled out personalization, which allowed registered users, I hope some of you are registered users, to follow what's important to them. It could be stocks specifically, it could be themes, it could be shows, it could be expert guests as well. So far, we've attracted more than 5 million in equity investment, and we've grown our database of our registered viewers to almost 120,000. I think it's actually above that now. And they're all investors and finance professionals. Nobody sort of stumbles on ausbiz. You have to actually want to watch the content to find yourself there. Very critically, I'm sure many of you know how tough the media business is, even just from reading the news. We've built new revenue streams that really do sit well without outside, I should say, of the traditional media advertising landscape. It's not, we feel, a sustainable business model going forward. What really sets us apart is this year alone, we will be connecting more than 60 commercial partners directly with investors, to invest literally in their products or service. So these new revenue streams are what are going to provide us with the opportunity to become not only sustainable, but also to scale into new verticals and markets. We can't do any of that. I'm head of content, head of growth. We can't do any of that without great content, and that's why quality, independent content always will be, really the heart of what we do. So taking a look at the group structure. So launching the ausbiz Capital business just last year required a restructure of the group, so we really want to keep a true church and state separation between the media and the financial services business. It's good governance, first of all, but it also really reflects our commitment to always putting our audience first. The majority of our cap table sits at group level. The parent group owns 100% of ausbiz TV. Which is, of course, the original media business. Aside from our founders, our major investors are financial services firms, which really saw the value of content reflecting their sector and for their sector, about their sector. So ausbiz Capital is 30% owned by ARC Funds. It is an ASX-listed funds management firm. And we are taking a direct investment of up to 20% of issued capital in ausbiz labs business. So this is another part of ausbiz that we're developing. The equity from this raise that we're doing right now comes from ausbiz clients and wholesale investors that are within our audience base. But I think now is probably when I should explain specifically our new business, ausbiz Labs, and why we are really excited about its potential. I think before I do that, it's probably important to understand our position in the market. So we have an editorial relationship with about 80% of firms in the Australian financial services sector. So that means that we interview an incredibly broad base of professional investors across all asset classes. So equities, private credit, infrastructure. We do a lot of macro currencies and the like. So these are not just names to us or emails on a database. They're people that we have true relationships with, and that's probably what I'm most proud of our past 5 years, is that we've really developed really great relationships with people within our network. So what it means for our audience is it means that they're getting across the investing universe. So not just the giant banks and brokers, whom we love, but also those highly specialized boutique fund managers. That means that whatever your portfolio strategy is, we've got highly qualified insights for you, available to you, and the breadth and the depth of that information is what we see as our moat. It is our moat. So it doesn't take much to look at TikTok, to look at YouTube, and you will see just about anybody can churn out finance video content. So a shout out to the finfluencers, but we're very much not that. So I'm sure AI has been mentioned a lot today. And AI, really anybody can use AI to produce video content at scale. But very few have the qualitative video content featuring licensed finance professionals such as we do. So that's really what sets us apart. So what's Ausbiz Labs? We know that it's impossible for an investor to watch every piece of content we create. So what Labs does is it takes all of our long-form video and it uses AI to transcode, to transcribe, to analyze, edit, and publish up to 80 short-form videos a day. So to start with, these clips will only relate to ASX-listed stocks, but the technology really can be applied to any content vertical. So each company video or stock video analysis is overlaid with meta tags, which also includes, buy, hold, sell sentiment, and it is delivered by an API to the end user. So this means that an investor could choose not only to receive alerts and information about stocks in their portfolio on a watch list, but really there's a lot that can go along with that depending on anybody's personal preference. So we could have a watch list. Future state, sorry, should have moved on there. Future state, the AI model could actually learn from a user's investment choices to serve video about stocks that they may not hold, but they could potentially likely be interested in. So that's future state. Where investors access the video is also key. So we know that context is everything, and the most relevant place to access this information is obviously within a trading environment. It's probably an online broking or some sort of a wealth platform. So it's good for the user because it's all in one place. It's even better for the platform though, because we know that having that information consumable, easily consumable, quality video content increases clients' propensity to trade. So our first Ausbiz Labs client, which is an online broker, is going live with the product very soon. So our plans for the technology include rolling out a premium service to Ausbiz users. We want to create more content at scale across other verticals where there's high demand, for example, US equities. And with more globally focused content, our addressable market actually extends well beyond Australia. So our raise for Labs will continue to develop capability, but also enterprise sales. And we will complete the re-architecture of our broadcast technology stack, which allows for everything to be completely cloud-based. We're already doing something in a newsroom that I don't think is being done anywhere else in the world, how we do it. But we'll be moving completely to cloud-based production. So it's more efficient, obviously, and it's also location agnostic, which fits with our vision for rolling this out in other markets. So I am not the person who's usually coming to speak to everybody at ausbiz Labs, but it's in my blood and bones. I'm very much excited about all the future opportunities for ausbiz. We always knew when we started out that we weren't just building a media business. We knew that we had big plans for the technology and the technology stack. So Kylie, our wonderful managing director, is in Singapore today. She's chatting with potential partners there. That's the end of the slideshow. But if you're interested in learning more, feel free to contact me or Kylie. We're easy to find. We're ausbiz.com.au.
Thank you, Nadine. Now let's hear from another one of our sponsors. Please welcome David Plant, partner from Succession Plus, to the stage.
Good afternoon, ladies and gentlemen. It's a pleasure to be here today. We very much appreciated Steve Torso's introduction of Craig West, who is the principal and CEO of our business. Craig's is now an international expert and a source of information for people who are looking at exit and succession planning across the world. So what I'm going to speak to you about today is employee share ownership plans, and it's a way really at the moment we have a particular drain on staff. There's a big market for good staff, and one of the things that we're particularly looking for when we're talking about the employee share ownership plans is the opportunity to attract, retain and motivate key employees. Bless you. Okay, so there's various different levels in terms of equity. So when we go in to talk to a business about their potential for an employee share plan, one of the things that we do is we have a look at the models in the various different areas, and usually with the majority of businesses that we deal with, for their key people, they've got the profit share, which you can see in the middle of that area. What we're encouraging businesses to do where appropriate, it's not always appropriate depending on the structure of the business, the revenue, etc., or the people that they have in their business. But where possible, we're really trying to encourage people to get to think about bringing people into ownership in the business, often in a very small way, just to bring them in, give them a small part of equity, the opportunity to build it based on performance. So, as I said, what we've found in terms of the business performance is that once there's a completely different mindset for those staff members who are employees as opposed to those who are equity owners. With the equities, clearly any effort that they make that's additional to what they used to do in the business is going to provide a better outcome for the business, and where rather than putting their paying tax, etc., of 50% usually, around that amount, on their bonuses, etc., that can be used to fund into purchasing shares. So we work with, so we work with employees to get people to think about working like business owners. One of the things that we do as part of our process, our initial standpoint is to actually go and value the business, understand where there's areas for improvement. But in due course, what we're endeavouring to do is to get people to think and act, as I said, like business owners. So we tend to look for the right type of ESOP for their business. So the way that we structure our particular approach is something that is exclusive to us, which is called our Peak Performance Trust. And the Peak Performance Trust has a couple of benefits from the perspective that if you were to bring people into direct equity ownership in your business, those people are going to be on your share register, there's going to be public information available on, or people from the public can have a look, competitors, etc., can see holdings, other people in staff can see holdings, etc. So what we do with the Peak Performance Trust, it is actually a trust operation where the trust owns the equity in the company, and then the shareholders, the staff shareholders, are part of that trust. What it does for employers is it gives them a control in terms of the way that the Peak Performance Trust is run. What I mean by that, for example, is we often have problems with people who leave a business. We sometimes call them bad leavers. They may be someone who goes and uses some of your IP. It might be someone who looks at this, that looks at your client base and takes some of those people with you. So there's an opportunity, for example, as we tailor the employee share ownership plan to say, there is a limitation before we pay you out the value of your shares if and when you leave the business. We will have a bad leaver provision in there. In addition, going into the Peak Performance Trust means that people immediately, once they receive equity, participate in 100% of dividends that are paid out to them, etc. But again, we can tailor the Peak Performance Trust that if that person leaves after a year, the company funded shares that they get, they may only get 10% of that, 20% the second year. So it's kind of reverse vesting. Often in arrangements we have these days, you get options of shares over a few years. This is a reverse. You do participate fully, which encourages staff members to look at the performance of the business, but there is protections for an employer. The other real advantage is that rather than staff members paying a 50% approximate on their bonuses if they are paid, they actually get to defer tax for purchases going into the employee share plan for up to 15 years. So one of the things with this Peak Performance Trust is it's fully compliant with all taxation laws. And often people say, I can do it myself. You can, but you're going to have to do a lot of work. You're going to have to bring legal people in. You're going to bring accountants. You're going to have to bring various different information, etc., from the tax to make sure it's compliant. So this is a great deal from that perspective. The other is there's a real benefit for the company in this. As you can see down on the bottom right, the employer actually funds, and usually from the profit share, they'll fund the purchase into the shares, and then the Peak Performance Trust will purchase those shares from the company. So essentially, from a cash flow perspective, the money goes out, and within 2 days it's back in the bank account because it's purchased the equity. It's a great way of making sure that there's not a problem with cash flow. The money does have to leave the business for a short period of time to make sure that it applies. Okay, so I just wanted to talk quickly. We haven't got too much time, but when we actually do our valuations of businesses, we speak to them, we look at their value, and I'll talk a little bit more tomorrow on our Business Insights report. And our Business Insights report is a full diagnostic of a business. It goes not only when we're doing a valuation into financials, we do non-financials, we do risk, we do benchmarking, and we've now got, as we said, 15 years of experience and benchmarking available. So we're able to compare like with like in different industries and make sure that we understand the value now. But the other thing that we do when we provide the report, which has a scorecard in it for various different key areas of the business, is we're able to say if you address these particular issues, you can move up that spectrum of values. So we work a lot, so that's got two potentials. One is it assists the business to understand that they're growing in that way, but the other is it gives confidence to the employees who may be encouraged and invited to participate in equity from the perspective that, hey, this is a business that's going to provide a good return. Just to give you a bit of an idea of what we do, this is a real business up in Queensland, an equipment hire company, and you can see there that we've worked with them on the increase of the value of their business, but we've done that by making sure that we've improved the performance levels. We've got specific objectives for people to meet, and in that way they've been able to increase their value of their business substantially, which is good for both of them and also for the staff. I won't go too long on that, so just to give you a bit of an idea of where we play in this, we've currently got 151 plans with, as you can see, about 1,774 employees, and we're expecting this year, we've got a revaluation on a business that's been particularly successful, that we expect that to go up to around $100 million that we're managing for employees from that perspective. So, as I said, tomorrow we'll talk a little bit about our Business Insights report, which gives you the details of how we get into the nuts and bolts of that. We're in the presentation area out there, so if you'd like to come and speak to us, we'd be delighted to speak with you, and there's my details. I think I've just made it within the 8 minutes. Thank you for your attention at the end of a long, hard day.
Thank you, David. Our next keynote will explore the consolidation of the marine sector, shedding light on the key drivers shaping the industry and what the future holds for investors and the businesses alike. Here to share valuable insights is Nick Richards, Senior Business Director at Venturely.
Hi everyone, how you doing? So look, initially I was going to essentially talk about the macroeconomic trends, and work a bit of a pitch in there too, but it's late in the day and we've had a long day, so I'm actually going to kind of tell the story about how we wound up here and the things that happened along the way. So originally, we as a group were actually management consultants, and as anyone here has experience with management consulting, basically people come to you with essentially one problem, which is they want to make more money. It just manifests itself in a variety of ways. Then, once you give them advice, one of two things happens. They either ignore you because it's not what they wanted to hear, or they ignore you and do what they want anyway. So after about 5 years of this, we really got sick of it and decided that maybe we should just buy businesses and run them ourselves. So then we started looking and we thought, okay, we've got this succession trend that everyone's spoken on today. There's people who are leaving the businesses or they want to leave the businesses, they don't know how. So we started looking at what businesses we should acquire. So the big thing there then was we had to work out what industry do we want to be in for longevity and what suits our skill sets. So obviously we wanted a product business, we wanted a moat against AI so we didn't get wiped out. We also wanted a product that's kind of complex or the moat's high enough that it's not easy for competitors to jump in. We want it to be scalable, repeatable, and not a franchise. So we've had a couple of e-com businesses, we've had beauty, we've had health, we've had recruitment. But then what happened was we kind of stumbled upon the marine sector. And so we actually happened upon a business in Gladstone that we acquired. We got in there. The owner wanted to retire. We got in there. It was actually a really good business. It had great bones. It needed a bit of a turnaround. And it had all of the things we wanted. So marine sort of looks like what the motorbike sector looked like maybe 15 years ago before Team Moto rolled it up, where there's little operators, mum and pop operators everywhere. They all hate each other and never talk to each other. There's more beefs in there than rap in the 90s, like it's crazy. The first one we bought had one computer that was plugged in manually. They didn't have an email list. They didn't have a stock list. They didn't have a customer list. They didn't know what they'd sold. They basically were what I would call a vibes-based business in the sense of their profitability and strategy. So then we acquired this business and we started putting systems in place. And then as we began exploring, we realized that there's like 50 of these and they're all basically exactly the same. So then the first thing we did, of course, was set a huge audacious goal, which was let's try to do 20 of these in 24 months. As we got on and on a bit, our businesses got bigger, they got better, they got more sophisticated as we bought in, our brands got better, and we started to get a bit of momentum. The other thing we realized is that suppliers and manufacturers were really, really keen to get involved because, again, you've got these larger corporate entities, you've got Suzuki, Yamaha, guys like Telwater who own Quintrex, who are dealing with a lot of these mom and pop operators who are kind of getting sick of it, to be honest, because it's difficult for them to deal with. So we got the opportunity to partner with these guys. As we started building momentum with them, we then started getting better terms. Then opportunities came along for bigger brands, and then opportunities started opening up for areas like Southeast Asia. So if I talk about, firstly, the problems we had in the acquisition, and secondly, the progress we had. So basically, the problems we had was initially we'd buy these dealerships and we're like, look, to the owners, stick around for a couple of years if you want, you can be semi-retired, you'll have a blast, come in here 2 days a week, work on some boats, it'll be sick. But the problem we found was the owners letting go was actually the biggest challenge to the implementation of changes. Because if we got in there and we're like, look guys, we're going to put a CRM in place, we're going to put some systems in, these guys are like, well look, I didn't need a system for 45 years. So the implementation, the changeover was just hellish. So we realized that we actually need to take these businesses, get them handed over, and move forward as quickly as possible. So with that, we've ended up acquiring about 6 dealerships in 8 months. We've got Central Queensland, Melbourne, Adelaide, New South Wales Coast, Quintrex, CJ, Stacer, all the brands, Yamaha, Suzuki. There's 5 more dealerships currently in negotiation. So you can see the pattern here is like a rough chronological order. So we started in Gladstone. there's a bit of a crossover, that's unfortunate. Then we went to Newcastle with a bigger dealership, then a couple in South Australia that were bigger again and had more luxury brands like Beneteau, then an even larger one in Melbourne. And as we rolled on, we basically picked up these brands, started consolidating the brands, started consolidating suppliers, and just watched the benefits compound. So it's been a long day, and you guys have heard like a million pitches today, so I'm not going to belabor our pitch on this one at all, but basically we're always looking for funding to accelerate growth, because the more funding we have, the more resources we can put in, the quicker we can roll out. And then we're looking at an exit probably in 28, 29 with either an external private equity firm or a larger company in the US. There's a couple that are doing a similar thing, or perhaps via an IPO. So I really wanted to open it up as well for if people had questions about acquiring businesses and the process they've gone through and anything we've encountered along the way, because I think that's a good way to round off the day rather than me just talking the entire time. So thanks. If I don't have any queries, then I'm going to head off to the lobby bar. See ya.
Thank you, Nick. Now let's invite Leslie Chong, CEO and Managing Director of Emergence, to the stage to present their company and its innovations.
Thank you. Is it fairly easy to understand? Okay. Hi, everyone. I love being the speaker that keeps you in between drinks. And we're going to go from marine to now, you know, an uplifting conversation about cancer. So imaging is all about hopefully curing some folks with the certain kinds of cancers. And we have a few walking around. Here are my disclaimer. All right, so imaging is, in one sentence, is a clinical stage, meaning we're already in patients, doing a cancer company developing in CAR T and oncolytic virus. I'll explain those in just a second. It's a little bit hard going in terms of the science, so I'm just going to try to make it as accessible as possible. So we have 3 prioritized programs, meaning these are the programs that we think is the one that's going to be eventually marketed or partnered with Big Pharma. So we've got an allogeneic CAR T and 2 oncolytic viruses. By the name, we all know viruses because of COVID, but oncolytic, it goes after solid tumors, so cancers. 3 current ongoing clinical studies, and we have dosed 200 some odd patients, over 200 patients, all cancer patients, and some of them are walking around today after having failed 5th, 6th, 11th line of therapy. So I'm quite proud to be doing what we're doing and talking to you guys today. We're at a market cap, sadly, only at 321 million. We were at the billion mark, and I think we will get there with our products. Azer-cel, CD19 CAR T, those are just letters and words, and I'll explain those in just a second. Oncolytic virus is our parental virus, and onCARlytics. This is a revolutionary product that we're hoping to produce data and bring it forward quite expeditiously. So I'll go into Azer-cel. So Azer-cel is an allogeneic CAR T. So these products called autologous CAR T, if you have a certain kind of blood cancer, you have failed off of chemo, because they give you chemo initially, and they put you on these autologous or auto CAR T, chimeric antigen receptor T cell. CAR Ts have revolutionized cancer therapy for blood cancers. It's about anywhere between $500,000 to $1 million. It's quite expensive, but if your doctors told you that you might have 50%, upwards of 93% of curing your certain kind of blood cancer, the government has already approved it, and only with roughly about 50 patients worth of data, they approved it, because that's such a 50% response, meaning clearance of cancer, is such a whopper of a response in any kind of cancer therapy. FDA approved this roughly with about 50 patients. Kite sold this particular product to Gilead for $11 billion off of only 50 patients. So what we're proposing now is that these auto CAR T, they revolutionize how patients can be treated. However, it is a laborious process where you have to wait 4 to 6 weeks for these things to be manufactured, because they're literally taking your T cells, genetically engineering them in a lab, and then putting it back into you, and roughly about 20% either reject it or they just get sick again and can't take the formula. What we have at Imaging is called Azer-cel, and it's called allogeneic. It's on demand when you need it and when you're diagnosed. So it takes roughly about 3 days for you to get the chemo and 2 days for you to get our product. This is a very heavy word, but we engineer the T cells from healthy donor cells. You can imagine, or I always imagine it's sort of like Ryan Gosling gives his healthy donor cells, and then we engineer it, and then we give it, and we have a batch that could be provided to anywhere between 15 to 20 patients. So it's frozen, it's at the sites. We have it at RPA. A patient was treated after failing 5 lines of therapy. So can you imagine having a certain kind of blood cancer, and it keeps coming back no matter what you do? They came on our study, first site, first Australian site, first patient in, complete response, meaning no more cancer. So Azer-cel, off-the-shelf, allo CAR T, and 7 patients came in after they failed off of at least 4 lines of therapy, including these $1 million laborious auto CAR T. They came on to our allo CAR T, Azer-cel, and 4 of those patients had complete response, no absence of their tumors. And 1 patient in particular, and a few patients, I might add, 11 months going on a complete response after failing off of 5 lines of therapy. So I'm quite proud. And when I think of this patient who's been on our study with no more cancer for more than 11 months, I get shivers down my spine because they're 47-year young and have failed off of various different therapies, comes on our study, and unbeknownst to them, 11 months later, they're still living without cancer. So I'll move quickly into the oncolytic virus. So oncolytic virus, by the name, it's a Frankenstein of smallpox variety, and it is engineered as well. And it loves to attack solid tumors. So it only replicates in solid tumors. And when it replicates, it bursts the cells, and then the virus is spread to other cancer cells. So we know this for a fact because roughly at the time of this data cut, 40 patients were dosed. These patients had anywhere between 5 to 11 lines of therapy. Now we're talking about solid tumors where you don't see the revolutionary 50 to 90% response rate. You see roughly about 20, 30% response rate. Half of these patients, 20 as a matter of fact, maintained stability. Their tumors did not grow. 1 patient in particular who had cholangio or biliary tract cancer, complete response. So only 8% of patients who have biliary tract actually respond to any therapy at all. They're given roughly anywhere between 3 to 6 months. This patient has been living without cancer for more than 2 years. We have a few melanoma patients that have been having partial response and maintain their partial response. So I get moved when I think about these patients because they've gone through so much therapy and they're so weak. And the fact that the oncolytic virus imparts killing of their cancer as well as maintain their safety. FDA has recognized that we have FDA approval for fast track, so whenever we want to submit this to the FDA, they will fast track us to approval. Revolutionary product, but what I'm really truly excited about is we know in fact that oncolytic viruses replicates only in solid tumors. In this case, we put a cassette of CD19. CD19 only appears in blood cancers. This replicates, shuttles up, or covers a solid tumor with CD19. You then add the CD19 therapy that I talked about that gave you 50 to 90% response rate. As I said, solid tumors do not see that level of response. So we have combined our onCARlytics with a bispecific product marketed by Amgen. It's a CD19 directed. We already have this in the clinic. And if blood cancers are only 10% of the market, affecting that 90% to give the same level of response rate, all those drugs are only approved in blood cancers, and they're all CD19 directed. If we can direct any of those blood cancer therapeutics into solid tumor, we truly have revolutionized how we can treat cancer, solid tumors especially, because no more are you we're satisfied with 20, 30% response rate. I want cure. I want 90, I want 100%. We have a lot of data coming out, an announcement, and clinical data that we're producing across this year. And we have the reason why you should invest in imaging, and you always have to give a pitch because that's why I'm here. We have novel platforms. We're actually curing some patients of certain kinds of cancer types. I like the truly unmet need, so I generally go for the real unmet need in cancers. And actually, the FDA likes for you to go to the unmet need because you get approvals faster. We have clinical data readouts in the next 12 months. We have deeply experienced cancer drug developers in the company that I'll show you next. And of course, we always wrap or ring fence our patents, and we just announced one this morning in China. So here's my amazing team. You could see there's Exelixis, Genentech. I've worked with them on myriads of drugs, and all of us combined, we have 17 drugs that we've helped shepherd through to an FDA approval. So our corporate snapshot, where I think I'm number 8 in the top 15 shareholders, so I'm pretty proud of that. And that's the end of my presentation. Thank you.
Thank you, Leslie. Now, last but not least, we have RB Wealth Management. Please welcome Thomas Barron, founder, CIO, to share their insights and vision.
Thank you. I really appreciate the people staying. I know I stand between you and a beer. So my name is Thomas Barron. I run a family office out of Auckland. Our journey started around 2005 after a failed bank relationship where the bank managed our money really badly, and then we said we want to bring it in-house and manage it ourselves, and that from there the idea grew that we can actually manage the money better than the banks and other fund managers. So my expertise, especially I gained in the operational finance area, with foreign exchange, options, futures, and interest rate swaps. And I thought I added value in those operational companies like Philips, other big corporates. So why not apply that principle to investment funds? So then, okay. So we made a decision to set up an investment fund which is based on a fund-of-fund structure, which focuses actually on absolute returns. And we're looking for the best performing fund managers, asset classes and geographies and sectors. And the part where we come in is around 20%, where we effectively direct invest in areas where the global fund managers are underweighted. So we are looking at mining. So I have invested in mining and nuclear power. Our point of difference is the use of tactical derivatives where we add increased performance, and the use of strategic derivatives, where we protect the portfolio from black swan events when large drawdown occurs. So what's the world market current stage at the moment? So we have US exceptionalism, The world population is 4% is US. They create a GDP of 26%, and the market cap of public listed companies is 49%. So the US is completely overweight. If you look at Europe and China, it effectively only has a quarter of the market capitalization of the US. And if you look at India, India only has 4%, but has 18% of the population. So where do you think the growth is? So we are looking effectively at investing in other areas. Then cryptocurrency. We do believe in the blockchain technology as well as in cryptocurrency. What we really struggle is with the valuation of those cryptocurrencies, and especially if you think about approximately 5,300 cryptocurrency tokens are generated daily. So the digital scarcity argument, they're saying, is digital scarcity that makes up the value of the cryptocurrency, doesn't really line up. If you look at Trump coin just as an example, so he launched his coin, 80% of the coin he holds himself, and he only releases 20% of the coin, which means effectively he keeps the supply short, and that's pretty much with all other coins the same. So you can artificially shorten the supply. We do believe that the central banks around the world have been asleep at the wheel, so there is a lack of regulations, and we do think we need more regulations for the safety of the investors, so no honeypot schemes and no partial floats, because otherwise that's what you have inflated valuations. We do believe there's an overinvestment in AI, so there's a huge investment of the AI theme, and we do understand the logic behind it, and we're following the argument that there are new developments and there are lots of productivity gains. What we can't follow is we can't see how the ROI is coming back to those investments. So we do think that there will be some large impairments or write-offs in the due future, where you see that the investments don't come through. And especially if you look at DeepSeek, I mean, not 100% sure, but if that is true, that they developed the model at the tenth of the price, that would mean the other models would have to be impaired by 90%, isn't it? So that's why I think there is a bit of a problem there. And then also we think a lot of the global fund managers, they are accepting the MSCI World as a Morgan Stanley Capital International World Index as a benchmark. And then they say, if we return 6 or 7%, then that's good enough. So what are we standing for? So we are standing for an absolute return fund. We are 80% we investing in other fund managers. So in this case, in this case, 40% are invested in bonds, in Aussie and New Zealand bonds, due to their security and return. You have 10% of APAC equity, so effectively you have 50% of the investment at the moment in AUD or New Zealand dollars. Then we invest in 10% in US small caps, 10% in China, 10% India, and then the rest of the world. Where we differentiate from other fund managers is here, tactical derivatives and strategic derivatives. So we keep that quite separate. So tactical derivatives are effectively an investment, or not investment, between a trading position between 1 and 20 days, and that's where we effectively accelerate the performance of the fund. The strategic derivatives, they can be dormant for a long time if there's no drawdown or black swan event. So if there's a black swan event, like early August, we had this unraveling of the carry trade in China, in Japan. the indices dropped fast. That's when the strategic derivatives kicks in and then takes profit there. So our base case scenario in year one, we would return 13.1%. It's relatively boring in the first year because the uplift of the technical derivatives is only 100% of the 2.5%. So you only have very little uplift because you have 10% on the bond investment. Sorry. Then if we go through as our base case return from year 1 to year 5, then the story looks quite different. So you have consecutively, you have an uplift on your direct technical derivatives, so it goes up 100% year on year. So the return should grow to around, let's say 29%, but from an asset allocation perspective, we probably would start to recycle the technical derivatives into equity, just for risk mitigation purposes, because when the position of the derivatives gets too big, you have counterparty risk and other issues, so we probably would like to keep it at 10%. So that's the chart we have done from October 22 to April 24. At the moment, as of the end of February 25, we're trading around 330% on our technical derivatives. So the performance has gone down a little bit, but in average, it still would be 70–80%. Then in this case here, we would show how the portfolio would perform in a crash scenario. So in year 2, we have the S&P declining 25%. That would mean we actually said, okay, if that's the case, despite being geographically invested in other areas, because the correlation in a down market increases with all asset classes, we said, okay, our equity declines 25%. So if that declines 25% and our direct investment declines 25%, then the total adjustment to the portfolio is about 13.75%. Now, with our strategic derivatives, in a strong drawdown, it would add 7.5% back, which is around 300% return on the 2.5% we're holding for margin purposes. Then we would still generate around 80–90% on our technical returns. And then effectively, that would partially offset the total loss. So the derivatives would add 11% back compared against the loss of 13.75%. So we still would end up at around 7.3% return in year 2. And then in year 3, we would recycle the strategic derivatives back into equity, and then you would go, effectively, you would be back at the normal growth trajectory than if nothing would have happened. And so we believe with our extensive experience in bond, equity, and derivatives, we will be able to provide absolute risk-adjusted returns over the long term with our much lower risk profile than other global and long fund managers only. So if you have any questions, please let me know. And thank you very much.
Well, ladies and gentlemen, that concludes day 1 of Emergence. We'll be starting bright and early at 9 a.m. tomorrow, so make sure you don't drink too much, come with a hangover or anything of that fun stuff. Tomorrow I'm going to be kicking off a talk about AI and the potential that I see for it in this space It's been talked about a little bit on panel sessions, but I'll be doing a far more deeper dive as far as I think it's been underhyped as what the true potential is, because I know a lot of people have been talking about it a lot and thinking, oh, it may be overhyped, but from my perspective, I think there is so much more capacity in what can be achieved. So that'll be part of my talk. And we've got an incredible lineup across family office panel sessions, private credit panel sessions, and one other one. Private equity panel session as well. So 3 panel sessions tomorrow. Have a great night. See you tomorrow morning.